things. And you know that it kind of took a long time to really kind of understand what I was seeing. But again, teaching myself, I kind of got eventually to the easiest way to describe it is just what the system was, which was it was buy a breakout and use a 480R stop and hold it for a long time, and it looks like you make money on it. That was basically what I saw, but I can describe that now because I know what it is. I didn't know then what it was, if that makes sense. It was just something that I saw within a lot of shares. So I guess really the path to that was just looking at lots and lots of charts. This thing had everything from US stocks to UK stocks and all of them. So there were thousands and thousands of charts. So you really kind of got to learn, what charts look like, and again, like I said, what these patterns were that you see. And predominantly, it was trending. It was from bottom left to top right. That was what I was seeing. But how to trade it was I didn't really know at the time. And then I guess I stumbled across one of Michael Cavell's books, and I remember reading it. And I remember it made no sense to me whatsoever. The only thing I could really work out was that the charts looked the same. But I had no idea that there was this thing called trend following. And it was only when it was one of my aha moments when I kind of realized what it was. And I then started looking it up on the internet. And that was really when I started to kind of accelerate a lot. And then I found a mentor online, and he helped me out a lot with it. And he had his own system, which I tried to adopt, and probably couldn't really, wasn't mine. But ultimately, all that experience led to how I trade today, really. So that's kind of a brief history on it.
Yeah, no, that's really good. So we're going to get into that a little bit deeper. So let's just sort of take it right back to the start when you sort of picked up a book. It was kind of random, started reading it, and shortly after you started, obviously you had your demo account, which you did well. You put live money on the line and lost it. I'm curious to know, what did your partner think of this at the time? Like, it was a little bit random, it was sort of something out of the blue that you hadn't really talked too much about before, and now you've just sort of started trading, and you've started losing money, $500 at a time. Like, it starts to add up. What did your partner make of this?
Well, at the time, it wasn't a huge thing, because it wasn't a lot of money. Obviously, no one wants to lose $500, £500, wherever but it wasn't big money. That was losing, and also I didn't know what I was doing. And I think probably because I had the business, don't get me wrong, there wasn't loads of money coming in from that, but ultimately, I used to make decisions daily that I wouldn't consult anyone with. It's that was just the nature of what I did at the time. So I certainly wasn't putting in £500, and that was being used to pay the mortgage. Obviously, in hindsight, it's very easy to turn around and say, don't obviously get risk money that you can't afford to lose. But at the time, I didn't know that. And the same as if anyone else, starts in the same way, they won't realise what any form of money management is. So I guess in that sense, I was quite lucky. I'm quite lucky that I didn't go and put thousands and thousands of pounds in, thinking that I could have traded it up like I did with that just one trade at the beginning. That was kind of fortunate.
Yeah, I mean, that's a good point. So even then, when you did sort of run a few accounts into the ground, even though they weren't, big accounts, like you mentioned, that you were just sort of starting out small, what was it that sort of motivated you to keep pushing on? Like, why did you not go, oh, this doesn't work, or this is too hard? What was it about it that sort of motivated you to keep going?
Probably stubbornness. I'm quite competitive anyway, and I think it was that when you first start, I think you kind of start off with this idea that you can make a lot of money doing it. Now I made thousands on that first trade, the demo account, which like I said, it wasn't real money, but it was wow, I made money there. and I didn't do anything. I didn't physically have to go to work and kind of, do X, Y, Z. I literally sat at home for a few days over the Christmas period and made money. So I think it was that drove me. Then it was the game. I've always enjoyed strategy games, and it was the market to me is like the ultimate strategy game, and you kind of realize that when you first start, and then of course you couple that with the fact that you can make you make some money out of it. It probably is what kept me going. But I must admit, I've never thought at any point about this isn't right. I think it was just something that I first started and kind of clicked with straight away. So I guess I was fortunate there as well.
Okay, sure. So you mentioned that you, of course, read this book right at the start. Later on, you sort of read one of Michael Coville's books. Was there anything else in between there that you were really getting stuck into and studying, besides just looking at charts? Was there any other sort of resources, or did you do any courses or books? Like, was there anything else that you were learning how to trade from?
So I've got a ton of books, probably 100 trading books now, and I did used to buy quite a lot of them, but it was that none of them really made any sense at the start. One book that really did, and actually this was probably just before I read Cavell's book, was one of Van Tharp's books. Now, they are a bit deep to start with if you don't kind of understand it, but it kind of brought into play a few elements of a strategy, risk management, psychology, and that was what then kind of, it probably started me on the track of, okay, there must be some sort of formula to this. And I guess ultimately then that might have been the start of, looking for a holy grail. Obviously, I know that doesn't exist now, but back then it was probably those little things that kind of started me getting more interested. And that was where I, thought about getting the charting package. And then ultimately, I guess it was throughout the time, there's been lots and lots of books that I've owned that I've read and picked out little bits from. I've never done any courses, and the internet was obviously helpful because of that. You can type in anything. You type in trend following, you type in day trading, whatever, online, and a whole host of things come up. But I certainly didn't do a course. I didn't subscribe to anything then. It was all just self-taught, and I'd hear something or read something, pivot point or moving average or whatever option, I don't know, something, and I would Google it, watch YouTube videos on it, and just really try and teach myself everything that I could. And it's just kind of built up from there, really.
Sure, yeah, no, that's really good. So if you had to pinpoint just a couple of your biggest challenges or hurdles between the point where you were starting out to becoming a profitable trader, what would you say these were?
First of all, entering the beginner's cycle and then exiting the beginner's cycle. So what I mean is so I've spoken there about how I heard a few things, risk management, strategy, psychology, etc., etc. Those are kind of the beginning of where you realize, okay, so there's something in this. So, before a strategy might be buy this because it looks nice. I don't know, whatever people do when they first start trading. But then you realise actually that there is some sort of strategy in this. And as I mentioned before, what I was actually doing it to start with was buying a breakout. That was my first kind of strategy I ever put together. And it was basically putting that bit together, and then after a while trying something different. So, let's say the entry point was a breakout, the exit point was a 4 ATR. I then might try a 2 ATR. I then might try, I don't know, something else. Selling when the price has gone up for 3 days, and it was all that tinkering around that then leads to reading more books, which have then, of course, got more strategies in. The internet is full of strategies as well, not to mention all the ones you can pay for. So you're kind of going around in this circle where you're not actually you're really not focusing on your strategy at all. You're tinkering constantly, and that's just not a way to trade. And when you realize that I think is when you exit the beginner's cycle. That's when you really then start to focus on yourself. You start to focus on your strategy, and that's really, I think, that was when I started to become consistently profitable.
Okay, good one. And at what point did you? Well, first of all, let me ask from when you started to when you became somewhat consistently profitable. How long was that time there?
Ooh, maybe 4 years, 5 years, 4 years, I think. Like I said, I've been quite fortunate. I haven't lost a ton of money purely because I did have a few big winners to start with, and probably the one thing that I've always been just generally in life is that if things are too good to be true, they generally are. Now, anyone that can one guarantee make you money all the time, you're very wary of those people, and I think it's been that's kind of constantly kept me going as well, because you can't make a lot of money with, we're talking like 100% gains in a day kind of thing. There's got to be a downside to that, and of course there is. That was just very, very bad money management, and I didn't realise that at the time. But it was that instead of getting euphoric and thinking, brilliant, I'm going to do this every day, I'm going to be a millionaire by the end of the year, I think I was more cautious and thinking, okay, well, I've made some money now, how have I done it? And I think it's constant reflection on what I was doing that probably kept me going. And it probably kept me in the beginner's cycle a lot longer than I would have hoped for, because of everything I was doing. I was then reflecting on, and I might actually change something. And ultimately, I have ended up pretty much with a system that I very first started off with.
Okay, excellent. So, in that case, at what point did you feel comfortable to focus your attention purely on trading and let go of the business?
Well, I still do bits now for it, but I certainly more my trading is what I do on a daily basis. I've got a few interests elsewhere that I do as and when I can, but I rely on my trading. And I guess it was just when my account got big enough. I'm confident enough in what I do. I know it works, and now it really is just a case of continuing to do the process that I know works, if that makes sense. So I don't trade into intraday or anything. I use end of day charts predominantly, and the daytime I spend either working on myself and how I think about the market, and reviewing what I've done, particularly reviewing trades. That was always something that I've been quite big on. I've always had two portfolios, and one is the real one, and the second one is one that I call discipline, and that is my make-believe one. That is, if I had done the trades like I was supposed to have done and didn't do anything wrong, that is where all the gains are in there. And that one, incidentally, is about 400% above the one, my real one. But that's what keeps me going. By looking in there, it was okay. That I can show you trades from several years, or 3 or 4 years ago, where I might have sold on a dark day. When I really shouldn't have done, got scared out of a position, and it ultimately went on to be a huge winner. I've got lots of charts like that, and again with the word discipline written in the middle of them, so that kind of keeps me focused.
Okay, I really like that. So you've got obviously your live account, which has funded real money in it, and then you've got, how does that other portfolio work? That's a demo account, is that right?
Well, you can. So I've got several accounts with different brokers, and the chart package that I use, you can keep tracks of your portfolio in there. So. I've just got two portfolios in there, and like I said, one is the real account, and the second is the discipline account, and Yeah, like I said, I really wish it was the discipline one that was the real one. But it keeps me, like I said, keeps me focused and keeps me. Every time I go to make an exit, I do kind of have a look through that chart and make sure that it is a valid exit. I'm not just doing it because of it's going down and I want that money. It needs to be the right exit. It needs to be part of my strategy. Otherwise, I've got to keep hold of it. That's what the plan says. The plan makes money. It's not me. It's the plan. So I've just got to stick to it.
Got it. Okay, so it's a feature of the software. I really like that. That's such a really good idea. I appreciate you sharing that with us. Now, from the few things you've mentioned to me offline, I get the impression that repetition is a key ingredient to your development as a trader. So, would you be able to shine some light on the importance of repetition to you and how you continually go over and revisit material that you study over and over again?
Well, see, I think with the internet being how it is, Twitter in particular, there is so much on Twitter that is really good. There's also so much on there that's utter nonsense. So you really need to kind of have a kind of very, very good noise filter. But I went into trading many years ago with a set of beliefs, whatever they were, aren't important now. And the same as you will, and anyone else who's listening has got their beliefs about the markets, about however they trade. And when you read a book, when you talk to someone, whatever it is, you're ultimately you're gaining more information, and your beliefs might change. And I think that the repetition part is just kind of going back over everything that you've done. And whilst today you might, whoever you've been chatting to or whatever you might read or watch on YouTube or whatever, might be conflicting to those beliefs, sometimes you need to just go back and look at everything you've done in the past and either discount what you've been told, or does it add any value to your portfolio? And this is where, like I said, my discipline portfolio comes in, because every day I look through it. Every morning I just go through it when I'm, like I said, I don't trade throughout the day. So I'm quite fortunate that I get a lot of hours to really just work on my psychology and work on my, my strategy really. I'll just look through that portfolio and see what does a good entry look like? What does a good exit look like? What does and deeper than that, what does a pullback look like? When it's quite easy, of course, when your portfolio sits at all-time highs. But what does it look like when you've had a 10% drawdown or something? How does that look on? Let's say on this software package, it graphs your profits. So I like to go back and say, what does my chart look like when I'm in a drawdown, and see it. And then, of course, I fast forward it and I go, okay, so it looks like this now. And when it picks up again, it will look like this. And so it kind of reassures me that the drawdown isn't anything, to worry about. It's just part of the trading plan, or, part of the trading process, should I say. And I think that really helps, or it helps me anyway.
Okay, sure. That's really good. So let's move this along and get into some discussion about mentorship and the impact it's had on your trading. So if you could start by telling us how you met your mentor and what actually motivated you in the first place to seek out a mentor.
So to start with, it was that I knew I was onto something with the charting software, and like I said, seeing what I was seeing, reading a few books, and I just didn't know how to put it all together. And that was when I was really just looking for it sounds quite sad actually, but I was looking for someone to talk to, because I don't know any traders. I do now, but back then I didn't. I just had a ton of books, some information, some charting software, and it was so much chaos that I was kind of, I didn't know if what I knew was the right thing to know, if that makes any sense. I just, if someone was there going, yeah, no, you're spot on there, but you should have a think about this and this, or whatever, it would have made things a lot easier instead of having to try and figure it out myself. So I knew that what I was interested in was trend following. So I googled it and found my mentor online, and I sent him an email. I think we spoke on the phone actually for a long time, and he agreed to mentor me. He came down to see me, and he showed me his style, and this is probably where I'd say I made a mistake and probably extended my learning period by a good 6, 7, or 8 months or whatever, because I immediately kind of threw out the window what I'd been working on and adopted and tried to adopt his system. And it was then that I started tinkering around with things, and that was when, they say about, you find a system that suits, and that was really what I wasn't doing. I was playing around with his system, and so eventually I went back to what I was doing, and this was where I found the mentorship invaluable, was when I started explaining things to him like that, and instead of him kind of telling me, no, you're doing it wrong, he would ask other questions. So let's say he traded a breakout and I happened to buy it on pullbacks. That's my favourite strategy. And instead of him saying, "Oh well, a pullback is an exit signal," in his strategy, but of course for me it was my entry. So he would then ask, "Okay, so where do you define your risk? Where do you put your stop?" And he would ask questions like that would actually get me thinking about my strategy, as opposed to feeling that I needed to justify why I wasn't using his, if that makes sense. And that was kind of what I thought, what I think a mentor is actually really valuable.
Yeah, okay. So you mentioned that you found him online. How did you find him online? Did he have a website or a blog, and was he offering mentorship, or did you sort of approach him about this?
Yeah, so he ran a blog, and it was a paid mentorship. You can follow his signals if you wanted to, which a lot of people, I know there's a lot of services out there that are like that. But I guess to start with, that was what I did. But it was when I met with him and spoke with him that he wasn't just selling. He wasn't selling signals. If that, you can do that. That's part of what he does. You could just copy what he does. But that wasn't what I was about. I was looking to become my own trader, of my, with my own kind of set of beliefs and strategy, etc., and do it for myself. He would, and with him, you could trade your own pension fund and just copy his trades entry when he said, he has a Twitter feed as well that you can enter. And that's what I think, there's quite a lot of services on the internet that do. But it was when it came to the mentorship, he really, really did go in, help me out and help me understand what I was trying to achieve with my system. And that was when he kind of put his system aside and helped me develop mine and ask me questions about it. And then also, tell me things to consider. So, maybe consider the risk part of it and, that kind of thing, really.
What's the kind of level of interaction between yourself and your mentor? Like, is it sort of scheduled once a week that you have a Skype call, or like how often do you guys communicate, and how do you go about that?
Well, now we just communicate, via Twitter or Skype or whatever, just for kind of fun, just talk about the markets, emails or whatever. But during the kind of the learning process, all the time, he has got a protected Twitter feed that you become part of, and there's a load of other traders on there as well, and he kind of you'll all be tweeting throughout the day. Equally, he used to ring constantly, maybe once a week or whatever, to kind of see how you're getting on. Is there anything that you can help with? Via email all the time, and depending on where you are in the country, he would come and see you. He really was, it was kind of, he was being a mentor. It was unlimited. It wasn't a service that was kind of, one email a day or whatever. You genuinely did feel like you had someone on your side that was helping you out, which like I said, I think that was good, especially when you first start, because you've got so many questions. I mean, I used to email him constantly. particularly on down days. Big. Let's say that the recent pullback in the markets. That kind of thing years ago I would have got scared out of big time, and now you kind of on days like that. You speak to him, and it's almost like that little bit of reassurance. Actually, no, just hold on, because your strategy does cater for this kind of thing. Look at a chart. You wouldn't be able to tell when the Japanese earthquake hit, or you wouldn't be able to, because of the trend has gone from bottom left to top right. It's incorporated all of that. And it was on days like that you kind of needed a mentor, and that was what I found really good. He wasn't. You wouldn't ask a question and have to wait 4 or 5 days for an answer. It was like it was straight away, really, which is a really good service.
Yeah, that's really valuable, and I mean, pretty much most traders coming up need someone like that, who can be there for them. So. Just maybe in sort of summary, some of the highlights or standout points, like what are some of the lessons that he's passed on to you, which really helped you to see things a lot clearer?
Risk management, more than anything, more than definitely kind of not entering too many trades at the same time. He trades a shorter system to me. They're kind of not necessarily relevant to my system, but for his, I would say, he would teach you that, not to take too many trades on the same day, because of, we all know that can, if you've got one or two, you shouldn't enter 4 or 5 trades in one day. All of them are showing, a loss, and enter another 3 or 4 the next day, another 3 or 4 the next day, that kind of thing. You need to stagger it. You need to kind of enter a couple, make sure that, they're kind of, they are making a profit, and you can kind of build up from there. That was a big thing. You don't have to trade a lot. You really don't, to make really good money. I think his blog site, I haven't checked it, but it was something. He's up something like 400% in 3 or 4 years. So he's doing very, very well, and he's been sat out of the market for the last 4 weeks, I think. And it's things like that is absolutely invaluable, to kind of realise that you don't have to trade every day at all to make really good money, and you combine that with the right risk. And like I said, you've got a very profitable system. The other thing was understanding that actually you don't need to risk a lot of money to make a lot either. He risks 2%, which is actually quite high I think, but 2% of your account isn't a lot, and yet this is a guy, like I said, who is making 400% and risking 2%, on each trade. So that again was important, but the main thing was the psychology, was teaching you to probably have faith in your system more than anything. That your system works. Of course, that gets into a whole other topic about system testing and all that kind of thing, but we probably won't go there. But your system works, so you just need to have faith in what you're doing. And like I said, go back to the dark days when the market's down day after day after day, and you really, you're probably then thinking, well, this system doesn't really work. I might go short, but it's short in an uptrend is a silly thing to do. And the other thing is, well, does the system really work? Has it stopped working? There's all these things. Trading is full of kind of things that kind of counteract, counteract that, like arguments. But it's days like that he would then reassure you a bit more in the early period. And that, like I said, that I think is really, really important.
Absolutely, yeah, that's all really great. So yeah, thanks a lot for sharing that, Chris.
Are you ready to get serious about trading? Then join tastytrade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. tastytrade has to help you trade smarter. In position, you trading is news with Trade the newest IPOs profit target. It's a game changer trading with Trade the Pools.
Trading.
Okay, so my probably my routine is the easiest thing to describe. Is that I don't use scans. I just don't. I think that's probably come from the early days of just looking at charts and trying to figure things, trying to see things. But in the UK, the FTSE 350 is 350 stocks, so that's not really a huge amount of stocks to look through. So I don't use scans. I look through all of those at least once a day, sometimes 3 or 4 times, and that gives me an overall state of the market. You'll be able to see off that. For example, are a lot of stocks consolidating? Are a lot of stocks selling off? Are a lot of stocks breaking out? Are they breaking out and failing? Are they pulling back and giving a lot of reversal signals? So that kind of, I think, gives you a very good understanding of what's going on in the market. And then I would plot support and resistance on charts. And obviously, you could then combine that with kind of, I guess, like a Darvas box method or whatever. But, I don't draw the boxes. But you can see support and resistance if it's getting higher, like a ladder or whatever. That's the start of a trend. I've got plotted on the charts the 50, 100 and 200-day moving average. And I wouldn't use those for an entry, but obviously you can then, that gives you a feel for the stock. And every stock, I think, is different. They have a different buying and selling pattern. Some stocks don't pay any attention to moving averages at all, but they do pay attention to support and resistance. So therefore, that gives you a good place to either enter, also gives you a good place to exit. Some stocks do absolutely hug the 50-day moving average. And as soon as it closes below that, and maybe 2 days in a row, the kind of character of that stock has changed, and that then would be an exit signal. And some stocks don't pay attention to anything, and that for that I may just have like a volatility stop, so like a 4 ATR. But ultimately, I buy on pullbacks. I look for things that are already in trends, and I enter on a pullback, but the pullback must be to an obvious place. So, like I said, it must be a moving average or a support, or a support line, and then ultimately, I like to see a kind of reversal candle in there. Just something that shows me. My favourite ones are kind of a really nice spike down with a bit of volume on it. I don't really trade volume, but that's kind of a pretty good kind of pattern for me. And that then gives me a good place to enter, shows me that buyers are stepping in, and it gives me a good place to put my stop. So I kind of get all the things that I need out of that, and then I just, like I say, ride it up and, hopefully hold it for a long time. Ultimately, though, if it closes below, that entry point, I'll sell it very, very quickly.
So you said there, hold it for a long time. What would your average, sort of generally speaking, holding time be for a position?
Well, hopefully months. That my big winners I've held all through the recent crisis, and most of them are back at all-time highs. I find with trend following, particularly on stocks, I don't really know about forex and futures markets. I mean, I know what they are, but I've never traded them. So I can't really comment on the characteristics of those markets. But particularly in stocks, when they go wrong very, very quickly, kind of staircase up, elevator down all the time. So you've got to be prepared for that. But you find that if you enter on a pullback, it will very quickly tell you if you're wrong, like possibly even the next day. So, you need to be prepared to exit very quickly. But then it's just a case of holding. And then I would tend to add on the next pullback. And the next one, and the next one, and the next one, and hopefully, like my biggest winner is maybe 14 months old at the moment, and luckily it's showing no signs of backing down at the moment.
Nice one. That's really good. So before sort of adapting this, I don't know if you'd call it a swing trading sort of methodology, or it's sort of borderline position trading if you're holding for a number of months, I guess you could say. But did you ever attempt to trade intraday, like day trading?
Yes, and it nearly drove me mental. I couldn't believe what I was experiencing. I certainly believe that you've got a mental capacity and emotional capacity, and whatever you want to call it, 100% or whatever. And I just couldn't make that many decisions in that day, and let alone do it 5 days a week. I really would love to go and sit in a day trader's office and see how they do it, but I was, I saw there was something in pivot points, and I tried to do it, and I just couldn't. It really kind of it really messed me up in my head. Really, I'm in a very good place in, psychologically, and I like trading end of day data. I like seeing. I've mentioned before about breakouts. I think breakouts that they break out in the first hour of the day, I'm a bit dubious of them. But if you see something that's held on to its gains throughout the day, I think that's a solid entry. And I was trying to do that, but intraday on a 5-minute chart, and I really couldn't. I couldn't make that many decisions. I couldn't enter, exit with a loss, enter, exit with a loss, enter, exit with a loss. You get the pattern there, and then get 2 or 3 winners throughout the day, and have to do that 10 times a day. I'm sure that day traders can tell me they don't trade that much, but this was what I was trying to do, and I tried it for a couple of months, and like I said, I just couldn't do it. It really made me mentally tired. And so I have to be more long term, and that goes back to finding a system that suits you. I'm sure you've had people on this show that they would think about how I trade, and think I'm crazy. I don't have to look at the markets throughout the day if I don't want to. I just do it because I enjoy them. I really can make all my decisions based off end of day data, and the rest of the time, particularly in the last few weeks when it's news has been. The market's been kind of headline driven. I've just turned everything off and come back at the end of the day and seen which stocks have held up and which I've had to sell. And I couldn't do that through day trading.
Yeah, that's a fair enough point too. So you've mentioned a couple times or a few times throughout this interview that the word system. So just so we understand, how systematic is your trading?
Okay. Yeah. So, system is in nothing is let's say robotic. It's certainly not every stock that does this I must enter here. Every stock that does this I must exit here. It's completely discretionary. So I do I stalk a number of stocks that are in uptrends. Some of them are sloppy uptrends. But I look for those periods of kind of exhaustion with on a pullback. I do trade breakouts occasionally, but I'm more successful trading pullbacks. And the only thing that is, I would say, systematic, but I guess that's to the point where I absolutely will exit, is when my stop is hit, and that will be decided before I enter. So, like I said, there's one stock recently that I was in that hugged the 50-day moving average. So the easiest place to put the stop is below the 50-day moving average, or close below it, or if it was. This is where the discretion comes in. So if it closes below it and it closes on a pretty big candle, or it closes on it closes at the bottom of the range for the day, then I would just exit straight away. If, for example, during the day it's put in, there was kind of a wick on the end, I might say, okay, well, I'm going to exit as soon as it goes below that wick. So that kind of, in case a market maker's been pushing it around for whatever reason, because of course I'm not the only person looking at this stock. There is a lot of people that would notice that the 50-day moving average doesn't get breached a lot. So it's a very easy way to put your stop, and then just try to make sure that I'm not one of the weak ones that gets pushed out, and then obviously it motors on ahead, which has happened before. Equally, like I said, if it's support and resistance, then that's my exit. I'll know when. I'll decide that before I get in. So that's probably the part that is, let's say, if there is systematic. But like I said, ultimately it is discretion. But there is one thing that I would point out on that, is that as much as it's discretion, and I have just commented then about sometimes I might look at my exit. There's no way I don't hold a losing trade. So I wouldn't, there is kind of scope there to interpret that as, he might, a stock might have dropped to whatever price level, and he might be in denial about it. That's absolutely not what I'm saying at all. I'm just saying that occasionally, they go back to follow your rules, know when to break your rules, that kind of thing. It's just a process that I know works for me, but there is no way that I would hold a losing stock if it's gone past my exit.
For sure. Okay. So, how do I say? So, how did you know, or maybe I should say, when did you know with a reasonable amount of confidence that you'd found an edge, that what you were trading actually worked? Like, when was the point when you were comfortable with that approach?
Well, my account value, really. It was, I track my equity curve, and it goes from bottom left to top right. It doesn't mean that there are some, drastic pullbacks in that, but I could show you over the years. You can see they've got less and less. So ultimately, money is the way that that will show, that will tell you when you're right. I think I know that my system makes money. Now I know that everyone else you've had on your show, their system makes money. I'm not, there is no holy grail in that sense. So it's really just about finding a system that works. Now I could probably find one that makes more, but I don't really want to. You can obviously, once you found your system and you plot in your numbers, what your let's say what your winning percentage is, or what your payoff ratio is, or whatever. You can then adapt your money management to kind of fit your bigger, your longer term goals. But ultimately, it was that I was looking at my equity curve and see it rising. The other thing that was probably, let's say, one of the real kind of again, like, aha moments was. I started off with a system, and I tinkered about for a while. I tried a bit of, try the day trading thing or whatever, and tried a few other strategies. And one day I just sat down and was just frustrated and a bit like, well, how's this happening? Meanwhile, my mentor has gone on and made a ton of money, and I'm sat there with a lot less than he's made. In terms of percentage returns or whatever. So what have I done wrong? And that's when, like I said, the psychology side really kind of kicks in, because it's not the strategies. Okay, there's people out there that can trade pivot point strategies. There's people out there that can swing trade, day trade. They can fundamentally invest and make money. So everyone can. There is strategies out there for everyone. It was when I kind of went through my original strategy and looked at the initial trades and realised if I'd have carried on doing what I was doing, I would have made more than 80% more than I'd made that year, if that makes sense. It was then that I was actually like, okay, there's something in this. So what is it that I'm doing wrong? And that was, it was probably, the end of the beginner's cycle was when I realised actually it's really not about the system. What makes you successful as a trader is probably learning about your mindset and how you deal with your system, if that makes sense. So, for example, on a pullback, you don't, or a down, a drawdown in your equity, you don't kind of jump ship and look for the next best thing. And it's really then that you then start to think, well, okay, so I'm in a drawdown at the moment, so what should I do? Okay, so on one hand you can go, you know what, the system's rubbish, it's not working, I'm going to find something new that does work. That's, you go back to the beginning again. Or you kind of grow up and look at it from the kind of, let's say, a professional trader point of view and go, okay, is it the system? Does the system work? Yes. Okay, the system does work because it's made money in the past. What doesn't work at the moment? Is it the market conditions? And you go, yes. Or is it maybe I'm taking on too many trades, and you kind of, you start looking at that. And that, I think, is when you make a jump from kind of beginner to, let's say, more professional style of trading. You're just working on that constantly instead of going back and thinking about a whole new strategy.
So what were the certain aspects of your sort of psychology issues that you had to work through that were preventing you from sort of making potentially 80% more that year? Like, how did you, like psychology, I guess it's kind of quite a broad topic, but how were you able to sort of pinpoint what it was and then sort of focus your attention on that to be able to resolve those psychology issues that were preventing you from making a lot less money?
To start with, it was driven by frustration. I'm sure that everyone must get to a point. There's one of the guys in Market Wizards book, and you have to forgive me, I can't remember his name. Said there was a day when he lost a ton of money and turned around and said something, along the lines of, "What, am I this stupid?" And this is, no, you just got to keep going. And that really is kind of part of it. You need to. I needed to. I knew that the systems were making money, but I just wasn't implementing them right. I wasn't doing the right thing, and that was the bit that was frustrating. Why? What am I doing wrong? And that was, like I said, you then start kind of self-reflecting and really kind of looking. Well, if that system makes money, let's say one of these subscription services on the internet where you can buy, you can sign up to it and they give you the entry and the exit signals. Well, they make money they probably make money as a trader. You could get those same signals and not make money because you might do something wrong. It might be obviously your risk management and that kind of thing. Equally, it might be you might try and preempt the exit signal. You might preempt the entry signal, and that's nothing wrong with the strategy. Although when you first start out, you'll blame that strategy. That's down to you. That's your own fault. And I think it was again, it's from another book that I apologise to anyone that has written these, and I'm not referencing them, but where he says about you've got to take responsibility for everything you do, and you can do this in everyday life. And this is kind of, I think, something that I tried to do a few years ago, where every situation that goes on is your fault, and it's quite a big thing to say that, but everything that happens, let's say your partner comes in from work and she's in a bad mood and she lashes out at you. How's that your fault? And you constantly find a way that is, you start then looking at yourself a lot more in detail, and particularly with your trading. Why is this strategy? Why does it make money? In back testing, why does it not make money now? What am I doing wrong? And that's when you can be honest with yourself. That, I believe, is when you're kind of you make a massive leap in the right direction. And it's quite hard to do. Not a lot of people like being honest about themselves. I could probably list a lot of things that I know are wrong with me. One is I'm very impulsive. I've got an addictive personality, and these things. They're probably gambling is not a very good thing for me. Day trading. This is when I realised actually this isn't good, because I get impulsive. I make the wrong decisions. I jump into trades quickly and realise I've done the wrong thing, and that goes totally against my the way that I am. So therefore, I need to adapt my system to fit me, which is why I don't like looking at the markets throughout the day, because if I get I might get a rush, or I might I might lose discipline. Whereas it's much easier for me to sit down in the evenings, look through thousands of let's say 500 charts a night, and just make a decision whilst the markets are shut. I'll make a little short list of what I think I want to enter or want to watch. I might have another little look later on in the evening. I'll have another look in the morning. And if it still looks good, then I'll buy it. Equally, there have been times where you get a bit giddy because your portfolio's up, and you think, yeah, I'm going to buy that. You look at it the next day and you're like, well, actually, it's kind of invalid. That's not the right entry. And you'll sit back and you'll wait. But it's only understanding that I've got that side to me that I'm able to then adapt my strategy to fit, kind of my the bits that I would consider pretty crap about my personality.
Sure, yeah. No, that's a lot of great points in there that you touched on, so I really appreciate that. We should probably start to wind things down, Chris, but let me ask you, is there a resource or a book or a video or anything you'd like to recommend to listeners to check out if they'd like to dive deeper into sort of understanding the psychology of professional trading?
Yeah. I mean, there's firstly, just keep rereading books that everyone else mentions. I think I've kind of touched briefly in the past with you about this, that things like Reminiscence of a Stock Operator, Market Wizards, etc. There's I've read Reminiscences over 100 times now, and each time I hear something new in it. And the reason is that there is pearls of wisdom in all of this, depending on different parts of your trading journey. So Reminiscences, to start with, is a really nice story about a guy that likes trading and makes a ton of money. That's the nice story that you hear at the beginning. Then you hear about you might hear a part of his strategy the second time you read it. The second time you might hear about how he blew an account up, but he kept going. So you might have blown up an account recently, and you think, okay, well, he's done that. I've just got to keep going. And ultimately, you just keep kind of, every time you hear it, depending on what part of your journey you're on, you'll hear something new and relevant to what you're experiencing at that time, which is why I think those books are absolutely fantastic. The second was a YouTube video that Nick Raj put up called "What Makes a Successful Trader." I think it was a presentation he gave, and he talks about the two kind of facets of trading, kind of quantitative, it's easy for me to say, and qualitative, which is basically your strategy. He gives the best thing is he gives an analogy of a car. So the quantitative side would be driving the car. Put your foot on the gas, put your foot on the brake to stop, turn left, turn right, that kind of thing. But the qualitative side is learning about the roads, learning about, you get those idiot drivers that are indicating to go left. When you get that feeling, actually, they're going a bit fast to do that. So you don't pull out, you just hold back. And ultimately, they weren't going left. They just left their indicator on. And that's what I think is kind of what trading is about. You kind of learn those two parts. You learn, how to trade, and then you learn about everyone else around you in the markets. And that video is very, very good at describing it. But you have to watch it a lot to really kind of get all the points out of it. And again, I've watched it, loads and loads of times. And like I said, you kind of, once you realize that those two parts exist, you can work on one, which is your strategy, but then you should probably look at the other parts. What does it mean to you, and how does that affect your trading? And like I said, that was kind of a big thing for me.
Yeah, that's a really good video, that one. I've watched that myself, and obviously Nick Raj was on this podcast in the past, so if anyone wants to hear an interview with Nick, check out episode number 4. But all right, Chris, well, this has been really, really good, and I appreciate you making the time today to come on and speak to me and share with myself and also the listeners just a lot of really valuable information. It's been awesome, so thank you very much.
No problem.
And is there any way that listeners can get in touch with you if they'd like to sort of learn more about you or just sort of reach out?
Yeah, you can email me. So yeah, it's, I guess you put it in the show notes, but it's Chris Sace 1983 at googlemail.com. And that's a good way to reach me, really.
All right, sure. No trouble. We'll put that in the show notes. And if anyone wants to get in touch, they can just shoot you an email. But again, Chris, thank you very much for doing this, and take care, and let's talk soon.
Yeah, no problem.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey traders, what's up? What's going on? Hope you've been having an awesome week. I've got an interesting guest lined up on the show for us today, and he takes a slightly longer term approach compared to many of the guests I've had on in the past, but I think it's great to mix things up. He's a young guy, he's doing big things, and he's got a great story to tell. So let me give you the 1,000-foot view of where he's come from and where he's going. So Michael Melancinos started a job on Wall Street about 6 months before the '08 crash came through. So he was right there in the thick of it. He was actually an analyst on the trading desk at Bear Stearns and then later at JP Morgan after they were brought out. I'm sure you're all familiar with that story. Since then, Michael's left his Wall Street days behind him and now trades a fund of his own, using a systematic trend-following approach that operates on 40 global futures markets. While I missed a large chunk of the story there, you'll hear how Michael got to this stage of his career during the interview, as well as a few of the lessons that shaped him into the trader he is today, including the advice he received from market wizard Ed Seykota. I also like Michael's thoughts around why you should consider playing a game that's larger than money, and the emphasis he places on preparation is really great also. Alright guys, you know the drill. I'm your host Aaron Fifield. This is Chat with Traders, and here is this week's guest, Michael Melancinos. Hey Michael, what's up man? Welcome to the podcast.
Hey, thank you for having me.
No trouble at all. Thanks a lot for putting aside some time this morning to come on and be open for an interview. It's really good to have you on.
Yeah, well, it's 6:07 a.m. here in New Jersey, so not a lot of people are up right now. I'm probably the only person up on my block, but yeah.
Nice. Is that how you roll every morning? Up nice and early?
Yeah, because I was actually dealing with this problem yesterday. Because I was telling you before off the podcast that we recently bought a beach house, my fiance and I, and we're doing a lot of work around the house, and we still have a lot of chores. And my fiance is type A go-getter. She wants it done. She doesn't want things lingering. She loves to-do lists, doing them ASAP, and she's got me doing chores all the time. And I'm like, I need to do work, because the day rolls on, and there's just more and more stuff to do. It gives her more time to think about more stuff to do. I'm like, oh my God. Putting her bike together, doing the fence, doing this, doing that.
Never enough hours in the day.
Never enough. So getting up early and, before she gets up, is good. So this is, we have our sanctuary right now, our time to talk about whatever we want.
Good stuff. Well, I'm glad you could fit this in. So we've definitely got plenty to talk about. So let's just get into it, and let's get this started by telling us about how you originally got involved in trading, and perhaps even further back than that, what were you doing before this time?
Yeah, so I graduated from college in '06, started work in early '07, and I started in public accounting. So, and that's what I majored in college. So I wasn't entering the workforce with any kind of trading job or any kind of trading, experience or background of any kind. Didn't even intern with any banks or funds or anything like that. But a couple of my uncles went through Wall Street, long time, still in it as well. And just coming from a sports background my entire life, I had always interested in just competing at something, getting good at something. And after a while in the accounting job, that wasn't really fulfilling that urge in me. So, I started reading just, in public accounting, you have your busy season. I'm sure everyone knows an accountant, they have a busy season. It starts to die down probably in June. At least for me it did. So from June through the summer and then into the early fall is when I really started to read a lot, especially on the commute back and forth from Jersey to New York. I was working in New York. So I had about an hour commute every day on the train, so I would do a lot of reading then. And at work during the off months, I was reading a lot during the day. And it just became, I stumbled across, a lot of different blogs, a lot of different opinions, different this, different that. And the one that, stuck with me the most was this trend following style. And it kind of just made sense to me. And I was actually on Michael Covel's podcast maybe like a month or so ago. And I told him, when I read his first book, the trend following book, I think it was his first book that came out in '05, and I read it in '07. I said I slammed it shut at a few points in that book. I was like, there's just no way. Because he makes it sound so easy. He makes it sound like so simple, so this. And you know what? It is simple. At least the concepts are. And I think the concepts, parallel and have a lot in common with what happens in the natural world anyway. The ideas of diversification, spread yourself out. Don't limit yourself to one type of, to profit from one market, and then, buy and hold, comparing it to buy and hold's case. Don't limit yourself to profiting, to just making money one way. Be open to going short as well. Be open to staying out sometimes. And then the other ideas of, when you have a good thing going, let it roll. You're sticking with it. If it doesn't work, protect yourself and get the hell out of there. So all those things were, made sense to me just in general. And then I was like, oh, okay, now I have something that maybe I can actually try to get good at, try to get better at, because now I know, a strategy to play with, and, before that, what was I going to become, like a day trader? That's like the only other strategy I knew of, or like a fundamental thing. And that didn't appeal to me either, because that just seemed like a whole lot of work with not a whole lot of certainty. And I saw a lot of people going that way for a long time and losing a lot of money, especially in the bear markets, like of 2001. And I was in high school at the time. And then I guess before that, when the like a year or so before that, when like the bubble, the Nasdaq bubble was bursting, and then so that didn't really spark anything in me. But this trend trading thing started to make some sense to me and start to get the juices flowing, so to speak. So I started running with that, and eventually had some, light bulbs go off. And then I started getting so bored being at the accounting job that I asked my friend who I grew up with, who was working at Bear Stearns at the time. I said, look, dude, get me in there. Come on. I got to get off gotta get off the bench, so to speak. I gotta get in the game, and I didn't think I was gonna become a trend follower at Bear Stearns, but this trend following idea is like, oh, maybe I could start a fund. That was like in the back of my head, and then when the opportunity for to work at Bear came along, I kind of put the trend following thing on hold. I was like, oh, okay, I'm going to become like a Wall Street guy, and then work on the trading desk one day, and hopefully soon, and then all will be good, and I won't have to worry about this other thing. It'll just be just something that passed the time. This trend following, thing. So yeah, I think when I went to Bear in October '07. I was working a lot, so I got up at 5:30 today. Back at that job, I was getting up at 4:30. I was in work at 5, so I was home at like 8 every day. So I didn't have time to read or do anything relative to any trend following strategy, construction, or anything like that to one day become a fund manager or anything. I was just doing my job because it took a lot of hours to do. So, and then I guess throughout the 6 months later after I started working at Bear, it collapsed. So that was a big eye-opening experience for me. And then the team I was on went over and started working for JP Morgan, just doing the same job at JP Morgan, and the hours were still insane, but the middle of the day wasn't as intense as it was. So I started reading again. And then I started getting more serious. But those two events, the Bear collapse and the financial crisis, and they really opened my eyes. And, those people talk about aha moments. Those are two big aha moments that really put me on the path where I said, okay, I can't work anymore. I need to go and do my own thing. Because I thought this way, I was going to be, I thought I had it made pretty much going to Bear. It was a good company and everything, and good culture. And I thought, oh, okay, I'm just going to, just put my time here, and I'm going to be a big shot, trader on the desk one day, and all's going to be good until it goes down. I mean, the company goes down. I didn't get laid off or anything. The company disappeared. And that was just like, oh my God. And then half of Wall Street disappeared, several months later. So those were just, blessing in disguises for me. Because now I had the opportunity to actually do what I wanted to do, in the back of it. And at that point, it was just in the back of my head. But it was really a drive at that point because I saw it's not, my job and the Wall Street, vision of being a big shot or, it being like a good job just wasn't so anymore. The whole game was changed. Now it wasn't a safe thing. And now I saw that. So I saw a lot of my colleagues lose a ton of money, lose their jobs. And all the a lot of their retirement money, if it was in Bear stock or anything like this. And I said, look, this is not going to be me. And at the time I was 23, 24 years old. So I was still very young and stupid and impressionable, I guess. And that kind of woke me up and made me grow up pretty fast. So during the off months and, the transition period, from Bear to JP, and then even working at JP, it was just less intense, than my first 6 months at Bear. After everything collapsed, and then the financial crisis hit, things just got less intense. People were kind of just shaken up, and I don't know, I won't say didn't work as hard. That's not true, but just kind of like dazed, like they just got punched and knocked out, and then they're like stumbling to get to their feet. So people were just, I don't know, the workload just died. So I was just spending a lot of time doing more reading and getting into phase 2 of taking the path to become a fund manager one day. And that's what I was doing through, Bears collapse through, January '09. And then eventually got laid off from JP Morgan. The team I was on got laid off, and then I went to phase 3, because I had no job at that point, and I was devoting all my time to getting into the Excel, getting into like the X's and O's of creating a system, not just reading about the theory of it. So
yeah, no, that's really good. Thanks for really fleshing that out for us. But being so young, just having entered Wall Street, you were probably only, there for 6 months to a year before things started to unfold and the crash came through. Did it ever cross your mind that maybe you'd entered the wrong industry and this wasn't gonna be?
Yeah, eventually, but not at first. At first, I was just so preoccupied with what was going on. I didn't really think at all, and it was only till after I got out of it that I started thinking that, and was starting to read, a lot of entrepreneurial blogs and books and other things that, watching a lot of videos of these up and coming like startup entrepreneurs, because at that point it was starting to, there was no real startup scene then, like there is now. Like now it's like booming, right? Silicon Valley's booming, and I guess maybe other less intense Silicon Valleys out there, maybe in Europe and other parts of the U.S. But it wasn't that big back then. But it was starting to come out of that bear market into what it is now, which is a booming bull. But I was just reading and getting some exposure to other entrepreneurs outside of Wall Street, and then reading more about the trend following trader types, reading and going on their sites, the funds that were around and that are still around, but then also, getting to Ed Skoda's site, checking out his stuff. I entered one of Ed's trading tribes in New York, and just taking the next steps to get in the game, to get good enough to be able to play. At that point I was still just learning, but I was taking the next step from learning from the people that were doing it and hearing what they had to say. Because as an athlete, you want to learn from the guys that can actually play. You're not going to take hitting, in baseball, you're not going to take hitting lessons from, a guy who never played the game before, right? You take it from a guy who's done it and done it with success for a long time. So that's what I started doing. I started to get some FaceTime with the actual traders, and then other entrepreneurs in other industries. And then I started to believe that, okay, I'm starting to see the big shift here. Wall Street's not going to be the place to be for a long time, and maybe this is a blessing. And I probably had that thought, at some point during the winter of '09 when I was, trying to look for jobs or something, and just in my apartment reading, and in New York, it's pretty gloomy during those months. So that was kind of maybe a bright spot in one of the dark, dreary winters of New York.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, Lecter, the companies. Visit Tasty or set on the side equities. From penny stocks to big caps, now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade?
You briefly mentioned Ed, and you're referring to Ed Skoda. And I don't want to brush over that because he's a really big name. He plays the big game. So I'm curious to know, how did you actually get in contact with Ed? What was his tribe, his trading tribe, actually like, and what were some of the things that he actually really helped you with?
So he, before, Ed to me is a rare combination of very advanced technically and very advanced psychologically. He seems to understand both games pretty well. From being, him being an engineer, he's and engineers in general, they're very advanced, mathematically, science. They get that. That's their strong point, and they're not so strong with social skills and understanding behavioral dynamics, because let's face it, a lot of engineers, even accountants too, and maybe some other jobs, they're good with just doing their job, and they're not so good talking about it. They're socially awkward, or some of them can be. So he's not that, though. He to me, because he shares a lot of his information, a lot of his knowledge about things. I attracted to that quick, because he on some level reminds me of my father, because Ed's a very tough man to talk to, because he calls you out on your nonsense really fast. And he reading on his site, and then getting to one of his tribes, reading on the site about the theory about the feelings that we're unwilling to feel, so the feelings that we don't like kind of run our lives. And I was like, what the heck does that mean? I don't even know what that means. And, at that time I first came into him, probably around 24, 25. So I was still pretty stupid at the time. And I didn't know what that meant. And then, started getting into more of his FAQ on his site, which is where people submit, their stories and write whatever they write into him. And he responds. And, half the time he's being a wise ass in his responses. And the other times he's being pretty helpful in explaining what the tribe is all about, what's the whole process, what's the whole intention of it, how is it aimed to help people out. And, at its core, it's really just to help people push through their issues to get to a right livelihood, which is basically, you do what you like to do, and you do it, you serve other people. And you maintain your health, and you get good at what your craft is. And when I started in one of his tribes, initially it was a little weird. It was a lot of guys. In our tribe, it was a lot of guys in the financial space, which is not always the case in other tribes. Some people aren't in finance at all, and there's a lot of guys talking about, and then, first talking about their feelings, and then, he has this process called the hot seat, where you get into, some real intense feeling that you have that you want to change. You want to change you want to change from a medicinal response to a proactive response. So in the case of trading, you get people that don't like to lose money, right? What do they? And so they medicate it by, in some cases not having, not looking at it. They don't open their statements, or they don't sell it out. If they're long a stock or something, and it starts to go against them, they don't sell it, so they don't have to feel the actual loss. They could just hold on and hope that it returns to a more profitable, position one day. So these are all non-proactive responses with dealing with the loss that is true. It's, it's happening, whether or not you like it or not, it's happening. So you can either deal with it responsibly, proactively, or you can medicate it by not feeling it. And this is what a lot of people do, in their lives outside of trading as well. Same thing if they break up with a boyfriend or a girlfriend. What do they do? They don't go to the drawing board assessing their behaviors and, what did I do that really made this relationship tumble and end, they'll say, oh, they blame other people. They'll go watch a movie. They'll console a friend, an enabler who tells them it's going to be all right. It's going to, it wasn't your fault. Or they'll go, on a worst case, they'll go, do drugs or drink alcohol or, indulge in some unhealthy food or something to make the feeling go away, and to, justify themselves and, what happened. It wasn't their fault and all things like that. So, that's what the tribe's all about, because it helps you in a group setting. Ed believes that a group setting is better than trying to do it yourself, or it may offer a better way to just than going to a psychologist or psychiatrist or something, because you don't get to learn from the doctor doing it. In tribe, you get to see everyone work and everyone working on their own issues. So that he believes, is a better atmosphere to learn from, because you get to see other people doing it too. People get to learn and set examples for others, and that helped me eventually push through the fear of starting my own fund. I was scared. I didn't think I could do it. I mean, I knew I could do it, but I was afraid what my parents could think. Like I'm an only child, so I get a lot of questions and I get all the attention. So I was just nervous with dealing with that. My parents, they're slow and steady people that have been at the same type of job forever, and this is not something that they're used to. They don't know what starting your own business is like and the risks about that. They just think it's risky because it's you need to have a job. That's the way to go. So all these feelings that I had come up, the tribe helped me out, and learning the things from Ed, more on the psychological portion of the game, really helped me, eventually pull the trigger and deal with feelings that were previously standing in my way, deal with them proactively and take a more go-getter approach to it, rather than just sitting back and maybe they'll go away or distracting myself somehow. But and then like a side note to that, outside of trading, all these things help me in my life as well. And can't say enough about that, because my life in general changed after first being introduced to Ed's FAQ site and then getting into the tribe as well. A lot of people like to, Ed seems to have like a cult following as far as like, he was the guy who, made, read Market Wizards, couple 100,000% over 10 to 15 years, whatever it was. He gets a lot of attention that way. But, for those traders out there that think that's really cool or whatever because he makes a lot of money, or he did or something, that's all great. But I'm telling you, I think there's more to learn from him on the psychological game side, because I don't know, making money is cool, but making money and having good relationships and having a stress-free life and living a life that is fulfilling is much cooler. A lot of guys out there with a lot of money who are just miserable dudes and they have awful lives. So to those young guys, look, it's not all about the money, and it may be a weird thing, a trader saying that because the job is all about money, but, or that's the only thing we make, we don't create anything else, but you can create a life you'd like and, work with people that you like, and serve them well, by, getting your own issues straightened out, rather than just looking for the best system out there and emailing Ed and guys like him, like, oh, what's your system? Or teach me the system so I can go become a big shot. That's, maybe when you're young, you think that's the way until you get into it and you start trading a system or trading a style, And then you learn that, oh yeah, I don't just need a system. I need the whole psychological game too. I need the discipline. I need all this, the clear thinking. I need all that to make any money,
For sure. And I mean, on that point, like that's a really good point you make about how it's not all about the money. But I mean, most of the guys who kind of say that have money. Do you think it's always easier for those who do have, a big bank to be able to say things like that? Like, do you think it's a bit challenging when you're younger and you're coming up? You don't necessarily have all that money, so you've got like a safety zone, or you know what I'm saying? Like it's a lot harder to think that way when you don't necessarily have any money. Money does seem very important. Would you agree with that? And
yeah, and I would say, because I was in that position too. And looking back then, it's you likely want to make money when you don't have any and it's likely at that point a medication for the feeling you don't like of being poor. And so you think, oh, I'll just make a lot of money and that feeling will go away. And then you find, a lot of people become, maybe that drive to make a lot because you don't have a lot really helps you, make a lot one day and become a successful businessman or trader or whatever. Great. But it's a very myopic, I think, short-term view of and I say it's not a well-rounded strategy to make money and then get all the other things you want in life too. People tend to fall into that. In this case, like you're medicating that fear of, or medicating that feeling of being poor. I just want to make money. I'll do whatever I have to do to make money. That's why you hear about a lot of poor people growing up. They make a lot of money one day, because they're driven. They don't want to be poor ever again. And that doesn't mean that they're happy people necessarily. It may mean that they're good at their job. They're good at their craft or whatever. But you don't hear about the other things outside of their job and work success, because that's all business people care about. You don't hear about their personal lives. They're not going to we don't hear about Warren Buffett's personal life really, or like other successes personal life. So we don't get to see that side, and maybe it's a train wreck. Maybe it's not, maybe it's not what you would want for yourself. So, looking at just one piece of a person's life, I don't think is enough information for people to to learn from and then incorporate into their own structure, into their own vision of what they want their lives to be. If you want to just learn one skill and trade all other things for that one skill, then fine. But if you want to have good relationships, you want to be fit, you want to be healthy, you want to live a long time, and you want to have some money, and you want to have a good family and friends and all this stuff, and have a life of abundance and a vision, a well-rounded vision for what you want, then you may need to learn how to make money there. But maybe becoming a hotshot trader or a hotshot this or that works against a well-rounded view for yourself. It may not work like that for another person, but maybe for you, you need to, take other information into account and not just go for it all and try to be just the big shot trader, because you may be that one day, but you also might be, a jerk. You also might have a couple divorces. You also might, have a couple of health issues. And I think Ed would be the first one to admit that. Don't forget he's had 2 divorces. And probably a lot of drama during his great trading run that he may not be too proud about. It's what I'm saying? So, the money's cool, performance is cool, great, but there's other things that that matter. And I think Ed can, going to his site and maybe joining one of his tribes, learning about that process can really help people see or come to that. I'm not saying this view is correct, but it may just open themselves up to, maybe there's other ways to think about it. That's all. I'm not trying to push a way or a system on anybody or a way of thinking on anybody, but that's what happened to me, because I thought it was all about the money. I thought I was going to have it made, and then Bear went down, and then and then half of Wall Street went down. So, there's other things that become important. And I learned that for myself during those crashes.
Yeah, I like how you answered that. You touched on a lot of great points there.
Yeah, and I also tell a story about a guy who I work with at Bear, and I remember standing next to him a day or two after Bear, was bought by JP, and this is a guy who's been there for 20, 30 years, and nice guy. He's a regular guy. He just works on Wall Street. He didn't know anything. He didn't have any inside info. He didn't. He just made a little bit more money than the average guy, but he was still really nice. And we were standing on the trading floor, and he was looking at all the screens. This is when people were just, half the people there who used to be there weren't there, and it was a total mess. It was like the last day of school. There's nothing going on. Everyone's just kind of talking and not doing anything. And he was looking at his screens, all the flashing lights, because at that time the markets were still wild, going, high vol and everything. But at Bear, there was no business being done. So we were all just kind of watching it. And this is after the guy knows that he probably lost a ton of his retirement money. And he's like, Mike, you see all this? And he's pointing to his screens, all the flashing lights, all the Bloombergs and all that. And I said, yeah. He said, all this means nothing. I'm going to a wake tonight for one of my daughter's or son's classmates who killed themselves because they were getting bullied at school. These kids are 10 years old, 8 to 10 or something very young. And that was another hammer over the head moment. Yeah, you're right. This is not, I don't want just the money here, because focusing on that, you miss out on some of the more important issues of, in this case, kids. How important is it if your kid just died? Really, is it important? I mean, do you really need to have that big trade? You need to make that big no, because you have other things to worry about, and I feel that really. That helped me, one, even further push to get the hell out of the workforce in this, Wall Street, but also helped me to really think about more, when I did pull the trigger, what kind of business do I want? What kind of life do I want? Outside of just trading my trend following system, that trend following system is just one little piece, It just helps deliver some profits to my investors. That's it, But, incorporating some of the other more qualitative, aspects of life, into my picture, my life's vision picture. That moment with that guy really helped me at least be open to thinking about stuff like that. I didn't, starting the money hungry. Grip started to loosen a bit after that conversation.
Yeah. Well, that's really deep. Thank you for sharing that with us.
Yeah, it was pretty gloomy, but I mean, they're real things.
Yeah. Well, I mean that helps put things into perspective, doesn't it? And look at the bigger picture. Now, let's turn this discussion more towards your actual trading methodology. So I'd like to ask you, could you describe to us how do you actually view the markets, and just share an overview of your particular trading style? So you've already mentioned it's trend following, but let's get into the nuts and bolts of it. So what actually is trend following? How do you view the markets, and just, yeah, give us a bit of an overview of your approach.
Sure. Yeah. So the basic ABCs of it, if I break it down into a diversified, systematic, long-term trend following, I'll break down each like little sections. I feel like going like that is easy. It helps people follow along easier than it is just me spewing. I'm going left, right, back, forward. That people can't keep up. But anyway, so diversify to me, I take it from I'm on the stance that I want to be able to trade any trends out there. I want to be able to trade and profit from any moves in the world. Really doesn't matter. I'm not restricting myself to just stocks, which is the traditional approach, like the stocks and bonds and the real estate. I want to be able to trade currency trends. I want to be able to trade commodities and other foreign markets, foreign stocks, foreign interest rates as well, because evidence shows, you look back and do some research, that things outside of stocks and bonds move quite a bit. And why would I just want to sit in one spot and just wait for all the movement to come in those areas? Why not I branch out a bit and maybe open myself up to being able to profit from some moves like that? And what's happened over the past year has been a good example that currency trends have been great since last summer, and energy as well. And then most recently, metals started to break down again. So if you're a traditional buy and holder, you just don't get those moves. Maybe you can apply your style to that, to those other markets and do okay. But in the meantime, there's some pockets of time where you can't, because you're not open to them. So I like to be open to a lot of different things. To make a baseball analogy, if you're a hitter, you don't just want to be able to hit a fastball down the middle. You need to be able to hit other pitches in other locations, and if you can't play, because you're not good enough. So you need to be open to hitting different trends and different markets going different ways, and that's what kind of I feel. I like doing that because I don't want to be a stock picker. I don't want to be a picker in one area and try to trade every little wiggle in one or two markets. I want to be in a lot of different things and not really have an expertise in any. I just kind of want to just float along when the movement comes in different areas and just set my sails with them. So I get okay. So moving from the diversified to the I'll go to the long term first. So I don't want to be trading. I'm not a day trader. I don't really like to look at markets all that much during the day. Again, it's like quality of life. I don't want to be sitting in front of a computer all day long. I like to do other things. I like to get outside. I like to read and do things with my fiance, my friends, and family that don't require me to be sitting in front of a computer looking at my trading software or the quotes all day long. Like, I wanted a system that I didn't need to do that. And so I focus on long term. I focus on trading trends that my system on average, its average holding period is about 7-8 months long. So that's my average position that I'm holding. So I don't really need to look at it every 5 minutes. I don't need to look at it every 30 seconds. So I can update it daily, check it periodically, throughout the day if I'm around, but not an everyday thing. And I want to be there for the biggest moves too. The biggest moves exist on longer time frames, and that's what I like to be. I like to hit home runs, and I don't like to be a singles hitter where I'm trying to get wiggles every day like day traders do. They try to get a lot of little moves during the day or during the week. I forgive that. I say you can have those moves. I'm not trying to catch those. I'm just going to try to be there for the big sucker that plays out over X months or years or weeks or something. That's just my style. And again, there's no right or wrong. I mean, I feel that my style works better for me, but it's not always the case with everybody. And then I guess, all right, so we have the diversified, we have the long term, we have the systematic. So systematic, I just create a method, a rules, a set of rules that decide, which markets to select, which markets I'm going to look at, and then which markets I'm going to trade, and then which market, and then position sizing rules. So how big and how small am I going to be in each market that I observe, and then when I'm going to get in and out. What kind of methodology. I kind of already said that I'm a long-term method guy, so in that case, my entries and exits are fairly loose. It takes more of a move for me to get in and out than it would for like a shorter-term guy. He's more tight. His entries and exits are tighter with the movement than I am. To make it, I guess, an example, like, let's say say I'm a breakout trader, I use a 200-day look back, so if the market makes a 200-day high, I'll get in, versus a shorter term guy, which is, it wouldn't work. I wouldn't be able to follow a shorter term system that well, but just because my psychology doesn't really fit with it. But like a shorter term guy may go enter market on a 20-day high, so he's getting in and out much quicker. I like to be a little bit longer.
Well, let me ask you about the systematic side of things, because you started out as an accountant, then you became an analyst on the trading desk. At what point did you learn to start coding, or did you code, or did you bring in outside help? Like, how did you actually develop your system once you had an idea and some rules that you thought might be valid and have a edge that's worthwhile trading? How did you actually turn this into a functioning system that is essentially automated these days?
I old-fashioned way, I started with some pen and paper, and then I got into Excel, and I still do a lot of the majority of my systems in Excel, because I like to see, like, Excel allows you to go under the hood and kind of see what's going on, versus a software which kind of just pumps out results. You don't really see what's happening. So I called a couple guys to help me, who I used to work with, who were more advanced with coding, and they kind of show me the ropes with some like Python software and C# and things like that. And that's all good as far as like testing goes, because you can be efficient with running a lot of tests fast. With Excel, it's kind of slower because you got to, it's just a little more detailed and not as, not as advanced as some of the other softwares. But anyway, I called a couple traders who I looked up to, who Covell wrote about in his books, and then they kind of told me, like, look, we can code, but it's not really like a necessary skill to have. You need to have some sort of like basic, you can do everything in basic Excel. That's kind of why I started in Excel. So you can start there, and you can always stay there if you want. You don't have to go to the software route. So that's what I did. I got into Excel, just kind of started making it up as I went along to learn it, and didn't really have a guy there, sitting next to me while I built it up. And I designed like a risk sheet. So I had like a portfolio sheet, which is where I had all my positions. It had my position size, has where I got in, where my stop is, what the current price is, and how much money I have at risk, what's my P&L, and all those things that tied back into other sheets that I had for each market, which each market was just had the data, then it had my position sizing sheet, like how big of a position am I going to take if I get a signal, all that. And so I updated that stuff every day. I had a new, every day I go into the market sheet that I had, and right now I have 40 markets, so I have like 40 different sheets for each market, and so I update the data every day, and then I see what my rules tell me to do. How do they change? Should I take a bigger position today if I get a signal? What's the new stop orders? What's the new buy stop? What's the new sell stop? When am I getting in? When am I getting out? Type of thing. So those, yeah. I mean, I started probably doing that sometime in 2009, 2010, and then just kind of made changes and advances along the way as I've gotten better at building these things, and I guess more comfortable with just how to do it. But yeah, I mean, there was really no fancy way. I mean, and you could probably hire someone to do something today or help you, but I didn't.
Okay, so I've just got a question around that. You obviously mentioned Excel there quite a bit. What sort of data were you actually putting into Excel? Was it like calculating anything, or had you programmed it to output certain data, or was it just you were just using it as a spreadsheeting tool to keep track of your positions and your trades and that type of thing, or was there something?
Now everything is coded and linked together. So I have a data software that inputs into the market sheets every day, and then from those sheets they spit out the new days buy and sell signals if they are changed. Like a lot of times, since I'm so long term, they're not different at all. The new position size. So yeah, I don't just have a summary sheet of like what my positions are, so I could see it all in one spot. That kind of auto populates from other sheets and things. So it's a whole big linked web of things. But I think you could start with a simple sheet of, if you do things by hand. If you're a non-systematic trader, you just kind of want to make trades, based on your gut or something, or do it another way. You can have a sheet that kind of organizes things for you, like, so you can see what it is you actually have on the books, what you have, that we don't have to remember everything, and that's kind of what helped me in the beginning, because if you want to be a diversified trader and trade a lot of different things, you need to organize this stuff, because there's no possible way you can memorize and remember everything about where every stop is and what every position size is and what's the proper risk management and position size to take in every market. You can't possibly remember all these things. So maybe you can, maybe you're smarter than me, but anyway, I like to keep it organized, and I like to keep it in front of me, so I don't have to remember it all, because I have other things to think about too, other than just trading.
Of course, very important to be organized, for sure. It's a big one.
Yep, that's what I feel this has helped me to do, organize, and I feel that's what a lot of good traders in general do. Especially the systematic guys, because they're computer nerds. They don't want to have things in their books that they're not accounting for, or that they run the risk of not remembering, or maybe some of the traders of old that do it like that, where they're kind of just more on the off the cuff. They kind of see their their statement, and then they make other decisions. They kind of just on the fly of changing things and not really setting to a disciplined set of rules that hold them accountable to do what the rules say, and to organize them, and to face them every day. Some people don't want to face their statement or their summary of what they hold, the positions are, because they don't. Again, going back to the Ed Seykota stuff, people don't want to feel, the feeling of being bound by the rules that they set for themselves. They kind of want to do what they want to do, sometimes, and they don't want to obey the rules. Like dieting, same thing, people just go off the rails. So those things are, they won't appeal to everybody, but I feel that they really help me to, again, be organized and know what I'm doing. If I don't have this setup or something set up that tells me what to do, when to do it, and how much position to take, I feel that I don't know what I'm doing, and I'm going to freak out because I don't like not knowing what I'm doing. I need to write things down, and I need to be organized and everything. So that's why I go with this approach than maybe some others.
Yeah, I think that's a fair point too. Really, it comes down to what's the right approach for you. What fits your personality. So that
Sure.
totally makes sense. Now, when many people hear the word fund, or someone runs a hedge fund, they probably just assume big infrastructure, an overwhelming amount of technology, plenty of computers. But you started this working out of your parents' home, I understand.
Yeah.
So, what's the case now? What does your setup look like? What would someone see if they walked into your office today?
Well, I work out of I don't know if your viewers know what WeWork is. It's a startup that provides space to entrepreneurs, solopreneurs, small businesses, and they're in a lot of cities around the U.S. I'm not sure if they have anything outside the U.S. right now, but
it's like a co-working space, isn't it?
Co-working space, yep.
Yeah.
For a cheaper amount. So I have one of those spaces, and it's just my computer. I have all the security and everything, so no one can steal my stuff. But that's pretty much it as far as what you'll see. What you won't see, but is there is that I have a third party auditor and tax guy that we have for a fund. You have to have an audit done every year, and I also have my my legal and compliance guys on retainer when I need them. If I have issues or something that I need to do, like right now I have a prospective investor from India. I didn't know if I can take an investor's money from India. I don't know what rules and tax laws there are. I don't know about these things, so I consult those guys to help me, and then I have my my administrator that does all my monthly performance reporting, and they keep the financial statements and all those things of the business and the fund. So, and then they send out their capital statements every month for every investor, so they know what their account's worth and how it performed that month and everything. So, but those are things that don't require big buildings, that I need to, office spaces that I need to, pay for and all this stuff. I kind of just outsource that stuff, which a lot of funds do too. It's what we do. But I don't have a team of traders on staff. I don't have portfolio managers on staff. I do those things. And again, the systematizing of this stuff kind of helps with that. At least for me now. If I get a little bigger and I want I want some more freedom for myself. I want more. I want a guy on the desk 24 hours a day. Those types of things. Because obviously, if it's just me, I go to sleep at some point. So someone's not always there watching it, but I always have my stop orders in the market all the time. But maybe having someone there would be more of a thing at some point. But I don't know. I think I don't know what else I have that's really, I don't know, necessary. I mean, you can surely complicate things and buy 15 monitors and get a whole lot of different systems and softwares and have multiple models and get crazy with that stuff. But I feel a lot of that stuff is more of a distraction. It's more of a posturing move to look the part rather than what it takes to really do the part and do it well. You don't need all that extra stuff. It's kind of just distraction. It's kind of just complications. I started out with one computer at my parents' house in 2011. I now have upgraded to 2 computers. So that's the basis of my complication.
Nothing major then.
No.
That's really interesting to know that you can do it on,
yeah, and expenses. I mean, if you want to get out there, you want to raise a lot of money, and you want to be compete with like the biggest funds in the world. Yeah, you're going to need more infrastructure. You're going to need compliance teams. You're going to need all these other things that that allow the biggest investors in the world to even touch you. This is not like how it was in the 70s or 60s, 70s, and 80s, where you could be some dude in your garage that just has a good track record and you would draw interest. Today, forget it. That's not going to happen. But you could definitely, raise money and do okay and make a life for yourself. If you didn't want to go down that route, with local people, local businesses, you want to run local money or friends and family, things like that. You don't have to get out there and like pitch yourself to the world if you don't want that. If you do, you're going to need some capital to build a big house that allows these big investors to enter. Because right now, for a lot of people, like with my own situation, I call, have conversations. People reach out to me, from family offices, fund of funds, things like that see my track record, and they say, oh, we like it. We're thinking about, can you tell us a little bit more about your system and your thing and everything? Tell them about everything. What's your AUM? Oh, it's X. Oh, that's too small. We can't really touch that right now. Oh, do you have all these other bells and whistles, the compliance, to this, to that? No, I don't have that right now. Don't see it as a need. Oh, well, those are the things we require. So it's like immediately, if you don't have all this extra infrastructure, the biggest guys are not going to be able to invest with you. That's just the case. Especially after probably 2008. Everyone's all freaked out now that everyone's a fraud and everything. So,
sure. Okay.
Yeah, everyone's just kind of picky, but that's not the case for, the investors that you could probably find on your own that your friends and family, extensions of that. They don't require that stuff.
Yeah, sure. No, that's really good. So we should probably start winding this down. We've been talking for close to an hour now, but let me just ask. I've got 2 more questions I'm keen to ask you. So the first one would be, are there any traits from your time playing sports earlier on in your life that you believe have helped you succeed as a trader? Any traits that have you've essentially carried over and applied to your trading today?
Yeah, I'd say a couple. One off the field and one on the field. Off the field was the preparation of you prepare to develop confidence. That's how it worked for me. If I didn't practice and prepare for the game, I was a baseball pitcher, so I would need to, work on my pitches and protect, do my arm, shoulder exercises to keep my arm healthy, and there's my other exercises for my other body to be loose and stretched and strong, everything so I could be explosive and move freely and things like that. So if I didn't do those things, in between starts, I didn't feel confident and I couldn't execute well on the field. So that was huge for me because I was not a kid that was blessed like with this Superman talent where I could just like roll out of bed and just like kind of do really well. I really needed to do my work and like do all the little things that I don't know that helped me get on the same playing field as some of like these like superstar athletes or these things. So that's what helped me a lot, and I became like I got a lot of joy out of it. I almost enjoyed practice more than the games a lot of the time, because it was just that like this is what I got to do. And plus I got to like do it while I was like alone. It was like my little sanctuary. I was in the zone and just preparing for the game and visualizing kicking ass on the field when the game time came. So I know I liked all those things. And that's probably why I got into this. Why trend following, why systematic approach appeals to me, because you get to prepare, you get to do all the little things, and like the training is kind of just like pretty easy. It's not a lot of work. It's the practice time and the preparation time is the work. So I think also on the field, when the game time came, you have the confidence, everything, and you're playing. Sometimes you get into situations that are you have some pressure. You have the game's on the line. You have a big spot in the game where it's a make or break. In my case, like a pitch where it can mean the difference between getting out of the inning or losing the game or falling behind. So it was weird, and what I still feel today is that I can deal with pressure very well because I know I've done the work. So if I know, I just keep doing the work, and I know I do what I'm supposed to do, that there really is no pressure. The pressure is really just, I feel like when I feel pressure is when I feel like I'm unprepared. And I used to feel that way sometimes in school when I didn't study for a test as much as I should have, or something like that, or making a presentation, which like doing a project that I didn't do as well on, or I didn't prepare as well on. That's when I would feel my heart rate would go up. I get that anxiety, like those rushes through, like I get in like my chest, but I get those feelings that's like, oh my God, I don't know what I'm doing. Like I'm not as good. And then my delivery, like my test taking, I'm nervous, I'm not thinking clearly and smoothly and slowly. And same thing on the field. Like the game's moving fast. I'm not as calm, so I can't execute my move, my pitching motion, as fluid and as explosive as it needs to be in order to execute the pitch well. If you're jittery and your hands are shaking and you're not as sturdy on your feet and your mind's racing because you're now aware that you didn't prepare, so your mind is screwed too. So I think that happens in trading as well. That's when people jump off their systems and jump off their approach. It's likely due to a preparation issue, maybe, or they don't really have a style that they're committed to. They have kind of a style, but they don't have a really rock solid foundation and approach for what they're doing. They're kind of just on the whim, kind of just making it up as they go along, and they're winging it. Like in my test taking, I used to maybe some of your viewers have the same experience too. They just like didn't study or something. They come into test and they're all anxious and they're, I'm just winging it. I'm just, whatever. I think I know it okay, but they definitely usually don't know it on average. They don't know it as well as if they took the time to study for it and prepare for it. So yeah,
Absolutely. Yeah, I really like how you highlighted the need for preparation there. I think that's solid. And I mean, in that answer, you pretty much covered the second question I was going to ask here, which was going to be around what a quote I've heard you say in the past is people know what to do, but they just don't do it. And I mean, you kind of covered it there as a lack of preparation. And
yeah, and I think that's something that the best traders do really well. They know what their style is. They know what they like about their style, what they don't like about the style. You know, there's some things about trend following I just don't like. You know, but I know I can't have it all. I can't have everything. It's unnatural to have everything, and if you want to have everything, just go observe the star systems out there in the universe. You know, they want to have it all for them. And what happens? They collapse into a black hole and they die. You know, so I feel that you're gonna have to give some things up in order to do your style well. You know, in trading, you know, in trend following, you know, you're giving up the need to catch every little wiggle and move out there. You're giving up the need to even understand what the markets are doing. You forget that with trend following. You're kind of just, I don't really know why this thing is moving that well, but I'm in it and I'm long. I'm in it. I'm riding the trend, and I gotta stick with this because that's my system. I need to ride trends, so I can't afford to not be in this one just because I don't understand it. That's kind of one of the most, I don't know, maybe one of the bigger issues people have with it is that, how can you not know what's going on? What are you talking about? How can you be long a thing and not understand why it's moving? And that's like, how do you answer that? You know, to an investor or someone that is come up with in a career that it's built on understanding things, and a lot of trend followers just don't care about that. And doesn't mean they can't make money, because obviously they've shown there's a history of them doing really well. But it's something that someone who doesn't like to feel that won't be able to be a trend follower then. You know, sorry, you just won't be able to do it, because you commit that in your style as to not understanding. So you just need to be okay with what your style is and what the quote unquote good and bad of it is. You know, what you like and what you don't like, and that helps you, I think, create a style that you can execute like a Navy SEAL every day. Like you can be able to do it and do it well, and not apologize for, I don't understand it either, but this is my style to do it, and I'm doing it regardless. This is, I know what I have to do. So, I feel, getting and being in touch with at least the things that you like and don't like, you can create a better strategy for yourself that you can be able to execute well. And then when you can do that, you'll probably you'll stand to do a lot better over the course of your career with trading.
Yeah, no doubt. So, well, Mike, we should probably wind this down now, but thank you very much for coming on. It's been really great to have you share these lessons and experiences and what you've discovered for yourself in the markets, because I think it's going to be interesting for listeners, because you're coming at it from a different angle than what many of the guests which we've had on in the past. So it's good to have a bit of variety in the mix. So I really appreciate it, man.
Sure. Yeah.
Do you want to share with listeners where they can go to find out more about you?
Sure. I mean, I have my firm's trading site is Melicinos Trading. I think will you have it in the show notes, something, because of my name may be a little bit difficult.
Absolutely. Absolutely. So if anyone wants to check out Michael's site and a bunch of other links and any of the resources that we've talked about in this interview, including Ed's site, I'll link to that also.
Yeah.
So they'll all be at chatwithtraders.com/34. everything will be there in the show notes. So, yep, I'll link to your website in there. So definitely, I suggest everyone goes over there, checks it out. Are you on Twitter also?
Yep. Not very active on it, but
Okay.
I'm on it. It's just it's M Melisinos. Again, I would put that in the show notes because I'm sorry, my name is Greek and it's kind of tough, but it's like it spells like Melissa. So it's just MELISSINOS.
Got it. Yeah, no doubt. I'll link to that in the show notes also. So yeah, because I know many of the listeners are quite active on Twitter, so I'm sure they'd like to check you out there. But
for a long-term systematic trend follower, Twitter, other than maybe posting some maybe more deeper, long form type of content, being on there, like the stock twits guys, like you'll never see like a long-term trend fall on there because he doesn't really, he's not doing much. He's not doing as much as some of those other more active guys. So I know Twitter's good. I know Twitter's good for that, but for me and my style, no. But yeah, I should post. I should be posting more informational stuff on there though. I think who does that well is Jerry Parker. He was one of the turtles that Covell highlighted in his book many times. He's been on his podcast a few times. He's good, and he's been around a long time. He's probably a billionaire trend follower turtle, probably the most successful turtle. But he does that well on Twitter. Go check him out.
For sure. Okay, no, that's really good. Again, Michael, thank you very much for doing this. We'll call it a wrap, and let's talk soon.
You got it.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey everyone, what's going on? Welcome to episode 35 of the Chat with Traders podcast. This week, I have a very special guest on the show who almost needs no introduction, and that is Howard Lenzin. He's best known as the co-founder of StockTwits, but he's really a man who wears many hats. He's also a trader, investor, hedge fund manager, entrepreneur, and a rock star angel investor who has invested in over 100 startups at various stages. So, as you could imagine, I was thrilled to have Howard on the show this week. We spoke for around about 50 minutes and discussed the early years of his career, from the days of when he used to work in the back office of a brokerage firm. We also covered Howard's methodology around trading high growth stocks and the idea of buy high, sell higher. We also got into how innovative technology may revolutionize the landscape of trading over the next 5 to 10 years. And on top of this, we also talked about some of the angel investments that Howard has been involved with. Now, guys, if you enjoyed this interview, please go to chatwithtraders.com/iTunes and leave a review. It doesn't have to be anything crazy. Even a single sentence would be a huge help. I'd really appreciate it, and it's the easiest way that you can support this show. So that's chatwithtraders.com/iTunes. Go there now and just leave a very brief review. That would be awesome. Thank you very much. All right, guys, I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest, Howard Lindzon. Howard, welcome to the podcast. How's it going?
I am doing great. I am in San Diego. It's the opposite side of the world.
It most definitely is. So it's early morning here, and I believe it's becoming evening, afternoon there. So look, Howard, thank you so much for giving up your time today to speak with me, and just share your insights and experiences with everyone who's listening. I've really been looking forward to this. It's going to be a great discussion. So again, thank you very much.
No problem.
I'm thinking we'll break this discussion up into a few parts. So we'll talk about some trading specifics. That'll probably lead us into some discussion about trend and momentum. Also keen to speak with you about technology, innovation, and some of the angel investing work that you do. So before we get into all of that though, I'm keen to hear about your background and where it all started for you. So once you graduated from high school, what was the next step from there? Maybe take us through to the point of just before you launched your hedge fund.
Oh, after high school, I worked in the. I went to college in London, Ontario. Nothing fancy. And then when I graduated, '87, I didn't have a job. Didn't know what I wanted to do. Go to school much younger in Toronto, a year younger. And I went to work in the stock market at a brokerage firm in Toronto. Right before the peak, I was working in the back office. Order tickets would come in on a machine, like a little air terminal. The ticket would come in, you type it in the machine, it would go down to the floor, you'd get a confirmation. That's how archaic it was back in '87, which I'm sure seemed unbelievably like great progress compared to 20 years earlier. Now, basically, you can click a button on Robinhood, which is now even in Australia, and trade for free right from your mobile phone. But back then, it was, a process. I worked in the wire room, knew not much about the stock market. I was probably 21. And in October '87, the market crashed, and I just never forget where you were, especially since I was in the industry. And, people banging on the door, orders piling up. I was the guy people were screaming through the window. I was the guy trying to type orders in frantically, and I didn't even know what was really happening at the time, other than I could tell it was something major. And the firm that I worked at shut down. They had a huge position in gold, as most Canadians, like Australia, is a mining based and a manufacturing base in countries. And there was a heavy duty recession. The brokerage industry, was buried in margin and no business for months after, and the gold stocks were hammered. So that was my introduction to stock markets.
Okay, and was that always your goal from right back in high school to once you got out to go into the stock market, or was it just you just kind of wound up there by a bit of luck?
I just wanted a job. My dad was a trader, an investor, but I didn't have an interest in it. So I was just looking for a job. I went back to school after the market crash in '87. There were no jobs, and moved to Arizona. Went to school at ASU. Became a desert kind of rat. Graduated, and as luck would have it, or fate, I ended up, because I was a Canadian citizen looking for a job, I ended up having to take an ad in the paper and just became a stockbroker. It was the only company that was willing to sponsor me to stay in the United States was to be a stockbroker. And so I became a stockbroker knowing nothing about the stock market still.
Okay, and is that the point where your interest was peaked and you developed the fascination for trading, or did that still come a little bit later?
Oh, much later. So, back then you couldn't think. You were just had to learn the market, pass your exam. It was 91 after the Gulf War. Stocks were savaged. I didn't even know any of this. So it was a great time to be getting into the stock market. And it was the end of the S&L crisis in Arizona. It was all kinds of savings and banks. The banks were destroyed, much like 2008, and because of the savings and loan crisis. And so it just turned out to be a great point. I didn't know what I was doing. I was just trying to sell what the firm had. It was a pretty good firm. We weren't selling penny stocks or anything. I mean, I had my list of stuff I would call cold call. It was back then you would do cold calls. And so slowly that's what, how I started to learn the market. I had no mentors other than from a sales perspective. I was taught how to sell. So I tried to keep it simple, but, over time I just became fascinated with stocks and prices. And, it took me probably maybe 87, 91. It was 24 years later, I've learned a thing or two.
Okay, sure. No, that's awesome. So between being a stockbroker and launching your hedge fund, what went on in that period? How did you make that transition?
You start meeting people, get a little older. I was fascinated with the market slowly over time. People had started to trust me, and it was a bull market, so everybody thinks they can do it in the mid-'90s to the late '90s. So I think a combination of all those factors, plus knowing a lot of successful people, I decided to strike out on my own and start a hedge fund, knowing nothing about it. And in '98, when you started a hedge fund, you were like theoretically at the top of the market. Flash forward 17 years, hedge funds are more popular than ever, even though they've been supposed to have been dead for the last 20 years. So, the lesson there being it's never too late to start a business, no matter what the category is. You gotta love what you're doing and be able to ride the ups and downs, and so the same thing applies to every aspect of, working or entrepreneurship. Or what I talk to my kids about is like, I remember starting that hedge fund and people going, nah, who doesn't have a hedge fund? And this was in '98, during the Kramer, Street.com, passionate era of blogging and writing, or the Street.com at least was blogging, and Jim Cramer was like, oh, of course you're starting a hedge fund, who wouldn't? And, I've been running that hedge fund for 17 years now, and it turned it into a big business, a small business, because I'm too busy, and my passion has been more about private company investing, not so much trading other people's money. So my main passion is investing my own money and investing in startups. But that's how it's evolved. But I still have that hedge fund 17 years later.
Absolutely, and I'm really keen to get into those two things you just mentioned there. Just while we're on the hedge fund topic, did you have any experience actually trading your own money before you went into launching the hedge fund?
Yeah. My parents divorced. My mom had no idea. She had a little bit of money. I was 19, so I was stuck. That was my original. I think I've written something about this way back, but the thesis being, your original exposure to risk and management, really shapes your risk profile later on. So when I had to take over my mom's account, I couldn't risk losing $1. And it's kind of the same unfortunate or fortunate way that I look at the same unfortunate way or fortunate way I say I look at how I deal with other people's money today is that where I struggled in the stock market was I couldn't afford to lose money. So it's not a great place to be if you can't take risk. And so my strategy has always been a little bit more conservative. Over time, I've developed a much more aggressive strategy around momentum, and things in motion tend to stay in motion, but definitely not good for my mom, or it's definitely good for my money because I feel comfortable with it, but I don't like managing that strategy for other people's money, which is why my hedge fund doesn't take new money and why I focused on private companies, because I'm all about a momentum if my investors understand that they could lose all their money. And that's the way when you invest in an angel fund, which we've started through Social Leverage, my investors expect me to take big risk on big trends, and bad things could happen. So it's in managing the expectations of my clients and my own lifestyle and risk profile. That's how over 17 years you end up with evolving your thesis and your product so that my risk profile fits the risk profile of my investors.
Absolutely. Okay. No, that's really well said. Now, this is a question I usually ask to guests on the show, and I usually ask them what were some of their biggest challenges as a developing trader. But in your case, let's open this up. So what were some of your greatest challenges or failures in your early years as a trader / entrepreneur / investor?
Well, I think, like I said, the structure of my life around risk, because I had some of my mom's money that she couldn't afford to lose. I knew it had to last. She's still alive today, so that's 30 years later. I was 19, 29, 39, 40. I'm 49, so 30 years later of managing her small nest egg, I've had to, knowing that I'd have to support whatever difference there was, assuming she lived till 100. So I've always been, that's where my risk profile was structured, for good or bad. Mistake-wise, in starting a hedge fund, I've made so many. I mean, obviously starting it in June 98, the Asia crisis happened right after, the 2000 crash in 2008. So plenty of mistakes. Most of my mistakes more have been about people than about stocks. I'm pretty good at taking losses. I've learned to not listen to the TV, and I read people that think like me, not because I want to form fit my ideas, but just strategically wise, I try and just focus on my strategy so I don't bring in outside noise. So all those mistakes that people continue to make about trying to just have too many styles or survive in every single market. I'm not survive so much, but thrive in every single tick of the market. Once I settled on my style and communicated well with my limited partners and my clients, and they understood what I was doing, they never had to bug me, and I never had to worry about what they were thinking because they knew what I was doing. I think most investors just try to make money all the time, it seems like, and it's hard not to, because the market is just right there for us every day, all day. And I think the great investors will tell you, it's a lifelong process, but the great investors will tell you that they just don't trade that much. Most of the time you're just sitting. So, that's by sitting has allowed my life to expand and my portfolio to expand, because by sitting you have a lot more time to look at more things and really kind of the good pitches you're just more aware of instead of just hacking away every day at the market.
Okay, so let's dig into your strategy then. How would you best describe your approach to trading? From what I understand, you're both into trend following as well as momentum trading. So would you like to elaborate on your actual methodology for trading?
Yeah, nothing fancy. I mean, the basic example is buy high, sell higher. An IBD philosophy, or Bill O'Neill, is that stocks in motion tend to stay in motion. And I'm small enough that I've just kind of evolved my strategy to think like a pilot fish. Sharks are out there moving the waters, and I'm just riding there with them as long as I can, and have pretty good sell discipline. I would say every time I make a mistake, it's generally around selling, not buying. And in the private market, it's a little different. because you're not liquid. So in the public markets, I like to swim in the most liquid markets because you can change your mind very quickly. There's liquidity, and then in the private markets where things are illiquid, it's still very much a momentum-based strategy around trends and applying them to private industries, but a little more sensitive, obviously, to price early on because they are illiquid.
Absolutely. So just talking about the public markets still, what are some guidelines or perhaps common characteristics to discovering the big market-winning trends before they actually happen?
Well, they tend to happen in consumer stocks, whether it's restaurants, fashion, or consumer brands like Apple. They generally are they're brands that you're already using. One of the best stocks of all times is Philip Morris. So I would say it's still a consumer brand. It's a SIN stock as well. And 99% of us have never owned it unless it's been in an ETF of ours for as good a stock as it's been. So, they're generally brands that you've heard of, shockingly, whether it's Nike, Under Armour, Apple, Google. I consider all these consumer stocks, not technology stocks, because we use their products every day. Chipotle's, and these are right in front of us most of the time. And then generally they stay overvalued for extremely, 5 to 10 year periods, some of them longer. But generally, I can hold stocks 3 to 5 years. That makes my job easier. It doesn't always happen that way, but I'm looking for things that just are part of bigger consumer trends.
Okay, and you mentioned a little bit earlier that you like to buy high and sell higher. So you're looking at stocks that are breaking into all-time highs, and I've just got 2 questions around that. What is it you like about stocks that break into all-time highs? Like, why is that a good thing? And do you also pay attention to perhaps shorting opportunities that occur from stocks breaking down into all-time lows?
Yeah, I would think that, definitely on all-time lows, there's a strategy that works. But mathematically, over all the money that I've ever wasted learning and spending on shorting stocks and looking at the Fortune 500 list, I don't know anybody who really is, if I were to look at Buffett and some of the best investors, they don't short stocks. They ignore them and they use cash. And so no, shorting is just like, I'll talk about it occasionally. I have this feeling about the market, but I'm never right because the math is stacked against you generally. And so no, shorting is generally out. And then all-time highs is just something that works for me. It's counterintuitive. Most people ignore this, even though there's so much data available on how the strategy works. Nobody cares. God forbid you tell somebody momentum, their heart seizes and their ears close and they think it's voodoo. And I like knowing that. I mean, if everybody did it, it wouldn't be as easy. And investing is hard. Buying high, selling higher means that you are buying stocks that are obviously discovered because people own them. But at the same time, they also are highly shorted because the professionals, love to hedge and love to bet against companies to get paid their 2 and 20. And, historically, stocks that are at all-time highs got there for a reason. They were on an all-time high list the day before, a week before, a month before. So great companies growing really fast with catalysts tend to make hundreds of all-time highs. And so it just makes common sense to me as a small investor to follow those type of trends. It's not for everybody, right? Like, it's not for everybody. It's just, I like to keep things really simple. And if I buy a stock at an all-time high, it means there's no resistance. Everybody who owns the stock is profitable. Everybody who's short the stock is freaking out, and that's potential buyers. And it's, and then when I can combine it with a catalyst like, oh my God, this is a product that's being underrated or undervalued, or really simple stuff like, oh my God, this company, when it was Apple, it was like, fuck, there were 60 stores. I'm like, I could see 60 stores just in China. And this is like 8 years ago. So, buying it when it was 60 stores just in the United States seemed like just a simple, good idea. And the stock was, had been at all-time highs for 3-4 years already by 2006. So, in hindsight, it doesn't look that crazy. Same with Chipotle's when they went public. What were they, a couple hundred stores? And yes, McDonald's was selling their shares, but in the end, that it was just early in the growth process. And Wall Street likes growth. Like in the end, try not to overthink it. Wall Street still pays up for growth, historically and always.
Okay, so once a stock's broken through to all-time highs, there's no previous highs that might act as resistance. What are perhaps some warning signs or red flags that you watch for, which may indicate that a trend is nearing an end?
Yeah, it's a good question. A lot of it is just feel. A lot of it is trial and error. A lot of it is your own risk preference. I can sell on the way up. I generally sell on the way up. So, I leave tons of money on the table. The greatest trader is pyramid in. I'm pyramiding out. So, but again, that goes back to my risk profile. And the fear of losing money is greater than my joy of making tons of money. And that's, you got to live with what you got. And you can't, I've just lived within those means. But the signs are generally, sometimes you never get a warning. So just blindly buying all-time highs is not, a perfect strategy. And sometimes, I get the catalyst wrong and stocks implode without much warning. But most of the time, stocks give you a few warnings in price and volume. They give you warnings around an earnings. And sometimes you get one warning and the trend is over. And sometimes, it's a fake warning. But, you just have to have your money management skills. Some people, have 10% drawdown rules. Some people have 15%. I'm more, a blended... if I really believe in the trend and the market's strong, I may give a stock more room. Just depends. There's not one style fits all. And I'm very unscientific. Ivan, who trades for me and is a young guy, Ivanov, who, works for me, has his own style that he deploys on top of my style. But generally, right now I'm long a couple stocks that I don't fully have the full thesis on, but I use their products and I'm bullish on them, Chegg and Lulu. So those are two new additions that, they're not at all-time highs. They're very strong right now in a tough tape. And I understand what I think are the catalysts. I think one is, evolving into a huge learning platform, and the other, Lulu, is products that I use all the time. And so I think both are trends that, while the stocks aren't at all-time highs, I break my rules all the time for stocks in good uptrends, but aren't quite at all-time highs. And then Nike and Under Armour, I've been long for, on and off for 5-6 years, mostly on, where, the stocks have been at around all-time highs for most of the last 5 years.
Okay, sure.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, this is something I've heard you say a few times in the past, and that is there are no experts. So I'm interested to know what makes you actually say this.
Well, the market's the expert, so the market decides. You know, you can fight the market and get run over, or you can be the market like Goldman or Warren Buffett. They basically are big enough. They are the market and they make the market. But if you're not making the market, you have to respect it. And so I don't listen to anybody except the price and volume and my own instincts around catalysts, the products themselves. So, you know, Wall Street's all about, oh, this guy said this and that guy said that, and the CEO said this. And I'm more about what are the consumers doing with those products, and being more in tune at the street level with what's happening. And then if the price and volume confirms what I'm thinking, I'm like, I love that. And I don't care what anybody's saying because there are no experts because the market has decided what the price and the volume is.
Yeah, I mean, I really like that quote because, I mean, as a young trader and someone who's coming up, it can be very easy for them to be influenced.
Well, you need mentors. So, you know, if I can be a mentor to people, but you have to listen to me for hours to find two nuggets, I guess, because I'm, you know, rambling on. But, you know, I didn't have great mentors. So, you know, the young people today have great, you know, like I said, I was a stockbroker and they just threw me in a room with fill a binder full of Blockbuster and Compaq and the shit that we're selling and go sell that. It wasn't like I had time to learn the intricacies of the market. Now you can go on StockTwits and find 200 people that are expert in one specific subject. And you can get right to learning anywhere on the web much quicker, and you can trade for free. So, I mean, if I'd only known, so, you know, at StockTwits and anything that we're focused on in Robinhood, which we're investors in, we're focused on helping people, you know, onboard and learn the language of the markets much quicker. That's all we can do. That's all we can do is give people the tools to learn quicker, but not tell them we're the experts or, you know, we're not selling anything other than the magic of, oh my God, the markets are awesome. It's like learning Spanish takes a while and you're better to immerse yourself into it and you're going to make mistakes and you're going to offend people and you're going to, but you know, that's the market.
Of course. Yeah. So while you mentioned StockTwits there, I mean, I'm sure you get asked this all the time, but what actually sparked the idea for StockTwits? Did you see a genuine need for a service like this at the time?
Yeah, I don't use Bloomberg, don't read Wall Street Journal, don't watch CNBC. I was reading some blogs of venture capitalists really discovering trend following, and I was a Momentum IBD guy, so, you know, reading Investors Business Daily every day or on the weekend. And Twitter started, and I had an opportunity to invest early, and I was using Twitter, and I was like, oh my God, Twitter for stocks would be amazing. This was 2007. And I emailed Fred Wilson, who was one of the biggest investor in Twitter, a friend of mine, and said, Twitter for stocks would be incredible. Why don't they do this? And he said, why don't you start it? And so I kind of got, you know, dared into starting StockTwits, which was originally built on the Twitter platform, just, you know, figuring Twitter would just incorporate it and either acquire it or partner, and I would just help curate the financial section of it. like a financial part of Twitter, which in hindsight, that's what, I think the best part of Twitter still is. And then slowly StockTwits has built its own platform that doesn't rely on Twitter, but uses Twitter to get leads and find smart people. And StockTwits is its own self-reliant ecosystem of traders and investors. So really started out as just an idea to work on top of Twitter, but Twitter had its limitations, and we wanted to build a community just for traders, and that's how StockTwits started. So it's been almost 7 years.
For sure. And a lot of listeners, I'm sure, are active users on StockTwits. What's the advantage to these traders who use StockTwits, particularly the newer traders who are using this platform? Like, how can they get the most out of it?
Well, it's different strokes for different folks. If I could explain it, we'd only be 100 people because they would all think like me. God, it's so big that I don't even know all the different reasons people use it. But for me, I'm mainly on the mobile app these days. So all I think about is mobile because I'm on the road, and I've always wanted a product that allows me to catch up on my watch list really quickly and have the key people that I know follow that stock to be able to talk to quickly if I need something. And then on a bigger picture, who are the 8 or 10 people that Global Macro look down and can give me, end of day kind of readings in 5 minutes? How do I catch up on the market really fast from my iPhone? That was always the goal. And we're finally getting there with our latest apps. And on the website, there's a million ways to use the product. You can start by searching by tickers. You can follow me and say hello. Just to be able to access some of the greatest traders who are doing it for their own reasons, most of the time just to journal and keep themselves accountable and to their own money. I think what people misunderstand is the reason people use StockTwits, the good ones, or at least why I use it, is just to write my own ideas down so that I can be called out on it. And I don't want to tell people what to do. I just want to write down what I do. And I think that's the big difference of StockTwits, I hope, over old media, which was everything pre-Twitter, and including Twitter, unfortunately, where there's so much spam and penny stock chatter. But the idea for me is, here's what I'm doing. Tell me why I'm crazy. And you don't have to do it, but I'm just journaling what I'm doing. And then updating it.
Yeah, I like that answer, and I like how you mentioned access in there. I think that's a really valuable feature of StockTwits, is being able to access other great traders and network with others who are maybe more advanced.
It's just finding mentors, networking, saying hello, being if you're not nice, you're generally going to be angry and confrontational. You're not going to last but an hour on StockTwits. We've built a culture which is like, hey man, like you can hang out and take all my ideas and question me all you want, but don't call names and don't attack. And that's been a hard kind of culture to build, but I think we've succeeded. That may not be $1 billion idea, but it's definitely something we're proud of.
Yeah, I'm sure. It's helping a lot of people, so that's a good thing. Now let's move this discussion along a little bit to talk about some technology and innovation that you've seen coming through in this space. So, in the past, you've said there's never been a better time to start a business than there is right now. Would you say that's perhaps the same? Would you say the same applies to traders of today?
It was very one way. Like you read a research report written by some dude or some lady, and now I don't know why the only reason I read people here is because they show up every day and they're willing to be yelled at if they're wrong or laughed at. Not that you should yell or laugh at them, but like, man, were people here pouring their ideas out and are accountable, and 7 years later still doing it. So I think the difference is, the hierarchy has changed. Back then you had to have a title, you had to have this pulpit, and you had to earn your way into that. And then once you were on it, it was hard to kick you off, even if you sucked. Now it's like, fuck, if you don't have the game, you're not going to last an hour on StockTwits. And if you do have the game, you're going to be revered, but you're only as good as your last, 6 months. So if you're going to you just have to consistently share and journal and contribute. Otherwise, you're not going to make it. And that's kind of the market, right? If you really want to be around forever, you got to love doing it, and you got to love sharing, and you got to be wrong all the time. Sometimes as much as 60% of the time. Who the hell wants to do that other than baseball players? Baseball players are the only other people who are like 300. You're hitting 300, you're a fucking all-star. The other time, 70% of the time, they're walking back to the dugout with their fucking, head in their ass. Right? And they're like, still come out, like knowing that 70% of the time they're going to look like an idiot chasing a pitch or grounding out weakly to the shortstop. And that's kind of the market.
Yeah, you've definitely got to get comfortable with losing.
Yeah.
That's for sure. There's no way around that.
Yeah.
What changes do you anticipate coming to the trading landscape over the next, say, 5 to 10 years, particularly in the retail space?
Well, I think we get more of the same. It's obviously mobile. You're going to have to consume these products on mobile. So we're going to see with the beginning of like mobile trading, a pure mobile, like a Robinhood and the ensuing knockoffs and copycats and lookalikes. People are going to be able to open an account in 2 minutes. They're going to be able to follow smart people. They're going to be able to execute a trade for free. They're going to be able to follow mentors. And they're going to be able to do all this from a link on a mobile phone. That's pretty revolutionary. I don't know if we could ask for much more. But it took 20 years for us to go from 1991, which was the beginning of 2001, which was the end of the last bubble, to where we are today, which was when E-Trade and TD Ameritrade and Schwab were in their heydays and coming to the end of, the e-brokerage. And now we're finally having some innovation in mobile brokerage, which is like a whole new generation of millennials globally who either are going to inherit money or have their first job and, may not want to just dollar cost average, which has been droned into their heads for the last 10 years, and may actually want to buy the stock of Facebook or Twitter or GoPro or Shake Shack, to use U.S. stock examples. And, they don't trust E-Trade, Schwab, Goldman Sachs, Bloomberg. They don't even know about them. The last time they heard about them was Jon Stewart making fun of them. And, so they download an app on their phone and they discover investing for their first time, and they can do it with $2,000, and they can buy 10 shares of Facebook for zero commission. If it goes to 95 the next day, they made $50. They don't have to owe 30 of that in commission. And they just basically paper traded with real money and had a great experience. That's much like what Uber did to the old taxi industry. So I think we're at a renaissance point for people to do it themselves. And that's great for global markets, especially with startups at all-time highs. So it's just this massive opportunity. And so for the young people that are learning how to do this, they're just going to have a lifetime of investing ahead of them. So it's an exciting time. I sound like some kind of cheerleader, but it's so obvious. This trend is so obvious.
Yeah, there's definitely a big shift coming through. So no, that's really good to get your take on it. Now let's shift this along to the last part of this interview, and I'm keen to ask you about your angel investing and experiences you've had around that. So, at what point of your career did you begin getting into angel investing? And maybe also if you could share with us why you got into this, like what motivated you to go in this direction?
My first angel investment was a cold call that I made as a stockbroker. 92 maybe, I was just dialing for dollars. And, we would open up the newspaper in Phoenix, the Business Journal, and I would just call people that I thought were rich, that were written about, and then pitch them on opening a stock market account. And one of the guys that I called, Mark Scatterday, was a great guy, ended up investing in his company. I go down to pitch him to open a stock account thinking that he was rich and he needed money he was raising money for his company. And he talked me into investing in it. And that's how I got going on angel investing. And it just turned out to be a great investment. But it wasn't easy. It sucked up 5-6 years of my life, and we made tons and tons of money, and we had one of the great consumer products. But so, I got into angel investing by mistake. But, the passion was there. I had the education, I had the will, I had the, I love to sell and I love cool products, and that's how I got the bug. And then I just kept writing checks. I was kind of a sucker for a good pitch, and over 20 years, 92 was my first investor. 23 years of angel investing. I figured I know a little bit now.
No doubt. So what is it that actually attracts you to mostly tech investments over other industries?
I like consumer products, so I would say tech applies to everything now. So I'm more consumer focused. Consumer is just interesting to me because it could become $1 billion company. I mean, it's harder to build, but why not build something that could change the world? So I would say it's more consumer, but technology just is such a bigger factor in every company right now because of scale and costs of starting these businesses and using Amazon Web Services and having a laptop and an iPhone or a Droid. Everything's technology. And so if you don't know how to use these tools, you're just going to have a small local business. But now any small local business can be a global business. So consumer is number one. The main thing that attracts me is stuff that I'm passionate about. Like, money is a commodity, and I'm not rich enough to just throw it around. So I generally like to invest in companies that I either discover myself or that fit into my thesis around financial technology and financial web, which led me to Robinhood and my whole thesis and StockTwits. But I invest in great founders who have this insane passion around a problem that they're generally solving for themselves because they have this huge interest and something's bothering them. But then those interests generally end up having a huge audience. I've invested in a few billion-dollar companies at the beginning to know that a lot of times you just could not imagine them being, almost every time. They don't start out as billion-dollar ideas, but they're kind of unicorn founders. They throw around the word unicorn a lot, but generally it's the founder that's the unicorn. It's just someone who's willing to fight and scrap and pivot and change their product and get shat on and yelled at and been told their product sucks, but really know that they're solving a problem that then 10,000 people start using. And then once it's at 10,000 people, how do you get it to 100,000? And that's where the technology applies. And then how do you get it from 100 to 1 million? So they're all different stages. I like to find the companies that have great founders. There's a clear path, a hypothesis to get to 10,000 type customers or users, and that already have one passionate user, whether they're paying or not, or two. And that's kind of where we invest. And, as I get older, I move a little bit further up the food chain because I'm just old and not willing to do as much of the little bit of work. But hopefully that gives you a little bit of insight.
Yeah, absolutely. So just one more question around that. Now that you've invested in like 100 plus startups and companies all at various stages, I'm sure there's a few deals that you've turned down at the time and you later kick yourself for. Are you able to share an example of maybe one or two deals that you've let go, which you maybe wish you hadn't of?
Yeah, different reasons. So Zynga I passed on. I knew Mark Pincus. I really had agreed to invest in the deal. We were having a argument over another company that we had invested in, and Buddy Media, which turned out to be like a huge company. But I had brought Mark into that deal, and he didn't like the way it was going and was complaining and came up with his idea for Zynga, and I agreed to invest. We had agreed on a price, and that price quickly changed to a number that I wasn't willing to invest in a few months later. And so I just on principle didn't invest, and I should have invested. I think $100,000 would be worth $10 million. And so that's a bad one. The lesson there is even if the founder wants to be a billionaire and you have a chance to invest with them and they're willing to do what it takes to be a billionaire, you're pretty silly not to invest in them. And I think that's why people just continue to give Warren Buffett money at a premium, is the guy is just like, until he drops, he's going to try and beat the market. Second is Twitter. I mean, I loved the product. I thought the price was overvalued. That was dumb. At 20 million, I think. I thought, what? You're crazy. $20 million? How could I possibly make money? Whoops. That would be a big one. Probably the biggest mistake because I liked the product. And then one that I just didn't put enough work into was Hotels Tonight. I just didn't know the travel business, and I got pitched that very early, probably like a $2 million valuation. It's kind of like Uber for hotels, or it's like a very last minute hotel booking site using mobile. And I think it's my favorite product. I travel a lot. I don't have to book a hotel. I can just show up and land, and it's location based. Anyway, so I use that app, and every time I use the app, I'm like, should have invested. So that one hurts the most because I love the app, and it's going to be around until it gets acquired for a big number. Zynga never was like a fan of the product, so that's just money. And Twitter is just a complete mistake, but I can live with it because I have a lot of shares that I got from investing around the space and StockTwits, and ended up with shares in Twitter because I invested in TweetDeck. So Twitter I got right for enough that it doesn't hurt as much. But I would say Zynga just because of the stupidity of price and just being stubborn. And then Hotels Tonight just because I just didn't see it, but I was offered it.
Yeah, I mean, that's, some hard lessons in there. And I mean, it's really interesting to hear you talk about that. Thank you for sharing those. Now, Howard, this has been really, really good. I've just got one more question, and then we'll call it a wrap. And this question I like to ask to majority of the guests, and it kind of circles back to trading now, but why do you believe the majority of traders never reach a high level of success?
Well, I think they just don't have the mentorship, and they just give up. It's a long process. I just think they have a really bad experience, and it's not for everybody. Investing is a privilege, not a right. So maybe it's good that happens. But I think most people give up because they can't find a mentor, or the barriers. What the media drums on people is, you can't beat the market. And I agree, it's not easy to beat the market, and I don't even think beating the market should be in the vocabulary. It should be about destroying. If you're going to do this, why would I do it to earn 12% a year when the S&P is 9% a year? I do it because I want to have 80% years. 100% years or more. And therefore, if that was easy, so most people just give up because they have the wrong expectations and they started for the wrong reasons. So that's the main reason people give up. I can't help those people, but if you have the right expectations when you're starting, I would say that's the greatest hindrances. People just have the wrong framework for getting started. And both are we solve all those, right? Podcasts, I'm telling people the truth from my own experiences. This wasn't as easily accessible in 1990 when I started. And now there's no excuse not to dig into a few podcasts or try a few financial sites and see if you can find a mentor. And then expectation-wise, the same thing. It's I would say to anybody starting, what is your expectation? Well, I want to, I just want to earn more than cash. Well, you should dollar cost average. That's not, that person should be dollar cost averaging and do, low cost ETFs. But if a person says, I think I can make 80% a year, well, then I say, well, listen, expect to have years where you're down 40%. But if you're willing to ride that out, then you should dig in and start learning and finding a strategy that fits that risk profile.
Totally. All right, Howard. Well, where can listeners go to connect with you and just generally find out more about you?
Easy to find me all day on StockTwits. And, I have a blog that I've written for 7-8 years, or maybe more now, 9 years. HowardLindzon.com, LINDZON.com.
Okay. And what's your StockTwits handle?
It's just my name, Howard Lindzon.
Okay. And you go by that on Twitter as well also, right?
Yeah, it's just easy to say hello.
Awesome. All right. Well, I'll make sure to put all these links in the show notes, and they'll be at this will be episode 35. So it'll be chatwithtraders.com/35, and you can find links and a recap on the show with notes, quotes, and all that sort of thing that we've discussed during this discussion. So, Howard, thank you so much for doing this. I really appreciate you taking the time out of your day and sharing, being so open with us and your answers. It's been phenomenal.
Okay, cool. Congrats on doing 35 shows. It's not easy.
Thank you very much. All right, Howard, we'll take care and we'll talk soon.
Okay, cheers.
Hey guys, it's just me again. Thanks a lot for listening to this episode. I hope you really enjoyed it, and I can tell you for certain that it was a great opportunity to speak with Howard. So thanks again for listening to this discussion. I hope there was a few points that you're going to take away from this. So just a very friendly reminder, if you could, please go to chatwithtraders.com/iTunes and leave a very brief review. Like I mentioned at the beginning, it doesn't have to be anything major. Just a single sentence would be a massive help. And in case you're wondering why I like to ask for reviews, it's because essentially the more reviews that Chat with Traders receives in iTunes, the better the show ranks. And of course, the more listeners that, the more ears we can attract to the show. So if you could, go to chatwithtraders.com/iTunes and leave a very brief review. And for what it's worth, I'd like to thank each and every person who leaves a review. So once you've left a review, shoot me an email and I'll respond with a great big thank you, because I really do appreciate it. And my email address is just aaron@chatwithtraders.com. All right, guys, have an awesome week and let's talk very soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without...
Then join more of what you earn SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However...
What's up, guys? Thanks for tuning in to yet another episode of the Chat with Traders podcast. You're listening in to episode number 36, and I can promise you right now, this one will not disappoint. My guest today is the legendary trader, Peter Brandt. Peter first started trading around 1975, which I'm sure is before many of you listening were even born. I mean, that's certainly the case for me. So that's almost 5 decades involved with markets, a very long time. To give you an idea of Peter's performance during this time, he has achieved a compounding annual growth rate of approximately 42%, with his best year returning well over 600%. Of course, we want to know about his worst years also, where there has only been 3 losing years, which were all drawdowns of less than 8%. During this interview, we discussed Peter's early years working at the Chicago Board of Trade and classical charting patterns, which form the roots of his trading methodology. We also get into Peter's views on high-frequency trading operations, why he has the default assumption that every trade will be a losing bet, and some of the common misconceptions about super traders. So you guys are really going to enjoy this one, but before we jump into it, I'd like to tell you about a brand new premium ebook which I've only just released. It's titled Why Most Traders Never Succeed. The reason I decided to create this was because, as we're well aware, most traders consistently lose money and will eventually crash and burn. Some say this accounts for 90% of traders, but I wouldn't be surprised if the real number is even higher, which is just frightening. I understand the title of this ebook is not overly glamorous, however, that wasn't my intention. Instead, my intention was to create a guide that breaks down why most traders fail so that you're aware of the most common reasons for this. Once you're completely aware of these reasons, then you can better align yourself for success and decrease your chances of becoming another washed up trader. The content within this guide is the curated and polished answers from 18 of the high-performing traders who have featured on this podcast. Also included are additional summaries to add context and to help you understand. In total, this ebook is more than 8,500 words long, and it's just over 40 pages. This guide is $15 and it's available right now at chatwithtraders.com/read. That's READ. Even though this ebook is most likely cheaper than a round trip of trading commissions, I'm offering a full refund if for whatever reason you don't find the content to be valuable. So I'm pretty confident you'll benefit from reading this. So you can purchase this ebook and learn more about it at chatwithtraders.com/read. That's READ. You can also look at a few sample pages by following this link too. All right, guys, let's get into it. I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Peter Brandt. Hey, Peter, welcome to the podcast. How's it going?
It's going well. Thank you very much for asking. It's morning where you are, and getting to be about dinner time where I am. But it's good to be on this program with you. I've listened to a number of your casts, and I've enjoyed them.
Well, thank you very much, Peter. It's great to be speaking with you. We've been trying to set this up for a little while now, but we're doing it. It's happening. So thank you very much for doing this. It's an honor to be speaking with you. Now, we've got plenty to get through in this short amount of time today. So obviously we'll cover your early years as a developing trader. And then we'll get into how you trade and specifically some discussion around chart patterns, which I think will be really interesting. You've got a lot of insight around this topic. So let's kick this off though and take us back to where it all started for you. I understand you first got involved with the markets around about 1975. So tell us how this happened, and also what were you doing prior to this?
Aaron, I at the University of Minnesota, and where I was a journalism advertising major, and then right out of college, I was married and had kids, and I was a real young guy, and we moved to Chicago, where I worked for what at the time was one of the 5 or 6 largest advertising agencies in the world in Chicago, and that was a great opportunity. And so I'm in my mid-20s, and a father of one of my son's friends, I met him, and he was a member of the Chicago Board of Trade. I worked downtown, and of course the Chicago Board of Trade was downtown on the river, other side of the downtown. But he invited me to go have lunch with him someday and see what he did for a living. So I went over to the Board of Trade. We had lunch in the members' dining room overlooking the pits, and of course that's back in the days when pit trading was really almost at its peak, and it was just fascinating to me. I was captivated by it. And so I ended up inviting myself for lunch, probably more than he wanted to entertain me, but just was captivated by all of these guys yelling and screaming. I think what interested me the most was the fact that here you had people that didn't sit in meetings all day, were responsible for what they were doing and could determine at the end of the day to the penny how their day was. You talk about direct in a feedback loop, and they were on their own. They're kind of, many of them doing their own thing, and I just found that extremely compelling. And it was my interest at that point to find a way to get in the business. And that was back in the infancy, really, of futures. I mean, the modern era of futures trading really back only to about 1970, 71, 72. Prior to that, prices of just about everything had been flat for years. And then we saw some crop failures in the U.S., the Russian grain buying, and we saw price explosions pretty much across the board in 72, 73. So I wasn't really too far past that date. And there was no MBA fast track back then. There probably isn't even today in this business, but everybody started at the bottom, and I just really went around pretty much from door to door at the Board of Trade trying to find a way to get in. I finally found a company, it was Continental Grain Company, which at the time was the second largest grain merchandiser in the world next to Cargill. And Continental offered me a position, which basically meant I could sit on the edge of the pit, and I had to go find some people to do business. So, literally, they gave me a guaranteed salary for about 6 months, and then it was on my own. And so I kind of went that route. I had some very large institutional business that I generated right away. I'm just past 25 years old, and I knew back then that that's really not what I want. I wanted to learn how to trade. I wanted to trade for my own account, and it was just for me a question of how to do that. And but in the meanwhile, I had to kind of learn the business and make a living for myself, which I was able to do. And it took me about 4 or 5 years, I think, to really become accustomed to the market, to figure out how I wanted to trade, really to develop the capital that I needed to trade. And then in 1980, I went off on my own, left Continental, and started a factor trading company as a proprietary trading firm at the Board of Trade. And I guess, as they say, kind of this history.
Absolutely. No, that's really good, Peter. So I want to just zoom in on something you said there, and that's you weren't really a trader while you were working at Continental Grains. So at what point did you feel confident to transition from being an employee there to trading out on your own? Like, where'd you get the experience to trade before you made that jump?
Well, I think in a couple different areas, Aaron. I mean, when you're back in the days of the exchanges, you were in a building with hundreds of other traders, many of them trading for their own account, and found traders pretty willing to share with other people what they do. I mean, some are very private and don't really have much to say, but an awful lot of the good traders out there are willing to at least answer the specific questions you answer them. And I developed some friendships with some very, very proficient traders. And I started no prohibition against me trading my own account, so I'd accumulate a few $1,000s and try to trade it and blow it up. And I don't know how many small accounts I blew up before I finally kind of caught the scent for the approach to markets, which made sense to me, that kind of fit who I was. So would raise $5,000, $6,000, $7,000, fund an account and lose it and do it all over again and have a little more success and do it all over again and have a little bit more success yet. And so I think for me, it was just a question of I had to make enough mistakes, crashed and burned enough times so that I started at least catching on to some themes that contributed to an eventual success as a trader.
Okay, sure. So you mentioned there that you were speaking to people and you'd made some friends with actual traders, guys who were in the pit and, in the trenches trading. Was there anyone who sort of provided maybe further assistance and had more influence on your trading? Maybe like a mentor or someone who provided you with some mentorship during that time, or was a lot of it just things you picked up from speaking to different people?
No, I was really lucky, Aaron. I had a trader, a guy who was Cargill, who befriended me. Actually, he borrowed my wife and I the money that we used to purchase our first house, put a down payment on our first house. He was a single guy. He'd spend holidays with us. We became very, very dear friends. He's since deceased, but he was as good a trader, I think, as I've known in my lifetime. And he shared an awful lot with me, not necessarily about technique so much as about philosophy, really philosophy of risk management is what he drilled into me. He taught kind of just the practical aspects of surviving until you were successful. And because that's an awful lot of what I think so many novice traders today try to shortcut the process, and in doing so, they may not ever really build the foundation need to build on, at a future date. And so he was very instrumental, I think, in encouraging me, but he was also just so influential in drilling home to me the importance of risk management, the importance of keeping your capital together, the importance of taking losses quickly.
Okay, and just before we move on that, I've got to ask, because I know that many of the traders who are listening to this podcast are searching for someone like that, someone who is going to guide them with their trading and can be there to answer questions and be a mentor. How did you meet this person? Was it from your connections of working on the Chicago Board of Trade, or did you meet this person in a different way?
No, it was when I was working for Continental, I had gone out, and this was in the age when an awful lot of users of rails were still early in the process of learning how to hedge, and I focused on bringing into Continental some customers that were users, producers of food, and one of those was Campbell Soup Company, another one McDonald's, and in the process we kind of crossed paths because they were the oil seeds, and so we became familiar with each other really down by just seeing each other in the elevator, knowing each other were on the floor from time to time. Striking up a conversation, found that we had some other things in common, and kind of a friendship developed, and then a mentorship developed. And I think that those of us who started on exchanges had a real big advantage to so many traders today that start off behind their closed door in their house or in a small office and staring at computer screens all day, in that we were part of community. Trading can be a very, very lonely, especially it is today with the electronic exchanges and people setting up laptops in an office at home and throwing a couple screens on the wall, interact with other traders. Whereas those of us who spent some time at exchanges, whether they be CME or Board of Trade, New York COMEX, whatever, really fellowship in community and sharing in ways that I think were to our advantage.
Absolutely. No, you're totally right there, Peter. During those first few years, which we've kind of briefly talked about, you mentioned that you blew up multiple accounts. What actually led to you blowing up these multiple accounts, and what were some of the greatest challenges that you had to overcome during these first few years?
I think you just have to make mistakes. I think you learn to make mistake after mistake after mistake, trying to figure things out. Learning to trade is really an exercise in problem solving more than anything else. I wasn't sure how I was going to trade. I knew I wanted to trade. That was an assumption. I had certain assumptions going in as to what it would take for me to someday be a trader. A lot of those assumptions ended up being wrong, but I did have those assumptions. And but I wasn't sure how I was trading. So, I was looking to other guys that I knew were successful at the Board of Trade at the time. So it might be somebody who traded the markets based on supply and demand, and I'd listen to them and I'd try to trade the way that they traded. Somebody that kept point and figure charts, or somebody that traded spreads, or somebody that traded cycles, or somebody that traded what's called analog year principles. And, I think one of those big mistakes that I made was that I could kind of hook my wagon onto somebody else and learn how to trade as they traded. I think it always takes a few years to kind of unlink yourself from that idea and theme, and to figure out that if you're going to trade, you're going to have to do it on your own. You're going to have to make your own mistakes. You're going to have to kind of pick up a scent as to what makes sense to you, what works for you, what doesn't work for you, what time frames work for you, what methodologies work for you, what money management protocols work for you. And so I think it's a process of working through that. And in doing that, there were some approaches to trading that I tried that just frankly did not make money, that I lost money. But in the process of doing that, I would learn a little bit here and a little bit there. But more importantly, I would learn those approaches to the market that just were not me. So you can discard those and you learn a little bit and you go on. Learning to trade is kind of like going to a university, except you don't get to determine your own tuition. The market kind of gets to decide what tuition you're going to. But it is a process, and I think it's a process that takes most people I know who have become good traders somewhere between 3 and 5 and 7 years to get to where they really feel confident in what they're doing enough to kind of go all in and take a leap of faith and say, this is the way I'm going to trade, and this is what I'm committed to. And it takes a lot of mistakes to get to that point. And it's not something I don't think beginner traders can do quickly. I think those that do and come to a conclusion that they really know what they're doing too quickly will end up paying the ultimate price.
That's a really good answer, Peter. I like how you spilt that out for us. During that time, that process of you learning and you blowing up accounts and going from different approach to different approach, was there ever any moments when you came close to maybe throwing in the towel? You were just like, this is too hard, it's not working, and giving up on the idea of becoming a trader? Or what was it that kept you going?
I think what kept me going is that I had an income stream coming to me by doing business with large commercial customers. And so it wasn't like I rented a seat on the board and walked into the pit and put my life at risk and I had to make it. I did have income, and the income I had from some of these consulting clients was fairly good income for time in history that it was. And so I had, I think, a huge advantage in that I didn't need to be successful right away. I had time to learn it properly. Of course, I'd sock money away and lose it, but nevertheless, I had my eventually when I bought a home, I had my mortgage payment paid. I didn't have to dip into my trading account to pay for car payments or insurance. I can't imagine what that would be like for a new trader to feel the pressure of having to make money to pay for their expenses. That would be a shuddering thought to me. And I know there are a lot of young traders who are doing that, and they feel necessity to trade because that is their source of income. I think that's a very bad place to start off from. So I didn't have that pressure. Bought me time. It could have bought me more time. And so I didn't, during that process, feel like, this was the end of the game and throw in the towel and that's it, because I did have some income flow. I think there were periods once when I started off, and it really was, I was dependent upon my own trading activity, although I had money in the bank to pay bills. But there were times then when I felt a little bit more pressure. Some times then where I think it could have gone the other direction. To a certain degree, I look back at some of the trades I made early on, and it scares me to think about the risk I took, because those are trades that might pay, and I might not be talking to you today. And so I think to a certain degree, Providence entered in.
So what would you maybe say to any new trader out there who's perhaps thrown themselves in the deep end and maybe currently relying on trading as their only source of income while they're still learning? What would you maybe say to them might be a more effective way to learn how to trade?
Well, I think they need to go back and get a job, frankly. I mean, it scares me when I hear from some people saying, I'm going to quit a job that's paying X amount of dollars a year, and I've got $100,000 saved up, and I'm going to trade, and I'm going to be successful from the get-go, and learn a little bit as I go, and I think that's a recipe for disaster. I really believe that if somebody, trading can be a wonderful, wonderful hobby for a person who's a lawyer or an accountant or a policeman or whatever the case can be. If they can learn how to trade, they don't have to trade full time. Trading can be a very rewarding thing for them to do on the side. They can become, of course, they can't be day traders, but they can be position traders, which I recommend people be anyway. But they never have to really say, well, this is going to be my career. But for those who feel that is their calling, to be full-time, to become journeymen in the craft, I think they need to have at least 1 year and perhaps 2 years worth of savings in the bank to pay their expenses, their living expenses. And I believe that the capital that they use to trade with should not be capital they inherited or saved up doing up. I think it should be capital that they earned in the markets. Until they've made enough in the markets to support a trading account that is large enough to potentially their source of future revenue, I don't think they should trade. And so I think you trade after you show that you're successful trading, and after you show enough trading that you've accumulated what you need to trade. Then if you want to become a full-time trader and quit a job, you do so with fear. But so that's my view on that, Aaron.
Sure. Okay. No, thank you very much for sharing that. Now, let's fast forward just a few years, and I think it was around the mid-'80s. You had a kind of frightening near-death experience. Would you be able to perhaps share this with us? And also, did this maybe change your outlook or perspective on life and trading in any way, shape, or form?
Well, yeah. I mean, it was August 26th. I'm right now coming up on an anniversary date, but it was I had always been a sleepwalker as a child, even as a young child, 4, 5, 6 years old, in a neighbor's garage or outside the home or in the basement, whatever the case may be. I had always been very active in my sleep, and at date 1984. I got up out of bed and at 2:30 in the morning fell 17 feet to a concrete slab and did my spine. I was in the hospital for 41 days. I was in a full body cast for 5.5 months, and then in another kind of Velcro halo type device for another 4 or 5 months. But I did a number on my spine, and that, of course, is a gift that keeps on giving. But I don't know if it changed my view of trading so much as it took me out of action for a bit. I think it probably changed my view on life a little bit, but not necessarily on trading.
Okay. So in what ways did it maybe adjust your view on life?
Well, I think that recognize there's more to life than turning on your quote machine and keeping charts up and trading. That you've got your store of value that how do you measure yourself? How do you represent yourself? Do you find your worth based on what your account did this month, or do you find your worth in other areas? Markets are all compelling. They're addictive. It's easy for somebody with an obsessive personality to become all involved in the process of market speculation and forget about the fact that there are other things in life that have value, and that we really need to measure our self-worth and who we are.
Sure, absolutely.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and visit tastytrade.com/chat for more info. Small to matter. Good news, with Trade the Pool's limited risk platform, with 0 locate or hard to borrow fees. Start your evaluation, get educational resources, practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Style and your methodology for reading markets. Maybe the nuts and bolts of how you trade these days and how you've traded for the X number of years.
Link in the show notes to start trading with Trade the Pool's capital.
Now, Peter, let's move this discussion along a little bit and get into maybe the nuts and bolts of how you trade these days and how you've traded for the X number of years. So how would you describe your trading style and your methodology for reading markets?
I had in the 70s tried this and tried that, and there was another friend of mine. It wasn't my friend from Cargill. It was another person I had met at the Board of Trade. Told me that he was a classical chartist, to which I said, what's that? And he said, well, come with me, and I'm gonna go buy a. We went across the street on Jackson Boulevard to a little bookstore that was in the block next to the Board of Trade, and he bought me the McGee and Edwards book, and I'm sure most are familiar with that, which I just consumed. I mean, I read it literally in a weekend. It just all of a sudden made sense to me. I could relate to it. I could see myself trying to trade that way, and of course. Edwards and McGee make mention early in their book that a lot of what they were talking about was based on the original works of Richard W. Schabacker. So I immediately tried to find Schabacker's manuscript. Back then, it wasn't published. You couldn't buy a book. It was a course, and I ended up buying a photocopy company in Los Angeles that had kind of these old manuscripts, and it was really Schabacker that really, in a more pure sense, turned me on to classical charting principles. And so I think that at that point, I became convinced that I would be a classical chartist. It just made sense to me. Now, there were still a lot of things that needed to be out. What do you trade? What's your time frames? What patterns do you look for? How do you draw patterns? I mean, you show a chart to 10 chartists, you'll probably get 15 different views of what the chart has to say to you. So, it's not an art, it's not a science. I think it's a craft. And like any other craft, you kind of move from apprenticeship to journeymanship. And in the process, you have to kind of figure out, you're a chartist, but what does that mean? How does that play itself out on a day-to-day basis? And I think that's a process. I look at my trading over the years, and I'm aware of the fact that I've tweaked a number of things and continue to do so. But it was interesting. I gave a speech, a plenary address to the Market Technicians Association 89. And here a year ago or so, one of the MTA members sent me a copy of the speech that I had given in 89. I didn't have a copy. I know all about it. And I read through my speech, and it was almost spooky because there really hadn't been a whole lot of changes that I had made to my trading since then. There, money management, a lot of nuances, but for the most part, I've stayed true to the classical charting principles. I think I've become longer term. I used to trade more daily charts, where now I tend to trade more off of weekly charts. I use daily charts for timing. But for me, I look for classical patterns. In particular, I look for patterns that have a horizontal boundary. I do not like diagonal boundaries. I hate trend lines. When I see a chart a slanted line, it freaks me out. I think that's a low probability payout. I want to look for a chart that's got a recognizable chart pattern with defined horizontal boundaries, such as a descending triangle or a rectangle or head and shoulders pattern. I mean, those are probably three of the patterns that I trade more often than any. I look for patterns that develop over the course of at least 8 weeks. I have no interest in day trading. I want to see patterns that I can recognize on weekly charts, and I found that usually a pattern of 8, 10, 12 weeks on a daily chart will convert on a weekly pattern that you can see. But I'll trade, patterns that go on up to several years in duration. Sometimes these real duration patterns are difficult to trade because the breakouts aren't as precisely identified. You're a little bit more sloppy in how a boundary drawn. But I certainly am interested when I see a pattern that can be in a considerable period of time in duration. I like those patterns, and then I try to find something on the daily chart which gives me a trigger point. Because when you play chart patterns, sometimes you can't be precise as to where exactly that line comes into play, and so that's where charts become important, is trying to find something on the daily chart that gives me a breakout. I'm a momentum trader. I trade breakouts. It's how I trade. I've never really become very good at selling rallies or buying breaks. It's a skill set I wish I had. I don't have it. I know some traders do have it, and that's their preference, and I think that's wonderful. It's just not my deal. My wheelhouse is big patterns and breakouts of big patterns and big. I trade futures and I trade Forex. I trade very few stocks. I do look at stocks. I look at stock indexes globally, but for the most part, I'm in 90% a futures Forex trader. Of that, probably half and half. I like the Forex markets, and of course I from origin am a futures trader. And so that's kind of my stick.
Okay, that's really interesting, Peter. Thanks for sharing that with us. Now, you mentioned in there, like, price going through a level of horizontal resistance, or support as a breakout. Have you noticed over the years that these have become a lot less clean cut? You did mention that they, are often sloppy, but did you notice that they have become more so less clean cut over recent years with the advances in technology and, all the rest of it that comes with it, like algorithmic trading systems and that type of thing?
Yeah, I definitely do. I mean, I think charts were more reliable, particularly daily charts, 80s, early 90s. I think that today I look at daily charts can get pretty from time to time just because of the volatility. But, I address that in a couple different ways. First off, I don't think that we have that degree of added unreliability when we're dealing with weekly and monthly charts. The reason being is that, in a lot of these markets, volume is coming in from high frequency trading operations, which of course are, in my opinion, illegal operations that run my orders in advance, know what I'm going to do before I do it. But so that's a large amount of volume that takes place, and those high frequency trading and algorithmic operations are pretty good at knowing where the orders rest, and they're pretty good at running stops, and they're pretty good at creating false breakouts. And so they day-to-day basis is a little bit more difficult to create a false breakout on a weekly chart pattern. But the other thing that I think I've graduated to, I've gradually moved to over the years is more dependence on a closing price. I just find what markets do during the day really doesn't matter much. I mean, jerk themselves around looking for stops during the day. Volatility is created to kind of suck people in. I look at intraday volatility as just simply wealth redistribution, the hands of the many to the hands of the few. And so I really don't want to be pulled into markets based on intraday price volatility. I wait for closing prices, and when we get closing prices, I act accordingly. So I'm looking for closing price breakouts of recognizable patterns through horizontal price boundaries. I think that's another thing, that were diagonal patterns such as the boundaries of symmetrical triangles or the violation of trend lines. I think that's an area that has really become more dicey than it used to be. And for that reason, I tend to stay away from chart boundaries that are diagonally on a chart, because I think that's where you get an awful lot of sloppiness.
Okay, that's a great answer. Now, something you said in there, which I found really interesting, was you mentioned that high frequency trading should be, illegal, or they're running illegal operations in your mind. So, what are your thoughts on that? I'd love to hear you speak more on that topic, on why you feel that way.
Well, I mean, it's a legal issue. Ultimately, it's going to be settled by a legal issue, but I think it's an ethical issue and a moral issue as well. I mean, what we know is that these high-frequency trading operations, which are run by high-speed computers and built around algorithms to take advantage of certain market situations, are piped into the exchanges. In the case of in Hoboken or in Des Plaines, Illinois, they've got their pipe to the price reporting mechanisms than I do. They get prices a fraction quicker, and as a result, they know prices are trading before I know what prices are trading at. They have an advantage for me, even if it's a split-second advantage. It's being on by a computer that has a microsecond reaction time, and I see it in the way I trade. I'll look at price. I'll look at price columns now, and generally, when I trade, I'm not hesitant about covering the spread, which means I don't mind buying at. I don't mind buying at the offer and selling at the bid. I'll see S&Ps trade maybe 40 contracts offered, 50 contracts bid, whatever. I'll put an order in to at the offer, and I'll click enter, and the offer disappears. Well, it disappears because that computer saw my order going in and adjusted where the offer was. They don't get an awful lot on a percentage basis of their orders filled, even though they represent a high percentage of the total volume in a market. But they have orders, they have bids and offers in the markets all of the time. It's kind of the way they're taking the temperature of the markets. And so I just have an an ethical and moral issue with somebody that's trading on advanced knowledge of price behavior.
Sure, okay. That's a good answer. I mean, I'm actually really keen to have someone who is involved with high frequency trading on the show at some point to get their views on it all. But I mean, I know a lot of the guys who are involved with that side of trading try to keep it under wraps as much as possible. But let's bring this conversation back to chart patterns. So I'd like to ask you, why do chart patterns even exist? Like, why do specific movements of price occur again and again on pretty much anything that trades?
Well, I mean, there's a couple different ways that I could go to answer that question, and I guess I'll just go right back to Schabacher. What Schabacher's observation is that prices, when plotted and viewed on a price graph, can be seen in the past as either having trended or being in an area of congestion. I mean, I think there's degrees to which that's true, and there's time frames to which that's true. But generally speaking, prices during any given time frame usually either trending or congesting. And in the process of congesting, there is the tendency for prices to form geometric patterns. Now, Schabacher did a really good job in his book, and people interested in this subject further really should read the Schabacher book, because he really kind of goes into what creates these boundary lines. But it is the composite of buying and selling of well, back then it was insiders. When he wrote the book, he is referring to, the groups of the Vanderbilts and so forth that would kind of get together and decide what they were going to do with the market. And so there was collusion, and it was kind of these buying and selling campaigns that would create these areas of support and resistance on a chart, which in turns represented geometry. Where I think today it's, of course, not collusion, but I think that there are trading operatives, there are trading people, there are involved in the markets who are definitely smarter than me. There are people that are operating very shrewdly with in some cases inside information. In some cases, they're just really smart people, and they tend to operate in composite. They don't know each other exists necessarily, but they're acting like-minded. And I think in the process, what happens is that large moves don't normally take place on preparation for that move to take place. That in general, when substantial moves take place, you are under pretty good assumption that the right people have been prepared for that move, have taken positions for that move, and are making money on that move. And it's so during these periods of congestion where big money comes in and creates tops, big money comes in and creates bottom. In the process of creating bottoms, tops, and consolidation areas, we tend to find ourselves with developing geometry. Now, I've got some philosophies of charting that I think some folks will find kind of contradictory to the fact that on charts. I mean, I don't believe that charts are predictive. I don't believe that you can predict any given market at any given time based on the chart patterns. I take real exception to Elliott wave people who tend to think that at any given time they can define where we are in a wave structure, that a wave structure is always viable. Of course, they can be wrong, and they call that revisions of that structure. Well, I'm a trader. I don't call chart patterns that don't work revisions. I call them loss. And so I don't have the luxury of saying, well, I'm revising my opinion. And so I think it's a real danger to always try to understand the market at any given time based on classical charting. But I do think that 2, 3, 4 times a year, we see the type of chart that I'm willing to trade in an individual market. Look for it. I don't try to study a chart. I hear people talking about, well, I need to study my charts. Well, I'll take a look at a chart and in 2 seconds know whether there's a trade setting up for me or not. And more often than not, there's not. Most markets, most of the time, cannot be understood based on classical charting principles. And so it's not a function of trying to study a chart so that you can figure out what the pattern is. I think there's a pattern or there's not a pattern. And when there's a pattern, there's a possible trade. More often than not, that trade's wrong. I mean, my win rate over time only 40%, Aaron. And what that means is my default assumption on a trade is I'm going to lose money on it. And so if you take a look and be wrong 60% of the time, I'm only going to be right 40% of the time. From the starting gate, that says chart patterns that are even well defined are not real reliable, at least in terms of the way that I approach it from a risk reward point of view.
Now that was a really great answer there, Peter. Thank you very much for going right into that. That was awesome. One of the things you mentioned at the start there was people should read, I'm probably going to butcher his name, was it Schumacher? Schabacker.
Yeah, Richard W. Schabacker. And the name of his book, and they can find it on Amazon, is Technical Analysis and Market Profits, Profits, and allude to that book in their technical analysis of stock trends is the basis upon which they wrote. And Schabacker, and I suppose but Schabacker really formalized classical charting principles for the first time.
Okay, sure. All right, well, I'll put a link to that book in the show notes if anyone wants to check that out. All right, so let's keep this moving. Would you be able to give us just a brief overview of how you generally actually manage trades? Once you've identified a pattern and you've taken a position on that trade, how do you then go about managing this in regards to stops? I mean, do you use trailing stops or do you have profit targets in place? What's the next step after you're into a position?
Well, now it gets kind of complicated, but I can try to answer that question. It's not an easy one to answer. I have a lot of nuanced ways to do it, but let me approach it from a little different angle. You know, if each trade would have taken since the inception of factor trading in 1980 were to be printed out on a sheet of paper as statement. You know, we used to get those by the mail. You know, now some brokerage firms still offer it by mail, but most of them come over the computer. But we used to get statements for every we do, and if I would have accumulated over the years a statement for every trade that I would have done and piled them on top of each other, I don't know. I made that I'd probably have a stack of paper that's probably 8 to 10 feet tall. I've made literally thousands of trades over the years. I know as a trader what my net bottom line as a trader over the years is. I mean, that's a pretty easy number for me to come by. I just need to run a cum of my tax report, what I've paid the federal government. So I know what I've made as a trader over the years. Now, if I were to start picking out of that pile of P&Ss, starting with the largest profits and then going down in that order, and pulling out pieces of paper until I come to an amount that equals my total performance as a trader since inception, I probably only end up with about 10 to 15% of the total trades. So, 10% of producing 90% of the profits, or 15 producing 85, whatever the case may be. Now, if I had to go a step further and say, I'm going to study those trades, I'm going to look at the trades that were I call my net bottom liners, the trades that really produced for me my trading profits over the years, that 10, 15, 20% of the trades that I made money on. Was there anything unique about those trades? And it quickly becomes apparent that there is. They tend to be trades that work right away, and they never look back. They break out and they don't hesitate. I mean, that doesn't mean to say that I've got a huge profit at the end of day 1 or 2 or 3, but it's at least not a trade that puts me into trouble. the person I mentioned who had the biggest influence in my life, the guy that traded for Cargill, he had a trading rule that he drilled into me, and that is you never take a loss home on a Friday. If you've got a loss in a position on a Friday, you get out of it without any question whatsoever. You get out of a trade. And he even took it a step further and further trading this. He didn't like taking any trades home that were losers on any given night. And he was a position trader. He wasn't a day trader. He'd take position an extensive period of time. But he placed a lot of emphasis on timing. And if your timing's not right, your trade's not right. To be successful, a trade has to be right on direction and it has to be right on timing. And if a trade is not right on both of those things, it's not a trade I want to be in. And so I tend to play markets pretty. I generally risk 1% or less of my trading capital, my nominal trading capital on a given trade, and I will markets with pretty close stops. I trade multiple contracts positions, and I tend to treat an entire position with different trading rules. I will take half of the position and I'll tend to trade it. I'll tend to take profits and look for an opportunity to put it back on. So if it's a short position, I will try to find opportunities to buy the breaks and then sell some sort of rally. And then I'll try to hold half of a position for as long as I can. And that's 3, 4, or 5 weeks. In some cases, there was a trade I did last year. There was a Forex trade in the dollar against the Singapore dollar that I held for, I don't know, it was 4 or 5 months. And so as long as a market is going in my direction, as long as I have a feel that it has further to go, as long as it doesn't start struggling, I'll tend to stay with the trade. But I do not use trailing stops. I think I'm kind of opposed to that, frankly, is you say, well, I'm going to, when I have $500 made, I'll move my trailing stop $250 below it, and I'll keep a stop from a trade. That to me it really doesn't make sense, because what happens if a person is, you have to ask yourself, why is someone using a trailing stop? And that is that they don't want to give back profits. Well, the reality is that may not be the right reason to make a money management decision. You make decisions based on the markets, not based on your equity. When you start trading your equity levels, you tend to get sloppy in terms of trading markets. And the market's not my equity level. I want to make good decisions based on what a market's doing, on the hopes that the markets will take care of the bottom line, and that I don't have to have my preoccupation on the bottom line itself. My focus will be on the market and let the markets take place. And let me just jump off of that and mention something. Control over whether a trade's going to be profitable or not. I don't have any idea whether a trade's going to be profitable or not. I have no guess whether a trade's going to be profitable or not. Obviously, when I'm optimistic about what the trade's going to do, but I have no control over what a market's going to do. The only control I have is over the that I enter. People try to glamorize the business of being a trader. Being a trader, at least being a position trader like I am, is actually a pretty boring job. I mean, my job is basically that of a glorified order enterer. I want to make sure that the order makes sense based on the chart that I'm looking at. I want to make sure that my position size and my money management makes sense based on my capital, and it is on the order that I enter. Is the order that I'm entering this evening, are those orders make sense? Will I be able to look at a chart 6 months from now and have every entry I make and every exit I make sense looking back a year or 6 months after the fact? The reality, caught up in markets the way that everybody does. I do stupid things. I mean, I still do stupid things. I don't know if I'll ever be able to purge myself of stupidity. But we don't seek perfection, progress. And so as long as I pull myself back, try to stay distant from the emotions of volatility during the day, and have my focus be entering orders that make sense based on my approach to the markets, then I'll let profits take care of themselves.
All right, sure. Now, Peter, many traders look up to you, especially for your extraordinary returns which you've accumulated over the years. But what's probably just as impressive, if not more so, is how you were able to achieve these returns with only very minor drawdowns. So I'd like to ask you, what are some of the common and perhaps dangerous mistakes often made by novice traders around risk management?
Well, I think there's a lot of them. I'm not a day trader, so I can't speak to the dangers of day trading. I'm sure those people who are proficient from different answer to this question than somebody that tends to be a position swing trader. I'd say I'm kind of mid-range between a swing trader and a position trader, and everybody's going to place a different definition on those terms. So for me, what's a swing trader is going to be different than what somebody else defines as a swing trader. But I think the big one is just making sure that whatever your approach is going to be in style with the market, in sync with the markets at times, and at other times in sync with the markets. I don't want to have to get myself in a position where I have to change the way I'm trading all the time just because the markets, I perceive the markets as trading. It's the markets are trading, so I'll pull plan B out of the closet. I've got a plan A. That's what I exercise, is my plan A. And I just assume that plan A will be in vogue in step times and out of step with the markets in times. And it's what happens during the out of step phases that really make the difference in the end. Trading is a marathon. It's not a sprint. It's for me, it's a long-term thing. I've traded now in 5 different decades. In 5 more years, I'll be able to say that I've traded in 6 different decades. And so my goal is to keep my capital together when I'm in a losing streak. And that pulling back size when I start losing on my trades. It's when I feel that the markets are not as well definable as they have to be. It's paring my size, it's paring back my risk. It's at times saying I'm going to be more picky on the signal that I'm looking at, and it's by very careful. It's it's diligence. If you exercise diligence, the rest is in the details, and it's by trying to just be diligent to keep my together. If you trade long enough, particularly in leverage markets like I trade, sooner or later you're going to make money. You can't help it. If you trade long enough, make money. It's not the making of the money which is the real challenge. It's the keeping of the money that you made. And I have just found that traders that over the long pull have records that I admire are traders that tend not just necessarily to be the best at selecting trade. I think trade identification, trade signaling is grossly overestimated in its importance. That money management and keeping the capital of an account intact, that's where a trader needs to spend their money management side, not on the trade identification side. I think novice traders in particular place way more emphasis on trade identification than they should. The emphasis needs to be placed on risk management, money management, and on the process of trading, on being repetitive. I'm also a pilot, so I know what checklists are. Is you get into a plane and you do the same things every time you're in a plane. You go through your checklist. You purposely look at thing. You have a written checklist, and you check this and you check that, and you go down through your checklist, and you're very purposeful in how you go about piloting that plane. I think a lot of traders get sloppy with how they trade, and that's when they get themselves into trouble.
Okay. Now, Peter, we should probably start moving towards the later part of this interview and start to wind things down. But I've got 2 more questions that I'm really keen to ask you. So the first one of those would be, what are some common misconceptions that people often have about traders who quote unquote make it?
I think a lot of people listening to this will probably disagree with me on this answer, but I feel strongly about it. I think my going in assumptions when I first went to the Board of Trade was that I would become a successful trader because, I felt I was just as smart as some of the guys that were down there. I would work hard. I would be studious. And I'd put in a lot of effort, and that those things would bring me results. And I'm not discounting those things. I'm not discounting intelligence. I'm not discounting hard work. I think they play a factor. But there's this thing that comes into bear called providence. I look back, and maybe if I would have started at a different time, I might not have had the in trading that I have had. Maybe if I would have had different people who would have come around me and been my inner circle, the results would have been different. I certainly know that early on, there were a few trades that really enabled me to put an account together that was large enough size that it really brought me into full-time way. Those trades might have gone the other way. It could have been a different story. And so there's a confluence of things that come into play. Call it luck, call it providence, call it destiny, call it whatever you want to call it. But that, my outcome wasn't necessarily based on what I perceived as my intelligence or my ability to work hard. There were other factors that kind of came in and guided what occurred. And so, and I'm sure there'll be a lot of people who take exception to that answer, but I feel pretty strongly about it.
Absolutely. I really like that answer, Pete. I think that's brilliant and very well said. Now, let me just ask you this question. I like to ask it to pretty much every guest that I have on this podcast. And we might have already covered it a little bit through some of the other questions and answers, but just to summarize, if you had to put it down to just one or two reasons, why do you believe the majority of traders never make it to the big time, meaning they never see huge success? What would you put it down to?
They're afraid to lose. I think would be the number one reason is, becoming right on a trade, becoming right on the series, to get personal. Hey, you're going to be wrong on a lot of trades. I just see that in so many traders. They're afraid to put on a trade because they're afraid the trade's not going to be right. That they're going to be wrong on the trade. Well, I don't have any problems with being wrong on the trade. I just assume I'm going to be wrong on the trade. As my default position is I'm going to be wrong on the trade. And if your assumption is you're going to be wrong on the trade, you approach money management differently. And so I think that's one reason. I think if there's a second, they trade too big. They oversize their position. They trade too much. They're too aggressive in trying to build a position that's larger than their account can support. That's particularly true, I think, in Forex and futures, not so much in cash, especially in stocks with a cash account or even a margin account. You're reined in based on what your capital is. You run out of your capital pretty soon. You don't, in the case of futures and Forex, seldom do I have more than 15% of my capital committed to margin. And so they come into futures and they say, my goodness, the margin on a contract of beans is $3,000 and I have $30,000 in my account. I think I'll do 10 contracts. Well, I do one contract of beans for every 100,000 in my account, or 10 per million. When I tell novice traders that, they at how small a size that I trade. But and so I think the mistake a lot of novice aspiring future traders make is they trade way too large a size.
Okay, great answer. Pete, what an amazing interview. Thank you so much for doing this. I mean, it's been an honor to have the opportunity to speak with a trading legend like yourself. Thank you so much for doing this.
You bet. Thanks for doing this. What you're doing, Aaron, is akin to what my friend Jack Schwager did in the form of books, is supply to new traders as well as old traders. Just stories about unique things. When I listen to your interviews or I read Jack's book, there's a couple of things that stand out. That is, every successful trader finds their own way. They find their own route. And it's only when they take responsibility for themselves do they really start to achieve and own it. And the second thing is the emphasis they place on money management, the strict emphasis on money management. I think those are two commonalities that you'll find us good traders and across continents.
Yeah, for sure. Those two things are very prominent. I mean, even I've picked up from having interviewed, what are we up to now? I think this will be episode 36. So, yeah, I mean, both really good points, and thank you for highlighting those. Now, Peter, where can listeners go to find out more about you?
I do tweet at Peter L. Brandt is my handle. And then periodically I'll post a blog, and that's peterlbrandt.com. I'll put a blog up. I don't blog as much as I used to, mainly because I find WordPress difficult to use, but easier sending a tweet. So, if they want to kind of see what I have to say from time to time, I will say this. I have a philosophy that I trade by. It can be summed up this way: strong opinions, weakly held. When I get into a trade, I have a strong opinion on it. But the minute that trade turns against me, that opinion all of a sudden becomes weakly held. And so sometimes I get some grief on Twitter because I'll express a strong opinion in a market, and then 3 months later they'll come back at me and point out how wrong I was. And what they don't realize is I was probably out of the trade the next day because I have strong opinions weakly held. But and so I find Twitter is kind of a engaging thing to do. But I think when you have a public presence like I do, you get your of who like you, but you also get your followers who want to find every fault you make.
Yeah. I mean, I guess that's just part of what we're dealing with at the moment now, with the social media the way it is. But yeah, I mean, I suggest everyone goes and follows you on Twitter. I mean, you post a lot of charts, which I find really interesting to look at. So yeah, a lot of value just from following your Twitter page. Also check out your website, which I'll link to in the show notes. What is your website again, Peter?
It's peterlbrandt.com.
Okay, excellent. I was actually on your site the other day, and I think it might have been the About page. You've got 11 trading rules, which I thought were excellent, and I'm going to link to those in the show notes. So if anyone wants to read those, go to chatwithtraders.com/36, and you'll find a direct link to those rules that Peter has, his Twitter profile, website, and everything else that we've discussed over the last hour or so. So Peter, once again, thank you very much. Take care, and let's talk soon.
My privilege. Thank you, Aaron.
What's up, team? It's just me again. Hope you thoroughly enjoyed this week's interview. I can tell you it was a massive honor to have the opportunity to speak with Peter. I mean, he's a guy who's been trading for 5 decades, which is phenomenal. It's such an achievement. Now, just a quick reminder before we wrap things up here, the latest ebook, Why Most Traders Never Succeed, is online and available now at chatwithtraders.com/read, READ. And like I mentioned earlier, I believe there really is huge value to understanding why most traders fail, probably more so than reading a book about how to succeed as a trader, because by now you've probably already discovered there are landmines everywhere, but if you can stay alive long enough, you'll find a way to succeed. The problem is most traders never make it through the initial learning phase, and it's due to a number of reasons. These are documented in this ebook. All the reasons provided have come directly from 18 of the pro traders who have featured on this podcast in the past. You'll also find summaries throughout to make things very clear and to help you better understand. If you do decide to purchase this, I really appreciate it. It supports the podcast in a huge way, so thank you very much. So if you'd like to find out more about this ebook, just go to chatwithtraders.com/read, READ. You can purchase it there for just $15, and you'll also be able to preview just a couple pages. If you scroll down to the bottom, you'll see a link there in the FAQs, so make sure to check that out. All right, guys, have an awesome week and let's talk soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has become home-based, ready to trade the pool?
And more. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer.
And get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? You're listening to episode 37 of the Chat with Traders podcast. It's great to have you with me, and thank you very much for tuning in. This week, I had the pleasure of speaking to another brilliant trader who has been heavily requested. His name is Morad, but many know him best as Futures Trader 71 or FT for short. To give you just the 30-second rundown, FT has been an active trader since 2000 when he started out scalping NASDAQ stocks. A few years in, he made the transition to trading futures and later started his own proprietary trading firm where he funded and mentored a team of traders. These days, FT runs a brokerage where he provides continuous education and risk control to a structured community, and of course, he remains an active futures trader with a great focus on reading market profile and volume profile, which we get into in great depth during this interview. We also speak about how you yourself can find a statistical edge without the need to be a programmer or have any knowledge in that field. And guys, all the show notes for this episode can be found at chatwithtraders.com/37. So a full recap on this week's episode, any of the links, resources, etc. that I mentioned can all be found there. And just while you're listening, I'd love it if you could please leave a brief review on the podcast in iTunes. This helps in such a huge way to increase the rankings and reach more listeners. So if you could do this, I'd be super grateful. Just go to chatwithtraders.com/iTunes. All right, now for this week's interview, I'm your host, Aaron Fifield, and here is my guest, Futures Trader 71. FT, what's up, man? Thank you very much for coming on the podcast. How are you doing today?
Good. Thanks for having me on.
No trouble at all. I mean, I've had many requests to bring you on the show, so it's really great to have you here. Now, let's get this started like we normally do by taking it right back to when you first got into markets. So tell us, how did you first discover trading and what were you doing prior to this?
Okay, so back in 2000, I was in construction. I was a construction manager. I have a degree in engineering with a minor in economics, and I was working for the largest construction contractor in the U.S. I learned to meditate just a couple years before that. And on a weekend, Memorial Day, I believe in 2000, I went on a retreat. I was living in Florida, drove up to a retreat and a meditation retreat. And I met a guy who was a trader. As we were talking, the markets, the conversation about the markets being as it was 2000, and the crash had just happened, 2 months prior. We were talking about the markets, and he said that he trades equities. He was part of a group known as the SOES Bandits, SOES, and he, based on our conversation, he said, "Hey, I think you've got the right personality for this. You should check it out." I guess I'd complained about my job, the hours and the problems with labor and equipment and all that stuff. And he said, you really should look at this. And so I thought, yeah, maybe. I was already investing. I was on motleyfool.com a lot, and I was an IBD subscriber, and I was kind of running some money. I was doing that through college as well. But this was trading, which was a full-time thing. So once the weekend was over, I went back to work, and I requested to have the following Friday off. And I drove from Miami up to a town called Vero Beach, which is just north of West Palm Beach, and basically joined this guy in the morning. And he said, the market opens at 9:30. I trade intensely from 9:30 till about 10:30 or 11. So why don't you come around, 10:45, and I could show you what we're doing as a group, and you can give me your thoughts on it. So I arrived on time. I sat down quietly. He said, just don't say a word. And it was a room, it was sort of an arcade that he created with a group of people. It was a room full of traders, and for the first time in my life, I see guys with multiple monitors on their desktop and so forth. Remember 2000, that's when LCDs started coming out. And it just looked really impressive. And as I sit there, I see this guy just clicking away on his keyboard, and I look at his P&L, and it was like $18,700. And so I thought, maybe that's just his buying power or the account value or something. And then he gets done, and we go out to lunch. And I said, I know this is private, but it says you're up $18,700. Is that a real number? He says, no, that's not. Actually, that's not the correct number. You have to deduct commissions from it. And that blew me away. He said he had traded several million shares that morning to generate that much revenue, and he probably owed about $5,000 in commissions and fees. And it just shocked me to see that he had made, in an hour and a half of trading, what I would normally make at my normal job over, couple months. And so I was, initially, just like everyone else, I was hooked by the earning potential and so forth. But, as time went on, I learned that that's not what it's about. I basically put in my notice the following week. Took them 2 months to find a replacement for me because I was a project manager, and it would be very difficult to just hand the reins over in a 2-week notice on a $40 million project that I was assigned to in Miami. And it took 2 months, and by then I was ready to move. I set up my account, and that's when I started. So I quit the salaried, regular employment world, and I joined the cowboy world of trading, or that's what it seemed like at the time. So that's how I got my start.
That's an excellent story. So, I mean, that's a pretty bold move to quit your job so quickly, after experiencing what you did. I mean, what was your thoughts behind that? I mean, were you worried that trading was gonna be difficult and that you might not pick it up right away? Like, how did you plan on supporting yourself?
So one of the conditions, the guy who introduced me to this is an extremely close friend to this day. One of the conditions was that I would need to read a couple of books before I started. He said, just wait, read the books, don't quit your job, and then decide if this is for you, and then quit your job. I didn't listen to him because, being an arrogant, pup, I knew what I needed to do, and I just quit my job the next week. But, I read The Disciplined Trader by Mark Douglas, and I picked up a couple of other books, and it just seemed to me like I didn't have a choice, because I was doing work that I didn't like doing, and I knew I needed to make a change, and I knew that I was in the best position I could be in the business that I was in. I was highly paid for my age. I was one of the highest paid people in my age bracket in a company that's been around for 115 years, the construction company. I was well taken care of. I had stock options, which I cashed to open my account for $50,000. And I was, I had a cushion, and I figured because of the projects that I was on and the tenure that I had, if I spent 2 years and failed at trading, that it wouldn't be an end all for me to get back into the construction business, which is always, there's always work, always something to be built. So to me, it was. And this is the case with my personality and with pretty much everything that I do. It's you're either going to dive in all in or you don't. And so I wasn't going to do that transitional thing where, I'll go to work at 10 a.m. and trade the market from 8 a.m. to 10 a.m. type of thing. I was either going to do it and figure out that I'm no good at it, or not do it. And so that it wasn't a big issue for me to quit my job and just pursue it, because I had the means to do that. I had the savings and so on to be able to just leave and go do it. The pain that followed, though, probably gave me a lot of self-doubt, but it was definitely worth it.
Sure. Okay. Well, let's get into that pain and self-doubt. So you've quit your job. What was the next step from there? Like, what was your experience like for the early years?
This is going to sound all too familiar probably to your audience, but basically I had the best possible environment to become a trader. And I've always traded in a professional environment. So I was surrounded by guys who, I'll give you an example. The last guy before me who joined this group, on his best day, he made over $90,000 in one day. The guy who brought me into the group, his best day was $280,000 in one day. I was in good hands. But in trading, being in good hands it helps. I was in a room that was very focused. There were blinds on the windows, even though we're in sunny Florida. There was a news feed that was running all day long. There was an S&P pit squawk that was running all day long. There was multiple LCDs with CNBC and Bloomberg on them. There was a Bloomberg terminal. And I was with these traders that just came in and absolutely obliterated the market every day, it seemed. But that's not enough. That's not enough, because coming in, watching someone trade, it's kind of like watching Federer play tennis. It just looks so easy, Oh, he just has to run and hit the ball. That's all he's got to do. But try returning a serve from a professional tennis player. Good luck with that. So over the next few months, I basically discovered that I neither had the right attitude, nor did I know myself enough, and that's the hard part, to be able to extract any sort of profits out of the market. So I opened a $50,000 account. And I traded equities. I started with the slower products, Dell, JDSU, and so forth. This was NASDAQ equities. And, the idea was to trade a 50-share lot and to make, $20, $30 a day at the beginning, and then to increase your size and so forth. I basically did not make money for the first, I think it was about 3 months. I just consistently lost every day. And this is trading from, the time the market opens till the time it closes. So it's pretty intense to sit there all day, just fearful that you might hit the wrong key on the keyboard and do something that would, destroy your account. In the meantime, I heard guys yelling, breaking keyboards, rejoicing for the profits that they just made, or you just got there was a lot of input. And this contrasts this with some of the folks that I know now who trade online, who are sitting in their basement, in a quiet environment. Maybe they're a part of a chat room and it's just a very sterile sort of environment where you're not getting all that feedback. The room I was in, people would yell out things all the time. The bid's thickening up on, Cisco. Take a look at Cisco. Or I'm getting short 20,000 shares here. Looks like the offer's not moving down. I'm out. I'm scratching this trade. Damn it. That sort of stuff. These guys are just constantly talking. And I was the guy in the corner with one monitor, because that's all I could afford at the time. And just sitting there and trying to figure out, what are they talking about? What is an offer? What is a bid? Why are they hitting the bid but not hitting the offer? Why are they lifting the offer? What does that mean? How do you read this scrolling tape that's going up my screen? What is this? What are all these blinking lights and numbers? It took a while. It was just like you're just basically being thrown into the middle of a lake and told to swim. There was no training or anything because we were all independent. This was not a prop shop, but it was a professional environment. People wanted to help out when they could, and that's a huge edge. And then finally I started to get it. I started to understand that maybe I should be buying when I feel like selling. Maybe I should wait for the market to tell me what it wants before I do anything, as opposed to just getting in there and saying, oh, what the heck, it looks like it's going to go up. Boop, nope, it went down. So that was the pain, just coming home every day and basically seeing that some of the guys were leaving with $5,000, $6,000, $10,000, $20,000 winning days. And I'm just losing $500 a day, and I'm watching my account go from 50,000 to, 20,000 to 40,000 to 35,000 to 32,000 to 28,000. And it just seemed like there was no end in sight. And the more pain, the more fear there was, and the more hesitation there was, and the more losses there were. It's just this cycle that somehow had to be broken. And all you could do about it is just show up, turn on your monitor, sit down, watch the market. It's all you could do. Just sit there. I read a bunch of books and all that stuff, and it all sounds great when you're reading a book. Oh, okay, yeah, so all I have to do is be aware of my fear. Or all I have to do is look at this moving average. Nonsense. You just had to reprogram your instincts because we were trading order flow and we were doing it in high volume and high speed manually. And you just had to be in the flow of the market. It's much like, surfing. You can talk about when you should jump on your board and when you should paddle and what part of the wave you should be in and how to ride a wave. You could talk about it all day long, but unless you're out in the ocean, floating around, waiting for the next wave and falling off your board with every wave and learning, muscle memory and teaching yourself that, you're not going to make it. And you certainly can't learn to surf while you're sitting on Lake Michigan in Chicago, where there are no waves. You had to be in the middle of where everybody else is, and I was, and that's the saving grace. I think that's the key element that helped me see that there is, yes, you can do this for a career because there are people there. I had that hope, and I didn't need that much hope because I could see that these guys were making money. It can be done. It's me. Something's wrong with me. It's not the market. It's not my equipment. It's nothing. It's my head. And that made the transition or the turn come a lot sooner because I had continuous evidence that this can be done, whether it's a slow day or a trend day or a fast day. It didn't matter. Somebody somewhere was making money, and somebody somewhere was losing money as well. And I was one of the folks losing money. I hope that answers your question.
Absolutely. No, that was an awesome answer. So would you say that after those initial 3 months of trading, did you start to gain some consistency, or how long did it take you before you were consistently profitable as such?
So I will define consistently profitable not as a dollar amount or metric. I will define it because I had to actually learn to trade twice in my career. 3 times, actually. One as a SOS equity bandit, as a SOS scalper, when when they had fractions and then moved to decimals. Then I had to relearn to become a trader when I moved to Chicago and started trading futures, which is what I trade now, as an order flow, high volume scalper, meaning, regularly trading 3,000 round turns a day, something in that volume. And then I had to relearn to trade the market the way I do now, which is more structure, more a stronger position, and more methodical, slower. And I could tell you that consistency should be defined, in my opinion, as the ability to confidently come in and say, yeah, I'll take something out of this market, as opposed to, oh yeah, I'll make $1,000 a day. I'm a consistent trader. No, consistency is when you don't know what the market's going to hand to you for the day. It could be $50. It could be $15,000. Consistency is the ability or the confidence to come in and say, yes, I'm confident that I'll do what I'm supposed to do, and that I'll walk away and I'll be rewarded for that. And I would say it took 3 months during my equity days, like my first exposure to trading. It took 3 months for me to stop bleeding. It took about a month of me just floating around, making a little bit and losing a little bit. And then something happened about the 5th or so month where I could confidently come in and say, yeah, I'm okay making $100 today. I think I could do it. I think I'll have at least a couple of opportunities to do that today. And that was, around the 5th, 6th month. And then once you're there and you string together a bunch of days where you confidently put up money, amazing things happen in that you become a lot less fearful with sufficient respect to risk in order to be reasonable with your losses. And then, there's a day where you hit $600. You're just in the flow that day. Things just seem to happen. It's hard to describe. And then for the next couple of days, you may not make much money at all, maybe flat or lose some money. And then one day you come in and, oh, wow, this is my best day ever. I made $1,200. And all of a sudden, it's almost like a chart, a trend where you have a trend, you have a breakout, then you have a small pullback, and then you have another breakout, continuation move, and you have a pullback. That's how it was. And then as you get more and more confident, you get to the point where you think, well, I'm trading 1,000 share lots. Let me put on a 10,000 share trade. What difference does it make? You do that, and then you lose your whole month. And unfortunately, most traders have to go through that several times before they truly become consistent, in that you just understand that it can bite your head off at any moment, kind of like being an alligator handler. Yes, you can get it to, hold its mouth open and so on. But if you lose awareness of that, where that alligator is, it'll bite your leg off. You need to you can gain confidence, but you should always have a healthy respect for the nature of the market, if that makes sense.
Absolutely. No, that's really good. I like the way you described consistency there. I think that's really on point. Now let's dig into how you're actually trading today in current times. So would you mind giving us just an overview of your approach to trading?
Okay, so just a little bit of background. Once I stopped trading equities and I moved to futures and moved to Chicago from Florida, I basically traded order flow. I basically traded momentum. All we did was watch multiple markets and you try to be the first. Like if the S&P starts moving up and the Dow is lagging, then you'd buy a bunch of Dow and you would wait for it to catch up to the S&P and so on and so forth. There was no technical analysis involved at all, even though, we paid for very expensive charting packages and things like that. I did that for a prop shop, which is a proprietary trading shop. Means there's a company that puts up who owns the account, puts up the risk capital. You come and trade it, and you get a payout, a split of whatever profit you make, and they carry all the risk, and they charge you for things like rental of a desk and the cost of a computer and a phone line and so on. And so I did that for a while, and then I went and I left that business, and I actually created my own prop shop, and I started to back people and train people and so forth. I was training people. I was training new traders while I was at the first prop shop after I became profitable again in futures. And when I trained people, I would get a cut of their profits. I would share the house's cut of the profits. So I got to see how people go through the process of learning what issues there are. I got to work with a couple of floor traders who were transitioning to the screen, who are by far the worst guys that I've ever tried to work with, going from trading, 100 lot S&P in the pit, which is, $500 or $250 a point, and then telling them to trade one lots in the S&P E-minis doesn't go well with these guys. So I learned a lot about psychology, the psychology within others, and in teaching others, I could see within myself what I needed to do, what I needed to work on. And then once I started my prop shop and got that going, it was very successful. I backed about a dozen people on my own. Over time, I could see that the markets were paying less for more risk. So after 2005, 2006, the scalping algos, predatory algos, and things like that started to come into effect, and co-locating and high-speed execution and high-speed order flow started to eat into my bottom line. And so I started to cut back on, or I stopped backing newer people, and I just let my current traders just run out their contracts. And it just seemed like they're always asking for more and more buying power for the same returns or less. And I didn't like that at all. So I started to look around and educate myself about different ways to trade. I could not compete with the computers at a microsecond level. But what I could do is increase my time frame and potentially catch bigger moves. And that transition is extremely difficult to make when you go from clicking away all day long on the mouse and trading 2,000, 3,000 round turns in a day to putting on a position and taking a bunch of heat, meaning letting the position go against you for a while and waiting for it to turn. It was like trying to turn a sprinter into a marathon runner. It required a whole different group of muscles and the whole recalibration of my mind. So that was my third learning phase. So as I developed that, I went from just trading order flow on the depth of market to studying every indicator and every little thing that existed. I would recreate RSIs on a spreadsheet. I would create these dynamically linked spreadsheets that give me the same information that's on the chart so that I could understand how the line on the chart's being created. How is an exponential moving average different than a simple moving average? Things like that. So I started to look into that, and I wasted a lot of time looking at these lagging indicators. And eventually I came across Market Profile, which made a lot of sense. I'm a member of the CME, and the CME was pushing Market Profile there was a free course on it. And actually Dan Gramza, which is maybe someone you've interviewed, was offering a course on market profiling. So it was free to exchange members. So I went And I started to dig into that, and I started to study it, and it made sense to me how we're organizing the information based on 30-minute time slots into a statistical histogram, so we can see where the market traded a lot, what prices it accepted versus what prices it rejected. I did that for a while. I basically became an expert in market profiling, and I started to use that as a basis. But over time, and having a very expensive charting package, a $900 a month CQG integrated charting, there was a feature in there that would allow me to not only look at a market profile, but to actually look at the volume at every price, to create this volume profile. But nobody was using that. Nobody knew anything about it. And it just made more sense to me that, wait, why do I care about time? I should care more about how much traded at every price. So I started to do studies using Excel and so forth into volume profiling. And I just started to develop this approach of looking at volume at each price versus volume at each bar, and understanding how the auction is working. If the key participants in the market feel that a certain price is fair, or there's no reason to move price away from an area, then it would trade a lot in that area, and it would create this very bulgy profile in that price range. And what that clearly showed me is that, okay, it's got nothing to price, but people still are trading, and for every contract that's bought in futures, another contract is sold. There's never an occasion in the market where there are more buyers than sellers. That does not exist. There are more aggressive buyers than sellers, but for every contract that's bought, there's a contract that's sold. And if the market's trading in this tight range and it's got a ton of volume in that range, and for every buyer there's a seller, then what that means is if the market starts to move away from this area that's been accepted, then half of the volume that went into that creating that bulge is wrong, and they're going to have to cover their positions. It's going to trigger some stops, and they're going to have to cover their positions. And so I would observe that over the next few days. I would look at, okay, if the market's in the tight range because they're expecting news, or there's nothing, it's dead and there's nothing further to do, what happens when we break away from that? What happens when we break away and we pull back? Where does it pull back? How much of a pullback do we get? So I started to do this scientific engineering kind of approach to looking at what the market's doing in the form of an auction. And that's how I trade. The folks who suggested that you reach out to me and to have this conversation with you, I appreciate it, by the way. Those folks are followers on Twitter because of this approach, because this is all I talk about and it's all I do, and I've not changed it since 2005 or 6, and it's the same thing, and it's what drives the market. So you can sit there and impose VWAPs and CCIs, and you can put all kinds of indicators on the market, but the bottom line is, what price did they trade and how much trading occurred there? That's what governs. And so you can express that in all kinds of different mathematical ways, which is fine. I'm not poo-pooing that. I think that's, you use whatever you feel you need to in order for it to make sense, because ultimately it's your money that's at stake. But to me, understanding how the market goes from an area of acceptance to another area of acceptance to another area of acceptance, that's very important. And we see it in everyday life. We see it with the most valuable things that we buy on a regular basis. Think of when we look at retail, it's a one-way market. There's usually one seller. We show up at the supermarket to buy milk, you're only buying milk from that retailer. You can't go somewhere where you're able to buy milk from many different retailers all at the same time. So it doesn't represent what the market, what we see in the market every day. But it's very similar. If milk is something you consume every day, and let's say a liter of milk is $1.50, and that's what you commonly pay for it, that's value. So if I charted the number of units of milk that have been sold at $1.50, I would end up with a very long line. And then I could go to a convenience corner store, which is going to charge you a premium for that convenience. They may sell that same carton of milk, liter of milk, for $2, but they will sell much fewer units because people know that they can go buy it for $1.50. So that's the high end of value. But there are days that you can join a price club like a Costco or Sam's Club here in the U.S., where you can buy things at wholesale rates. So I can go and buy, instead of a liter of milk, I can buy 10 liters of milk at 90 cents. And so that becomes the lower extreme of what a liter of milk should cost. But let's say you're dependent on buying this milk for $1.50, and all of a sudden there's a mad cow disease, and there's a shortage of milk, and then all of a sudden everybody's selling milk for $2.50. And now, over time, as more and more people buy that milk because they don't have a choice, now you have value moving from $1.50 to $2.50. And it stays there. The fact is, you're going to buy less of it. You're going to try to find alternatives, maybe water it down or something. You're going to buy less of it because the market is much higher in value. As soon as this issue that caused milk to get more expensive goes away, then you immediately, naturally as a human being, remember that the market was at $1.50 for a liter of milk. And so your expectation is, as prices drop, they will likely continue to drop until it goes back to $1.50. To me, that represents a short trade opportunity from a temporary high price back to the most accepted price, which is what's called the point of control. And the market does this all day, every day, except it doesn't have one value point like the price of milk does. That's just a simple example. It creates value every day. Every day it picks an area where it trades a lot, and then it moves away and it picks another area. But if it does not hold that higher area, the most likely thing it'll do is it'll move back to the prior value area. If it cannot hold that value area and it continues, look for a lower value area, and so on and so on and so forth. So I'm watching volume of price. I'm watching the quality of the rotations. In other words, how quickly did price move from one area to the next? How desperate were the participants in that area? Is it done moving to that next area, or is there more liquidity available that's going to prevent it from waiting there and it's going to push it lower? And there are ways to detect that. And I talk about those every day. I mean, I opened up How I Trade to the public back in 2009 as a way of giving back. And it's not a system. So it's not something where I'm concerned that my edge is going to disappear over time. Most people who've watched me talk about this stuff since 2009 will attest to the fact that it has not changed in that long. And on a day-to-day basis, I show up at 8 a.m. Chicago time, 9 a.m. Eastern, before the market opens a half hour, and I sit there and I say, here's what we said it would do yesterday. Here's what it did. Here's why it did or did not work. Here's what was set up yesterday. Here's what set up overnight. Here's what I expect to happen today. And here are my key trades for the day. And then the next day I look back and I say, here's what I said it's going to do. And I repeat it. And I call those Trader Bites. And I post those every day and are done live on YouTube as a way to demonstrate to other traders that they don't need to go out and pay for some ridiculously expensive course or be part of some crazy chat room or signal service, that they can do this on their own. And that's really an important factor for me. I've done well with trading, and I have something that explains the market at its core. And you can throw your moving averages on there, fibs or Drummond geometry or Gartley patterns or whatever you want to use. It's okay. Use what may own it. Ultimately, you have to own what you're doing. But first and foremost, understand what makes the market move and how it moves, what causes these rotations. And it's all about price discovery. The market's job is not to run stops and make everyone lose money and give it all to the big houses, the Goldman Sachs's and the JP Morgans of the world. They're in the same situation as everybody else. The market's main purpose is to get as many buyers and sellers to meet and agree on price as possible. The market's key mechanism is to discover value, because that's where the most trading will happen. Does that make sense?
Totally. Yeah, no, I really appreciate you going to such great lengths with that answer. That's really, really good.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Equities, using ACK as a registered broker, Trade the Pool's limited risk platform. You don't need millions or even thousands to start trading the U.S. stock. Start your evaluation, get funded with up to 2 months, practice on live data,
and volume profile. Obviously, volume profile is...
even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
And just so we're clear, so we've just discussed their market profile and volume profile. Obviously, volume profile is, how do we describe this? Kind of like the horizontal bars that go up the vertical axis of your chart.
Yep.
How is market profile plotted on a chart?
Market profile is plotted on a chart the same way, but instead of I use tick volume. So it's taking every single tick that trades and is organizing it at every price level. Market profile just basically takes half-hour slots and creates either a dot or a letter and then organizes that dot or letter the same way. So where volume profiling is representing the exact volume, hopefully if you have a good enough data feed and a strong enough charting package, it should represent the exact volume that occurred at any given price. Market profile is only looking at time. So a market profile where the market traded a lot of volume within a certain range is going to look exactly the same as a market profile chart where the market just traded very little volume but continued to trade that same range. It'll basically show the exact same thing. But to me, that doesn't represent the same information. If I'm able to represent volume at price, it's a true indication of how motivated the different traders are at trading at those prices. To me, time should not be. I don't like time being a factor in my trading. I'm not interested in 15-minute bars or 5-minute bars or 3-minute bars. I remember when I was researching, moving away from tick scalping to trading, more technically, I would hear things like, what I look for is for the 5-minute bar to close below the 20-period moving average. And it just seemed to me, it just didn't make sense to me personally. It may make sense to others. It just didn't make sense to me personally why it should be a 5-minute bar that has to close under the 20-period average. Why not 6 minutes? Why not 3? Why not 10? Why not 12? Why not some random number? It just did not make sense to me because I felt like, does it make a difference to the merchant whether you buy that milk between 8 and 8:32 a.m. versus 9 and 9:02 a.m.? It doesn't matter. You're still buying a certain volume of milk and you're buying it at a certain price. And that's what determines, whether or not that merchant should restock its shelves, or if the milk is just sitting there rotting. It doesn't matter how much time there is. Well, in the example of milk, that doesn't apply because the stuff rots. But does that make sense? So that's the difference between. I felt like Market Profile was great back in the day when you didn't have all this volume information. But these days, I get tick volume, and I have that information. So why would I be stuck organizing the market in terms of time when I can organize it in terms of price and volume?
Yeah, I think that's a really fair point. And I like the milk analogy too. I think that helps to make things a little bit clearer. And what I'll do is I'll actually link to your YouTube channel. So people who are interested in finding out more about this can go there and check it out. So a link to your YouTube channel will be in the show notes at chatwithtraders.com/37. So I recommend anyone who wants to find out more, definitely check that out. Now I've got another question around market and volume profile. So you're using them sort of intraday for intraday trades. Can they provide benefit to traders who may not operate on an intraday time frame, such as swing traders and position traders, etc.? Or do they tend to become less effective as you zoom out by time frame?
Great question. I'll let you in on a secret. In my own portfolio, for my own investments, I use volume profiling. For example, you can do a volume profile on Apple and look at Apple over, how has it traded since it's split, and look at how much volume, how many shares were traded at every price, and you could get the exact same information. I organize things by day because I trade in a day time frame. I shouldn't say never, but I hardly carry any positions past the close. It's just not my style. In fact, the fact that I can hold a trade for several hours during the day is a huge leap from the few seconds I used to hold trades. But it's the same thing that applies. In my own investments, the way I determine, like if I was to trade an option, for example, if I held shares of, say, Potash, and I wanted to, let's say I owned 100 shares of Potash and I wanted to generate additional revenue, I could sell an option, a call option against that position, collect the premium. And the way I would decide what the price of that option should be, what the strike price of that option would be, is to look at a profile that carries for more than a day. And it's very easy to do that. If someone goes to my website, for example, futurestrader71.com, and looks at some of the images that I have in there, they'll see that there's what I call a composite profile. And this is a profile that's collecting data at every price over years. And it shows you over the last couple of years where the market has traded a lot versus where the market has rejected prices. So it's the same process. By the same token, on very slow days when the market tends to be locked into a range, what I do is I look at 5-minute profiles. So not really 5-minute, but I basically have the software draw a profile every time it trades 10,000 shares. So I look at these mini profiles. I call them intra profiles. They're like within each bar, I can see a profile of the bar. So I can see, when you look at a candlestick, let's say you're looking at a 15-minute candlestick. That candlestick is showing you where that candlestick opened, how far it went down with a wick, and then it shows you how far it went up with a wick, and it shows you where it closed, right? That's all the information you're getting out of a candlestick. If you attach a volume histogram at the bottom, you can also find out how many shares or contracts traded within that candlestick. But what you don't know, what you're blind to, is where that volume occurred within those prices. So if Apple moved $5 in a 15-minute candlestick, you don't know if the volume occurred at the bottom of the candlestick where most of that trading occurred, or did it occur evenly distributed within the candlestick, or did it occur at the top part of the candlestick? That's important information, because if it occurred at the top part of the candlestick and the close of that candlestick was below that high volume area at the top, that shows weakness. It shows that as the market tried to push higher in this 15-minute bar, that there was a supply, there was liquidity there, and it continued to trade and trade and trade, and the traders failed within that candlestick to overcome that liquidity. If I was holding a long position, I would start to consider, I should lighten up here. I should take some profits and reduce my risk. So it does apply to pretty much any time frame. I look at weekly profiles, I look at monthly profiles, and I also look at a few seconds worth of profiles, because all I'm looking for is just detail within a time period of where the volume has occurred, where the trading has occurred. And that gives me a lot of information.
Okay, no, that's a brilliant answer. Thank you very much. Now, let's keep this moving a little bit. So I know you have a very specific way of determining what defines a setup and what actually defines an edge. So would you be able to share with us how you define these two commonly used terms? Like, what is an edge and what is a setup in your eyes?
So an edge, to me, an edge is simply a probability of one thing happening over another. So an edge is as simple as, look, the market has sold off for the last 4 days. And I do a lot of statistical study, because I think that's the missing link for a lot of traders, is that they just want to follow a head and shoulder pattern or cup and handle or whatever. But they haven't built the confidence or the background of how often something works. But I think in probabilities. The times when I didn't think in probabilities, I was probably thinking emotionally, because I think that's the alternative. That's the only other alternative there is. And emotional trading leads to losses. An edge is as simple as, look, if the market's been selling off for 4 days, in other words, it's made lower lows for the last 4 days, let me look at statistically over the last 3,000 days, how often has the 5th day been a selling day? And if I look back, given any stock or any commodity, if I look back and I see that the probability, the number of times that after 4 days of selling, that the 5th day was a selling day, has occurred just 1.5% of the time, then the next day, I'm not going to look for selling opportunities. I'm not going to be aggressive about the selling. I may still sell, but I'm not going to be aggressive with the selling. That's an edge. Something as simple as that is an edge. I know the probability of today making a lower low is 1.5% given a large sample, 3,000 trading days. So if the market gets close to the low, and I can see an opportunity where I can get in and my reward, my upside is much better than the loss, which could be the prior day's low, that would be my stop out, somewhere beneath that would be my stop out point, then that's a huge edge. And all I have to do is just put that on whenever it shows up, indiscriminately. Another way to describe an edge, and the description of an edge is very simple. It is the probability of one thing happening over another that provides you a 1-to-1 or higher reward to risk, period. over a period of time, that concept alone should show you profit, given that you overcome your costs, your commissions and fees and so on. That's all you need for an edge. A lot of people, when they talk about edge, and I read a lot, I look at forums a lot, I've done a lot of talks on several forums with regards to different ways. I'll give you a simple edge. I trade the S&P 500 futures, the minis. Statistically, and I have a video on this on YouTube, you just have to look it up, just look up Futures Trader 71 statistical edge or something, statistical analysis. And I show how I extracted this study using Excel, very simple study, where I showed that 97% of the time, given 1,700 days of a sample, 97% of the time, the S&P 500 will either touch or break the overnight high or the overnight low in that session. So the market opens at 9:30 Eastern. 9:30 Eastern till 4:15 Eastern is considered RTH. That's the regular trading hours. That's what we call the pit session. If I look at that session, 97% of the time, the high or the low of that session should have touched or exceeded the high or the low of the overnight session or the Globex session. Does that make sense, or is that complicated?
No, that's good. That's good. I like where you're going with this.
So that's an edge, 97%. So the only thing I have left to do now is figure out where can I, given where the market is opening today, and knowing that the overnight high, let's say the overnight high is 1932 in the S&P and the overnight low is 1914, the market looks like it's opening around 1920. All I have to do is figure out, okay, who's dominating the auction at the beginning? Is it the sellers that are in control? Because if the sellers are in control, I'm going to target that 1914 low, the overnight low, and there's a 97% probability that the low or the high is going to be tagged or touched today. And so if I'm trading with the dominant side and sellers look like they're in control, in other words, the market drops quickly and then moves up extremely slowly and laboriously, that I'm going to try to get short somewhere where I can define my risk. And that's a very fluid decision. The context of it is very fluid. And I would have to have a screen in front of me to describe that, but I talk about that all the time. I've eliminated, I would say, 80% of the decision-making process on the spot as I trade. I've eliminated it by identifying that simple edge. My job now is to find an area to get short, period. In the example of four selling days, with the fifth day having only a 1.5% probability of making a lower low, I have already eliminated most of the work. I am going to look to push my long trades today versus my short trades. I'm going to be tentative with my short trades, meaning I'm going to have very small targets. I'm going to trade them with 1/4 of the unit size, but my long trades are going to be the bulk of my focus today. That in itself, identifying that small piece of information, puts me ahead of a huge number of traders who have no idea what could happen today statistically. And I have the data to back it up. And everybody's got the same data. I'm just digging into it and creating a probability out of it. So that's an edge. As far as a setup, that's another thing that's very fluid. If I could describe what I'm doing in the form of if then else statements, Aaron, I would not be sitting at my desk every day. I would hire a programmer, I would go on Elance, hire a programmer, create a system, and just invest money in it and, just let it rip all day long. But that's not how I trade. That's not who I am. My setups are dependent on my edge. My setups are mainly built on the price action, the current price action versus what the context of the auction is. In other words, what is the volume profile telling me? Who is the dominant force? The best example of how I trade, best analogy would be if you were in a bar brawl. You're in a bar, suddenly a fight takes place. You can't leave. You're going to be a part of this fight. Where most traders just are like, well, I'm here to brawl, so I'm just going to start punching somebody. And so they're very impulsive. And remember, I'm part of a brokerage now. I started a brokerage several years ago that takes my prop experience and brings it into a brokerage setting. It's called Stage 5 Trading. And I've watched how retail traders or online traders trade. And the analogy that comes to mind is they come in, sleeves rolled up, they know they're going to have to throw a punch today, even if they don't have an advantage. Even if the guy they're about to punch is 300 pounds and it has 2% fat, they'll throw a punch. That's not smart. My approach is to wait. Find out who's throwing the better punches and who's got the better fighters, and to go and fight on that side. That's my approach. I want to identify through my volume profile, through the detecting how the market is rotating. In other words, from the swing high to the swing low of the last few bars, which side tends to gain more ground with every push. And then what I do is I trade with that side. So I wait. I generally don't throw a trade out there right at the market open. There's no edge for me. I still don't have enough information. I want to know who is the gorilla, the 800-pound gorilla in the room, and who's controlling the auction, if there is anybody, and to trade from that side. If the 800-pound gorilla in the room doesn't show up, in other words, there isn't an immediate push and control from the buyers or sellers, and it just seems to float around kind of like yesterday's market did when it opened, then I know that I'm going to be trading against short-term traders. I'm going to be trading against scalpers and short-term position traders. And if I'm trading against those people, those are the dominant participant in the market, then we're going to be basically playing whack-a-mole with price. We're going to be beating each other over the head. And so I'm going to trade with the expectation that my targets have to be very short-ranged, and that there's going to be a lot of fluff. There's going to be a lot of back and forth that is kind of pointless until somebody comes in, a higher time frame, somebody with some real business to transact comes in, pushes the market in one direction, at which point I'll probably take a loss, but then it immediately gives me an opportunity to go with that participant. It's very technical, but it's hard to describe in words. It's much easier to describe on a screen, of course.
Of course, yeah. So we'll definitely link to your YouTube channel in the show notes. Just before we move on, though, I'd just like to ask you another question on your answer there. Do you still do all your studies in Excel, or do you use more advanced software for some of your other setups and when you're looking for an edge?
So because I'm trading in a more traditional way, it's sufficient for me to use Excel, and because I'm an expert at Excel, it's easy for me to manipulate the data using filters and so on to get what I want. However, there are studies that cannot be done in Excel, and so what I do is I've looked at several statistical packages like JMP or R, and I'm not a coder. And I just don't have the time running a brokerage and doing this education stuff plus running a charity. I just don't, and being a father, I just don't have the time to sit here and learn the code. But the software that I use, it's called InvestorRT by Linsoft.com. the software I use has made a lot of advances, and I've worked very closely with the developers. Has made a lot of advances in that I'm able to extract more complex data very, very quickly with it. And luckily, because I have such a close relationship with them, if it's too complex for me, I just call them up and I say, hey, how often does ABC happen when, DEF happens? And I get the results that I want. The proper way to do that, if I was to operate like more of like an institution, is to have someone who's just sitting there cranking out studies all day long. But frankly, I'm just a trader. I am not interested in dissecting the market in 50 different ways and to know to the tick and to the fifth decimal place how often some probability occurs. I feel like I'm at risk of, because I'm an engineer by nature, I'm at risk of getting lost in all of the numbers. And I've done that to myself. I start a spreadsheet and I'm looking for one thing and I end up spending 6 hours extracting so much stuff but I still haven't answered the initial question that I set out to do. What I do with trading is keep it simple. The banner for my site says simplicity in trading. Trading is simple. It's not easy. It's not easy, but it's simple. And I found the more complex I make it, whether it's by, statistical studies, or I start to play with some indicator or create some sophisticated system, and I've worked on trading systems in the past, I find that it loses something. And one of the key things it loses is expected value or expectancy or return on capital. The more complex I make something, the less I get out of it. So in general, I look for simple things. Let me ask you, what is your favorite instrument that you trade, Aaron?
It would be US equities.
US equities. Throw one out.
Goldman Sachs.
Goldman Sachs. Okay. So if you look at Goldman Sachs, one of the things I would look at is what is the magnitude of movement per unit of earnings per share release, beat or miss? How far, if they come out with their earnings and they always beat their earnings expectation and guidance, how far should I expect the market to move? That's number one. The second is, this is an earnings season play. So I get to play it 4 times a year. The second thing is, when it gaps, how often does it move back to where it was the night before the earnings released, the day before the earnings, and how often does it actually move away from that price? I want to know, does it generally return back? Let's say, I don't know, what is Goldman trading at these days? I have no idea. But let's say it's, let's throw a number, $40. And then earnings come out, they beat as usual, and it gaps up and it's at $45 the next morning before the open. I think they announced it like 6 a.m. Chicago time before the open. And let's say it jumps up to $45. The question I would have is, okay, how often does it go back to $40? How often does it retest the last most accepted price before that earnings announcement? That's number one. Number two, and how many days does it take? Does it do it the next session? Does it do it in 3 sessions on average, or what? And that creates a position trade or a swing trade edge potentially for me. It also creates an option trade edge for me. So I keep it simple. That sort of question can be answered with just a pen and paper pad or an Excel sheet. There's no need to pull in tick data and use R to get statistics and correlations on that sort of study. That's the sort of thing that I prefer to trade. Something that is created on the actual market movement or the actual market process rather than something that's purely mathematical. It has to make sense to me from the perspective of buyers and sellers coming to trade versus what does it do mathematically. That's why I don't use floor pivots, floor pivot numbers and so on, or Fibonacci retracements or anything like that. I need to understand how this makes sense from the perspective of someone who thinks a product is, Goldman Sachs is too expensive, or who thinks it's too cheap from a technical perspective. So I don't have a use for a high-end statistical package, but sometimes I do come up with scenarios, things that I observe that are just too complex to do with Excel. And for that, I rely on the actual charting package and the capabilities built into the charting package itself.
Okay, sure. No, that's a great answer. That definitely explains it. And I mean, it's good to know that you can do so many things with Excel. I mean, I'm a bit of a novice with Excel, but it's good to know that it has the scope and the capability to do these sort of things. So,
do you trade it on do you day trade it, or do you trade it on a position basis?
I'm not a day trader, no. So I'm more of a swing trader. I could get into a position and hold it for, a few days to a few weeks if it goes well. But in saying that, I could be out the same day if it goes sour. So
yeah.
Yeah.
So with that approach, like if I was trading in that method, I would want to know, for example, what is the range per day to expect in Goldman? What is the range per week? How much of the week have I covered? For example, if I put on a Monday position and it's going for me, and it's already covered 99% of the range, the average range, and it's Thursday, maybe I shouldn't wait till Friday to close that position. Maybe I'm pushing it to get that extra 1% if it gets there. That sort of simple. Then that stuff is very easy to pick up, right out of a chart. You just need to look at a weekly bar and look at its range and just put it on a spreadsheet. Okay, for this week and that week and that week, this is the range, and so on average, I get this much range on a weekly basis. And since my time frame is about a week, this is how much range I should expect on my next trade. So I shouldn't be pushing for, a $6 move in Goldman Sachs when I don't hold over the weekend. You shouldn't be pushing for $6 move when the most common move is about $4. I should be looking for an area to exit around $4. That's an edge.
Okay, no, that's really good. I appreciate you going into depth on this. That's really good. All right, well, let's just do a couple more questions. I mean, we're pushing just over an hour now, so we'll do a couple more questions and then we'll start to wrap this up. So, I mean, you mentioned earlier on that you originally started out as an equities trader and a couple years later made the switch to trading futures. So for anyone listening to this who may be interested in doing the same, what are perhaps some of the greatest differences that they should be cautious of?
With regards to switching to futures?
Yeah, from equities.
Okay, so once I switched to futures, I never looked back at equities. And for several reasons. One, extremely efficient use of capital. I don't have to, the notional value of one S&P contract right now is approximately $100,000. It's trading around the 2,000 point range, and it's worth $50 a point for the S&P Mini. So it's a $100,000 notional value. I don't have to put up $100,000 to hold a trade. In some brokerages, and I disagree with this, you only need $500 to hold that much buying power. So I don't need that much capital. When I started my trading business for myself, my prop shop, I started with $25,000, and I got a rate of return monthly. And this may seem really nonsense to you, but the monthly rate of return was between 65 and 85% per month. That only exists because of leverage. Now, that's the upside. Let's talk about the risk. If you're trading a $100,000 product for $500 in an account, it takes very little to wipe out your account. So you have to, with futures, you can't mess around with risk. I think stocks are a little bit more forgiving. But at the same time, I don't like about stocks that they can make their move on their own based on one factor alone. I'll give you an example. You're long Goldman Sachs, and something happens. You find out that they're being sued by the U.S. government or something, and this lawsuit's going to cost them billions of dollars. And you had your stop just below yesterday's low, and you come in and you see that it's trading at 50% of yesterday's price, closing price, way below your stop. And guess what? That's where you're going to get filled on your stop. There's no liquidity there that's going to fill your stop at market where you set it. And it's because some actions is taking place, or some news events taking place in that one stock. That doesn't happen in futures if you are trading a liquid product. You can't have one company controlling what the S&P 500 is going to do as a commodity. It's representing 500 stocks, and so there's plenty of liquidity, and it's much more methodical. Futures, however, are more competitive. It's a level playing field. There are no surprises there. So it's to extract money. You take advantage of the fact that you have this leverage to make money. So there's positives and negatives. One of the key positives to futures is that I don't have to deal with this day trading pattern rule. I don't have to deal with that. I don't have to have a $25,000 account to buy and sell and buy and sell and buy and sell futures hundreds of times in a day and come back and do it again and again and again tomorrow. All I need is $5,000, $10,000 or whatever, and I'm able to trade as much as I want. And then whatever profits I make are taxed in the U.S. On a long-term as well as a short-term basis. So the tax liability by trading a commodity is much, much better. My taxes are much lower, and my costs are much lower when trading futures than when I was trading equities. Equities, I had liquidity provider versus liquidity taker fees. I had, routing fees. I had all kinds of fees. It was very expensive to trade the one stock, and I still had to put up, even with margin being offered by my broker, like 4-to-1 margin being offered by my broker, I still had to put up with fees, and I had to pay interest on that margin and incur penalties on that margin. That doesn't exist in futures. I feel like futures are just a lot cleaner. However, futures are more difficult to learn on because the leverage creates a much higher emotional response in people. You can trade a 10-share lot while you're learning. You can trade a 10-share lot in equities. Pick an equity and just trade 10-share lots in it. You can't do that in futures. You're either going to play with the big boys or you're not. There's no way. The lowest amount of quantity of trading you can do is one contract, and that one contract may be worth $100,000 or $50,000. There's nothing smaller than that. So it kind of freaks people out. The ideal situation is you start out, if you're trading equities, switch over to trading, say, spiders or some other ETF, and trade small and put together a good number of days, put together a good expectancy or a good edge, see that you have a positive return, and then make the switch to futures. And may do it with a broker that helps you watch your risk or provides you the tools that help you watch your risk, which is really why I got into the brokerage business, is to create that environment. But most brokers will be able to help you with that.
Okay, and just to add on to this, one thing I often hear about aspiring futures traders, or people say about aspiring futures traders, is that they're often undercapitalized. So in that case, what would be the ideal amount of starting capital a trader should obtain before possibly going into futures markets?
So I think whether you're going into futures or equities, it's likely to be the same. The thing I always recommended, and it seemed like not many could do it, is the minimum amount you should be trading is really $25,000. That's a minimum amount. That gives you the ability to make mistakes. And your loss should be based on what your account value is. So with $25,000, you should be able to get many samples of trades under your belt, and still have, $10,000 left once you figured it out. What most people do is they come in with $5,000. Some brokerages take $2,000. That doesn't give you any room for error. And believe it or not, just like learning to ride a bicycle or learning to walk, you're going to fall. There's no way to avoid that. So stop being afraid that somehow you're going to lose money. You're guaranteed to lose money. It's part of the process. You cannot exhale without inhaling. An arrow cannot move forward without being pulled back. This is the same. You're going to have to lose money to learn, because it's part of the learning process. And so if you're going to lose money to learn, then you want to minimize the risk, and you want to have as much capital as possible to allow you to take the losses. It's just part of your tuition, and still have enough remaining to continue to practice and be in the business. So to me, $25,000 is the absolute minimum, and you should expect to probably lose at least half of that. And I'm saying this with a very strong statement. Losing half of it means you are a disciplined trader controlling your risk, and you will still lose half of it probably, based on my experience. And that is okay, because when things get going on a futures contract with the leverage, making that $12,500 or $13,000 or $15,000 back is not that uncommon in a very short period of time. When I made the turn, once I hit $1,000 on a day, putting up $400, $500 on a day was fairly straightforward. And all I had to do then, and this is what I did, the main reason my prop shop was successful is because I was an absolute Nazi about risk losses, about risk control and daily losses. I made a commitment to myself that if I exceed a daily loss or a loss limit on a trade, that I have to sit out the next day, which is painful because you expect to make money every day. And so even with controlled losses, controlled risk, you're going to experience losses. Just accept that this is part of the process. Most people come in and they think, I'll put up $5,000 in an Interactive Brokers account, and I expect to make a return of, 300% a year. Good luck with that. That's not realistic. The reality is it'll take a long time, because the key element, we didn't talk about this much here, the key element of the entire process of trading is your psychology, is your level of awareness of yourself, is your level of honesty with yourself about who you are and what your nature is. And most of the losses, and take this from a guy who's turned traders around and made them profitable for myself, for my own prop shop, most of the cost of my operation in turning a trader around was invested. I would say 80% of the losses that a trader took when they're learning was the cost of them adjusting their behavior. It's not about, oh man, I'm losing money, so I better learn a new indicator. I'm losing money, so I better get on this forum and find out what this guy is doing. Oh, I don't have a good enough charting system. Oh, I need a more powerful computer. None of that's going to help you. Most traders, after the first few months of studying technical analysis, studying fundamental analysis, if that's what they want to do, enough technically. It's not the technical end of things that is turning you around that's causing the problem. The problem is behavior modification. is your ability to do what's right, even though emotionally and instinctively you want to do the opposite. A market's running up. What do most traders want to do? They want to see it get weak and I want to sell it. Well, maybe it's running up for a reason, and selling into a run up is just a pause before it continues to run up. Your instinct is not to buy it after it's run up. Your instinct is to sell it after it's run up. But selling it after it's run up has a low probability in most cases. Things like that. Stopping yourself from getting emotional is a key one. Being aware that you're angry, that you are afraid. It doesn't mean I'm never going to tell you to control your emotions. It's a very, very hard thing to do. But your losses and the amount that you're investing, the capital that you're risking, the overwhelming majority of it will be spent on you, on the time it takes you and the experience it takes you, the cost of the experience it takes you to change the way you behave and to accept who you are as a person. Look, I get emotional about losing. I don't like losing. I hate losing, so I fight. I continue to fight and fight and fight and fight, even though I'm clearly out of sync with the market. That's not a good plan, and that'll cost you 20% of your account before you stop. Maybe. For some people, I've watched people melt 80% of their account away before they stop, before they realize, oh my God, this isn't working. That's a very expensive way to learn. If you're going to lose 80% of your account, do it on 3,000 trades, because you're picking something up on every trade. But if you start with $2,000 or $5,000, how many trading samples are you going to get? How many experiences or notches under your belt are you going to get before your mind starts getting the concept, or you start to internalize the concept of what it takes to make money? Does that make sense?
Absolutely. No, great answer. Another great answer. So, yeah, very good. Let's just run through one last question and then we'll wrap this up. And this one came through on Twitter. It was from Alexander. And he's asking, what's the importance of giving back and leaving a legacy? So I think you've got something interesting to share on this. So keen to hear your thoughts.
So a question came up during one of the interviews as I was recruiting a trader into my prop shop. And it was a college grad, and he said, I know I could be good at this, but why do people do this? Like, what's the point? It seems kind of selfish what we do as traders. You're just going there and you're clicking, and it's very capitalistic and it's very self-serving. We're just after the money. What's the purpose? Well, the purpose of trading, your purpose as a trader, is something you need to believe in and be aware of. Your purpose as a trader is to create an orderly market. The idea that day traders exaggerate moves or create volatility is absolutely false. My participation in the market allows much, much bigger traders, bigger institutions, to have more prices for them to get in and out of the market. So I serve the market in that sense. Much like a car dealer exists for the purpose of taking cars out of factories, holding them in his or her lot, and helping people have a selection and buy a car and enjoy the inventory that he has. We traders have inventory. Every time we have an open position, we're holding inventory. And if I didn't exist, then imagine a factory making a car and trying to sell it directly to the consumer. It would be very difficult to do that. It would be much more expensive. And so there's that service that we provide. Imagine the spread that would exist in Goldman Sachs if traders were not in there. You would have, multiple price levels. You'd have multiple ticks that are blank because there's nobody there willing to fill those in, and that's what we do as traders. So on a day-to-day basis, I know that I'm dampening the market's volatility by taking the risk in the inventory from those who want to sell or those who want to buy, and holding it for a period of time, and I get paid for that risk. That's my purpose. I help regulate the cost of, I'm just a little drop in the bucket, but I still help regulate the cost of crude oil or cotton or whatever it is that I'm trading. But the end result of what I'm doing is I've got a big trading account. Great. I live off of my trading account. I can buy nice things with it. But your legacy has to outlast the material purpose of your existence. As a trader, I control my time. I control where I trade, when I trade. It's one of the beautiful things about this business. If I do that for myself, then I'm really not serving a purpose for a greater society. And so it's important to give something back. It's important to help others. If it weren't for that friend in a meditation retreat who took me in and showed me the basics, I would still be grinding away working in a construction firm somewhere. Not that there's anything wrong with it, but I've lived a much better life now than I did when I was doing that. He took the time to do that. It's my obligation to do the same. This is why I share openly what I do on Twitter. I have, I think, almost 24,000 or 25,000 followers on there. This is why I have so many videos on my website. This is why I've created a Stage 5 trading. It's because if I help someone else achieve the independence or achieve their goal of wanting to have better control of their life, then that person is going to feel obligated at some point to give back to their community. This is why I run a charity. It's another way of giving back. I have the ability, and I'm lucky enough to be able to do that, to control my time, volunteer, and so on. So that's what I do, because ultimately, even if I were the greatest futures trader in the world, who cares? Who cares? Ultimately, my legacy is in my children. My legacy is in how I helped others achieve their goal. In the end, it's a small blue planet. It's a very tiny place that we live in. It's a tiny little dot in the galaxy. If I help other people achieve their goals, then it's just human nature. There's no way that they're not going to do that and pass it on. And in one way or another, I get to benefit from it. Not to mention the fact that when I started backing people and training people, I went from being an okay trader who made money. I think my first year at the prop shop, I made like $300,000. And that was okay. But once I started to back people and really pour my heart into their success, as opposed to just giving them a trading account, giving them a trading platform and saying, make me money. No, I would pour my heart into them. I would make sure that they are successful before I hired the next guy. And that's a huge part of my success as a prop shop. Once I started to do that, I started to really learn the business. I started to really learn how I react, why we do the things we do when we don't follow our rules. I started to really understand the ins and outs of what it takes to trade by helping others. So having had that experience directly made it clear to me that I have to continue to give. And I love this business. I love trading. It's a passion. It's not a job. It's not work. It's not painful. It's something that I'll do all day, every day if I could. So if I can go and talk about it, if I can provide something, if I can help someone out, if I can do an intervention like I've done many times, someone who's struggling and is about to give up, if I can do an intervention and look at their statistics and look at their performance and say, here's what you need to focus on, get back to me once you've done 50 trades this way, something lights up in them. And when something lights up and they see some success, they have an obligation, a human obligation to do that for someone else, be it their brother, their friend, their cousin, some stranger on Twitter, or whatever. What you're doing, Aaron, with these chats with traders is you're creating a legacy. You're creating a legacy for other traders, and you're improving the legacy of each one of your guests, including myself, by creating a recorded record, a recorded archive of what we're doing, right? You're serving me, I'm serving you, we're both serving other traders. It's a small community, and I'm driven to continue to do what I can within limits. As I get older, I'm 43 years old. That's why it's Futures Trader 71. I'm 43 years old. My time is becoming more and more valuable. So my time is focused more and more on just building that legacy, more so than building wealth or whatever. So this is a very important topic, and I think ultimately all traders have the obligation to do something that helps the greater good. That's the whole purpose of money. It's not to hoard. It's not to throw it in 6 Porsches and a big mansion. That's meaningless when you're dying. What's important is, what have you done with your money to improve the flow of prosperity in the community that you're in or around the world, as you and I are trying to do.
Very, very good answer. Well said. So thank you very much for going into such great depth with that answer. And big thanks to Alexander for asking that question too. Obviously led to a very great answer. So, all right, FT, well, we should probably wind this down now. So before you go, do you want to share with listeners where they can go to find out more about you?
The best way to get a hold of me is really on Twitter, Futures Trader 71. My website's futurestrader71.com. If you want to be involved in the day-to-day participation and help and context and all that stuff that I do for our brokerage clients, our traders within our brokerage, then check out stage5trading.com. I'm not a broker. I don't sell things. I'm not interested in selling you on anything, but I do look at everyone that joins there as almost like a prop guy, and I do what I can to make sure that they stay in a business, that they continue to do this passion, to follow this passion. So futurestrader71.com, futurestrader71 on Twitter, or stage5trading.com. Those are the best places to get a hold of me. You can always contact me through those any one of those venues.
Excellent, good one. And I'll make sure to put those links in the show notes as well, so anyone can visit them through any means. But this has been phenomenal. So thank you so much for giving up your time today. I mean, it went for a little bit longer than we expected to, but I don't think anyone's complaining. So thank you very much for doing this.
Thanks for having me on. It's an honor.
All right, no trouble. Take care, and let's talk soon.
Take care. Bye.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Home-based, ready to trade the pool? Click the
Tasty Trade has tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA.
What's going on? Hope you're all doing really well. This week on the podcast, I've algorithmic trader Kevin Davey, who, like many guests in the past, he comes from a background in engineering. And I don't know what it is, but there's something about these engineers, they just seem to make really great traders. After getting off to a bumpy start roughly 25 years ago, Kevin has come a very long way since then. Between 2005 and 2007, Kevin competed in the World Cup of Futures Trading Championship, where he finished in first place once and second place twice, each time with returns in excess of 100%, so he did very, very well. Kevin is also the author of Building Winning Algorithmic Trading Systems, a book which has been well received by the trading community and has plenty of 5-star ratings and reviews on Amazon. During this interview, we cover the great focus Kevin places on trading multiple strategies in multiple markets to achieve a smoother equity curve. So we kind of hit on a little bit of diversification. It's very interesting. And he also walks us through his development process for taking an algorithmic trading strategy from objectives and initial idea through to total automation. Plus, we cover plenty more as well. And even if you're not familiar with this side of trading or this particular style of trading, you shouldn't have too much trouble keeping up because Kevin does an excellent job of explaining everything. Now guys, just real quick before we get into it, I'm going to ask once again, if you haven't already done so, could you please leave a very brief review on the podcast and iTunes? I can't express how helpful this is. It's just a really easy way that you can support the podcast. So if you can do this, just go to chatwithtraders.com/iTunes. Again, huge help and I really appreciate it. All right, I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest, Kevin Davey. Hey, Kevin, great to be speaking with you. How's it going?
Great. Well, thanks for having me, Aaron.
Absolutely no trouble. It's my pleasure. I mean, thank you for coming on the podcast. We've been speaking for a little bit beforehand, and I mean, we're going to dig into some really interesting topics here. Algorithmic trading will, of course, be the big one. And I know you've got plenty to share on this, so it's going to be good. But before we get into trading specifics, let's cover your background and the journey you've been on to getting to where you are now. So, Kevin, tell us about your introduction to trading, and if you could, take it back one step further and give us some background about what you were doing before this time also.
Okay. Well, my introduction to trading was really, I got an ad that came through the mail that said, hey, you can make a ton of money by trading commodities. And at the time, I was a couple years out of college, and I didn't even really know what all that was. I had just started in a career. I was in engineering, actually aerospace engineering. So I was working on fighter aircraft, and I was just starting to get settled in a career and started to have some money to invest. And I saw this about commodities, how you could make all this money. And I think the example I was given was actually sugar. And it showed, hey, if you bought sugar all the way up here, you would have made, hundreds of thousands of dollars kind of thing. And so at that point, I was like, wow, this is pretty cool. And so that kind of started it and started me down the road of, doing research and, of course, opening an account, because everybody's always excited to open an account as soon as they can. And within, I don't know, a few weeks, I lost 10 or 15%, 20%, something like that. So then I did the reverse of the strategy I was trying to trade, and I lost a bunch more. And all of a sudden, my account's down like 60% in a very short time. And so, but by that time I was kind of hooked. I was like, wow, well, if I can lose money this quickly, I could probably make it this quickly. That was my naive way of thinking. And that really just had me progress down the road of trying a bunch of different things over the years. Most things didn't work. And then eventually I kind of started to do more mechanical trading system. I always liked the rule aspect, actually, from like day one. But there were times where I did discretionary trading and that type of thing. And eventually I just kind of settled on, hey, these mechanical algorithmic trading strategies that you just follow the rules and just execute them. And if you've evaluated them right and tested them right, they should produce, some kind of profit over time. And that's kind of where my journey's led. And that's what I do today, is just create strategies and trade a lot of the ones that I have. And I always have new strategies waiting to go in case something happens some of my existing ones, and I just continue on that journey.
Excellent. Yeah, that's really good. So let's not brush over those first couple years, and I'm keen to hear more about what was going through your head when you lost sort of around about 60% of your initial capital, and you decided to, take a step aside and reassess things. Like, I mean, most people, I presume, would probably do that once they've run out of capital to actually trade with. They'd step back and then rethink things. But you sort of noticed that this isn't going right. I need to do something here. So what was your next step from there? Like, what were you learning? What were you studying? And how did you go about this?
Okay. Well, really, what happened after, I almost blew out that first account, I kind of took a step back and I just started reading as much as I possibly could. So at the time, this is about 25 years ago, the internet didn't exist, so there weren't all these trading websites and forums where you could get information. So a lot of it was just books and magazines, some of the trading magazines, and I was just kind of devouring all that. As much as I could possibly get information-wise, I did. And it didn't really matter what style of trading was discussed. It was just talking about trading, and that's what really interested me is, I was just kind of on a fact-finding mission that I just wanted to see what other people did and how other people succeeded. Maybe that would help. And, I looked at things like, obviously, like Elliott wave and Gann theory and all these different things. And, I kind of said, well, hey, that doesn't really fit me, or this kind of does. And eventually I got to the point where I started testing some of this stuff. And at the time, I don't even know if tools like TradeStation or anything like that was available to do the testing. So I was doing a lot of the testing by hand. I had done some computer programming before. So I got a hold of some data and created my own trading systems and a way to evaluate them. And I did that for quite a while. And, that whole thing led down the road of over-optimizing, curve fitting, too many rules, too many parameters. And, you'd get these ridiculously good results, and they'd be like, oh, well, I didn't even include commissions on that or slippage. Didn't even really understand at the time what slippage was because I hadn't traded that much. But eventually, over time, I started to realize that, hey, most of these systems look so good, but they're just bogus. They're not going to work. I kind of knew that just from my experience getting creamed right at the beginning. So I was just able to kind of keep on and develop more systems, but not actually trade them right away, and just kind of watch them. And eventually I got to the point where I felt comfortable enough to actually start trading some of these things. Now, the problem was I was working full time, so I couldn't place orders all day long. I had to do like end of day systems. And at the time, there really wasn't software to, at least for a retail trader, to even automate things that would never even entered my mind. So I was just doing these simple end of day systems. And, on and off, I had some success. And along the way, I did a bunch of other things. I looked at things like scale trading, where you buy on a scale down and you keep adding to a losing position, and I got killed with that. So I was doing other things along the same time, but eventually I just kind of settled on this mechanical type trading. And make a long story short, eventually I actually had a little bit of success. And then once that happened, then I started to get some confidence in what I was doing, and that kind of led me just to where I ended up today.
Okay, no, that's excellent. So if we had to boil it down to just one or two of the greatest challenges you experienced earlier on, what would you say these were? I mean, I think it's really good to highlight these because a lot of listeners can really resonate, and perhaps if they're having similar challenges, learn about how you overcame these challenges. So, I mean, you kind of mentioned curve fitting and that, but was there anything else that you really struggled with early on?
That was probably the biggest thing. I guess I would generalize it a little bit more. Learning how to properly test and evaluate a strategy. That was the biggest challenge, because there wasn't a whole ton of information out there about that back when I started doing it. And, even the stuff I read probably didn't sink in enough, because, until you actually do some of it, then you become more experienced with it, and then you realize, oh, this guy in this book was making sense, and I didn't understand it at the time. But even when I started using tools like TradeStation, which is what I primarily use now, unfortunately, the way they set up the software, it makes it really easy to make a lot of bad decisions. The easiest thing to do is you open up a chart, then you insert a couple strategies, and then you optimize it, and then you get the best results, and then you go and trade it. And a lot of people still do that. And, and I certainly looked at that either in the stuff I was custom doing or when I actually started doing with TradeStation. So, and that's totally the wrong approach to take. It leads to so many bad things that I can't even describe them all. But that's probably the biggest challenge, is knowing how to test and evaluate the right way.
Okay, sure. And you also mentioned in your previous answer that you were still holding down a job for quite some time while you were trading. So at what point did you feel comfortable and confident to take the leap and make that transition to trading full time?
Well, I think I did this in 2007 was actually when or 2008, I'm sorry, when I actually made the leap. So I've been trading full time for over 7 years now. And what happened was in 2005, 6, and 7, I finished in the World Cup of Futures Trading Championship. I finished in first place one of the years and second place the other 2 years. And so it was 3 years in a row. I finished in first or second. And each of those years I had over 100% return. So that gave me quite a bit of confidence that, hey, I kind of know what I'm doing. Maybe I should do this full time. And the way it worked out career-wise with what I was doing, I had an opportunity to leave the company I was working with and get basically like a lump sum of money at that time. And so I thought, well, hey, that'll help keep me going as I start to transition to this full-time trading, because the last thing you want to do when you're a full-time trader is be sucking off your account to pay for living expenses. And eventually I had to do some of that, but at least this gave me a little bit of room. But the biggest thing, with just going full-time, I probably, looking back on it, I think I started not too soon, but with way too little capital. And if I had probably 10 times the amount of capital to start with, I would have been a lot better off back then. But, that's one of those things, you think you have enough, and then you start doing it, and you realize, ooh, when you start getting into drawdowns and you have to withdraw money too for living expenses, it becomes psychologically, it really kind of hits you.
Yeah, absolutely. And I mean, that's very impressive that you were able to take out the winning spot on several competitions there while you're still holding down a part-time job. I think that's very cool. And I can definitely see how that would be a huge confidence boost. But even still, I mean, did you notice, were there any notable differences in your trading habits when you did transition to full-time trading? Like you didn't have the regular income any longer that you could rely on and fall back on. Did your trading habits change in any way, shape, or form?
Yeah, especially in the beginning, because now I had all day to trade basically, and that was part of the problem because I started to do some of that where I just started to do some discretionary trading, which I really couldn't do, having a full-time job. Obviously, I couldn't really trade during the day. Now all of a sudden I had the time to do it, so I said, hey, why don't I try doing some of this discretionary trading during the day? And that didn't work out too well. Otherwise, I'd be still doing it. But that was a big thing. And the other thing was just becoming disciplined enough to say, okay, well, now I have all this extra time, but I've got to be working more on systems and new strategies and that type of thing. And that was something I really probably wasn't prepared enough for. But after a few months, I kind of realized that, wow, I've really got to step up what I'm doing. I think I was kind of in the mode initially that, well, yeah, I'm full-time trading, but it doesn't mean it has to take up all my time. And after a few months, I realized, well, I'm not going to survive doing that. So I got to be working a lot more. And actually now I bet compared to what I used to do career-wise with the part-time trading, I'm sure I'm spending more time now doing the full-time trading.
Right, okay. So let's now talk about what has been working really well for you. So Kevin, if you could, tell us how you would describe your style of trading as far as markets, timeframes, and approach, etc.
Okay. Well, what I do now is I'm looking any markets, really any time frames, and any kind of strategy. I try not to pigeonhole myself and say, well, I'm only going to look at the ES, or I'm only going to look at crude oil, or something like that. Basically, any liquid market is fair game. And then time frame wise, I'll look to develop strategies that are intraday. I don't have as many of those because those are just harder, I think, at least for me, to develop. But I have a lot of swing systems that last days to weeks. I even have some systems that last up to months. So different markets, different time frames, and then completely different strategies. I will, if I find something that works in a particular market, I might try to apply it to different markets and see how it works. But for the most part, I don't necessarily expect that to happen or demand that it happens. Some people say, well, hey, I need a strategy that works in 10 different markets or I'm not going to trade it. I think that, I understand why they're saying that, but my experience is you don't really need that. You can find, I have some strategies that only work in one particular market, but they work pretty well. And so I will trade them. So that's kind of where I've gone. So I just develop systems for any market, any time frame, and any kind of strategy. And as long as it meets certain goals, and it was also developed using the development process I normally use, then I'm good to trade it. And so right now, for example, I think I'm just over 80 different strategies that I'm trading, either automated, some are manual, but all different kinds of markets and that type of thing. So, for example, when the ES crashed, and then it went back up a week and a half ago, I was short quite a few ES put options. And my options, because I do option selling as part of how I trade, and those options accounts got really nailed where they lost probably just over 15% of their account value in 1 month. But I was also trading all these other strategies that, aren't option strategies. There's plain future strategies, and those made up for it. So overall, I was able to make money for the month of August, but that really speaks to, I think, some of the diversification I was doing. And that's kind of just probably where my trading will be going from here, is just developing more systems and just trying to diversify more.
Okay, and I know you're obviously very big on diversifying and having multiple systems, trading multiple markets simultaneously. What's like, you've mentioned some of the advantages there, but like I think there's additional advantages as well. Like, does it also help smooth out your overall equity curve? And is there any other benefits that make this such a important piece of your trading success?
Yeah, absolutely. I mean, the equity curve smoothing has always been one of my goals, and one way I measure that is just my monthly returns, percentage returns, measuring the standard deviation of those returns, and it's gone down by a factor of, I think, 3 or 4 in the last 4 or 5 years, as I've gone from probably trading 5 strategies or so to getting up to where I'm at now. So that's one of the huge benefits of it. The other thing, there's a couple other things that are kind of interesting that people probably don't think about initially, but let's just say you're trading 20 strategies, for example. If you allocate capital to each one is 5% of your account, roughly. And if one of those strategies breaks, it's not going to kill your account. Yeah, it's going to hurt, but you've only allocated so much to it that it's not going to wipe you out. Where people trading one strategy, if that strategy does bad, it just wipes them out. The flip side to that is trading one strategy, if it does really well, then you'll have higher returns. But as a full-time trader, I'm not really aiming for those super huge returns anymore. I'm aiming for something that's a little more consistent and that will tend, what I hope is, last longer. So I'm willing to give up some of that upside so I don't have that downside. And the other big thing with trading a lot of strategies that probably not a lot of people realize is it becomes really hard to, what I would say, cheat on a system. And by cheating, I mean, you'll see a signal, even if it's automated, and you'll say, oh, it shouldn't be doing that. There's a Fed announcement in a few minutes, so I'm going to turn that strategy off and exit that position. That's what a lot of people do with their automated systems or even mechanical systems that are manual. They'll override them and turn them off. That's not good, because now you're going against what your historical testing said. It said to do something, now you're doing something else. Are you going to make it better or worse? I don't know. Probably you'll make it worse, but the point is it's different. But yet when you have 20 systems, it becomes really hard to cheat on those systems, because you're going to be overwhelmed. Oh, system A, am I following it or not? I don't know. Well, system B, I know I'm doing the exact opposite of what I should be. And you're trying to keep track of all this. It's much easier just to let the systems run and then deal with the consequences of that, which means, you put things in place to quit those systems that are bad, but you don't overrule them with what you're doing. So that's one of a big benefit of trading a lot of strategies.
Okay, sure. Yeah, now you hit on a lot of really great points there. Thank you for sharing those, Kevin.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including high trading volumes, dividends, and smart order SIPC. Have you U.S. stock market? Bypass the PDT and tap into over 12,000 U.S. listed
to algorithmic or systematic trading. And in your opinion, what are the major benefits?
Start trading with Trade the Pool's capital.
Now, maybe I should have asked this a little bit earlier, but what actually attracts you to algorithmic or systematic trading? And in your opinion, what are the major benefits of this actual approach?
Well, I think the biggest thing is you can evaluate it before you start trading it. And that to me is huge when you start thinking about your confidence in something. I know a lot of people will look at a chart that'll be of 2 weeks and they'll see a certain pattern and they'll see 5 instances of it and 4 of them worked and they'll say, hey, that's good, I'm going to go. Well, to me, that's just awful. It's an awful habit to do. So I want to evaluate something and I want 100 trades, 200 trades, 500 trades. I have some back tests going back that have like 2,000 or 3,000 trades. That's the biggest benefit, I think, because I know over history that it's worked. Now, does it mean it's going to work going forward? Well, absolutely not. But all things being equal, would you rather trade a system that you knew worked in the past and you were hoping it would keep working in the future, or would you want to trade one that either you didn't know how it did in the past or you knew it lost money in the past? In that case, I think the answer is pretty clear. You want to go with what's worked and take your chances with that. And that's probably the biggest thing I get out of mechanical trading. I can look at history and said, well, yeah, this has made money in the past, and therefore I'm willing to take a chance with it working in the future.
Sure. Okay. Now, those are some great benefits, but as we're constantly reminded, there's no such thing as the quote-unquote holy grail when it comes to trading. So what are perhaps some of the cons or some of the negatives that come with being an algorithmic trader?
I would say probably the biggest con that people tend to fall into is they try to make a holy grail. And the way they do that is they will go through and they'll run a test of 5 years, 10 years, and they'll get some results, and the results will look pretty good. The equity curve kind of goes up and it looks decent, but they'll say, oh, I can do better. And they'll go back and they'll add some rules and filters, and then they'll look at, oh, it looks better, and then they'll go back and they'll look at the results and say, oh, if I didn't trade on a Tuesday, my results would be a whole bunch better. So they take out Tuesdays. Of course, the equity curve looks better, and they keep doing that. And they fool themselves into thinking because they made this better looking back test, this historical test, that it's going to continue on into the future. And that's usually not even true. And the exact opposite is usually true. It's kind of strange, but the more you try to make something better, the more you try to perfect it, the worse it actually becomes. And that's probably the biggest trap that I see people falling into, and the biggest con or disadvantage of algorithmic trading is people think because they can test, therefore they should do everything possible to make the test great. And that gets a lot of people into some serious trouble.
Okay, but in saying that, is there still, to a certain extent, it's a good idea to try and optimize your strategy? Like, is there a thin line between optimizing and then over-optimizing and curve fitting?
Oh, yeah, definitely. I mean, I still optimize. I use what's called walk-forward analysis, which keeps data out of sample. And so I'll optimize over a certain period, but then I'll apply those parameters to brand new data and see how it's done. And I'll do that approach. And that works a lot better than just traditional optimizing. But even that, where people get messed up is they'll get results that are walk-forward results, but then they'll go back and change their system 5-10 times, and then all of a sudden what they think is out of sample data isn't really out of sample, because they've run it so many times. So yeah, there's definitely a fine line. And I always tell the story that I have some systems where I have 2 or 3 lines of code almost, I have a line for entry and a line for exit, and maybe I'll optimize. There'll be something to optimize on each line, so maybe 2 variables to optimize. And if that looks decent, I will stop there. And some people think that's crazy. They'll say, well, you got to add more filters and more, conditions. And, that doesn't seem to work. I mean, I know people who've spent 5-6 years currently working on one particular system, and they have thousands of lines of code, and they're no better off. I mean, they've just over-optimized to the nth degree. And, I guess my rule of thumb always with this is if you start to feel a little uneasy that you might be doing too much optimizing, you've probably already gone past that point where you have. And it's definitely time to stop at that point.
Yeah, that's really interesting. Just a couple of the words or the terms you used in there. I just want to make sure that listeners understand. So there's a couple you mentioned there was out of sample and then walk forward. Would you mind just explaining what those two terms refer to?
Okay. Well, if you're doing any kind of back testing, normally what most people do is they will test up until today and optimize, and then take those parameters and start trading them. That would be optimization with it's all in sample, because by in sample I mean they've made their decision based on optimized data. So that's the first one. But then there's some people who said, well, I'm going to test for 5 years, but then leave the last 2 years of history. I'm not going to optimize that, and I'm just going to apply those parameters to those 2 years and see how it did. That's an out of sample test. So you optimized on one set of data, but then you applied those parameters to another set of data. That's an out of sample test. And then the walk forward is actually just a process that kind of takes that to a further degree, where you optimize and put it to a set of parameters for a limited amount of time. Then you optimize, you move the optimization, you walk the optimization window, and you apply it to another set of time. And basically what you do then at the end is put together all these pieces of out of sample periods together to get a full out of sample curve. And if you do it right, it really is truly out of sample data that your system is being evaluated on. And that tends to work a lot better than a fully optimized system. Now, none of those are as good as live testing. Obviously the best test always is going to be live testing. And, you can certainly do that. And a lot of people, part of my process I actually do some of that, where even though I've done the walk forward testing, I don't go and trade something immediately. If I develop something tonight, I'm not going to trade it tomorrow. I'm going to let it sit for a while and see what happens in real time. And that seems to also help eliminate some of those systems that, we've all had them, that as soon as you start trading them, they go and start, they go into this huge drawdown. And you're like, why does this always happen to me? Kind of thing. But that kind of helps with it, just waiting a while, and which most people don't do.
Excellent. Thanks for explaining those, Kevin. That's really good. Now, I'd like to talk probably a little bit more about the actual development of a system or an algorithm. So if you could, maybe just give us an overview of your process for developing an algorithm. Like, if you could just briefly hit on each one of the stages involved, going from maybe initial idea through to actually going live with an algorithm.
Well, the first thing, even before you come up with the idea, you really have to know what your goals and objectives are. And most people just bypass that completely, but it helps set expectations, because if you're looking for a strategy that returns, say, 300% a year with a 10% drawdown, you're never going to find it. So you got to have realistic goals to start. Then, ideas. I talk a lot about what I call a strategy factory, which is kind of describes my whole process, where trading ideas come in the door, come in your factory, you work on them, and then what either comes out at the end is either a full-blown strategy that you can actually trade, or it's junk, which is what most ideas turn out to be. And, it just goes in the scrap heap. But it all starts with ideas. Ideas are your raw material. And if you run out of ideas, well, you have nothing to test, right? And part of the running a factory is having lots of ideas to go through the factory to test. And so I make sure I probably have at any one point in time 50 or 60 ideas of things I want to test. And honestly, I just don't have enough time to test them all. I wish I did, but I never lack for testing. I never say to myself, boy, I wish I had something to test. I can't think of anything. So you need that reservoir of ideas. So then usually what I do is I just run a quick test on it. You don't need to go through the whole process of running these detailed tests. A lot of times just a limited period testing, a simple test will tell you if your idea holds any water, if it has any merit to it at all. And that's a quick way to kind of go through a lot of ideas. So I do that. Then I go into a detailed testing, which includes the walk forward testing and some optimization. And assuming that passes, then I run some random simulations, some Monte Carlo simulations, because, just because a certain walk forward test equity curve looked a certain way doesn't mean that's the way it will happen in the future. You can take those trades and just mix them up and you get something totally different. So it gives you some more probabilities of what's occurring. So if that passes, and at each of those steps, there's certain criteria that I use to say, well, okay, this can go on to the next step, or no, it's junk, I'm giving up, moving on to my next idea. Once it goes through the random simulations, then I actually just put it in what I call incubation, but it just sits on a shelf basically for a period of time, and I go and check it periodically to make sure to see what it's doing. But then at the end of it, I'll say, yes, I think I'm going to trade it, or no, I'm not, or I need to evaluate it longer. And I just evaluate it once a month. And I do that right now probably with 100, somewhere between 100 and 150 strategies that I look at least once a month. And, at that point, sometimes I'll bring new ones in. And that's probably the last step is, you say, well, I've got this portfolio of strategies I'm trading, and I have some extra capital. So either I'm going to bring in more strategies, or maybe I'm going to increase the size of the ones I already have. It kind of becomes a trade-off. Should I increase size of ones I have, or should I just bring in new ones? And there's some criteria that I go through to determine what to do there. And that's pretty much it. And then I'll go live with it. And but then even once you go live, the important thing, you have to monitor those strategies, make sure they're actually performing, and you also have some criteria in place to tell you when you're going to stop. Most people don't think that's one thing most people don't think about. They don't think about when they're going to stop trading a system. Especially, think about it. You just created a system, and you're all excited about all the money you're going to make. The last thing you're thinking about is, well, what if the strategy doesn't work? What do I do? Most people don't think about it, but that's exactly the time you should be thinking about it. And you should say, hey, if the strategy does this, if it has this kind of drawdown or whatever, I'm going to quit trading it. And that kind of completes the process, and it's kind of the loop back to monitor your performance. And then it just becomes almost as simple as it sounds. It's just doing that process again and again and again, hundreds of times to create new strategies.
Okay, so have you ever had a situation where, like similar to what you just described, you've gone through all this testing and this process, you've gone live with a strategy, only to find out that it's not performing anywhere near as well as it was during the testing phase, and it's actually given you quite poor results. Have you ever had an experience like that, and how did you treat it if that's the case?
Oh yeah, definitely. I mean, whether it's I do something wrong in the testing and I don't even realize it, or the market's changed. For example, in my book, I have a couple Euro systems that were doing pretty well up until mid 2014 when volatility started to reach record lows in the Euro, and then those systems stopped working. They really haven't recovered at all, even though the volatility's picked back up. But the structure of the market, I think, has actually changed a little bit. So yeah, I definitely have some that don't quite work out. And the big thing I do is I just say, well, here's my criteria for when I'm going to cut that strategy out of the portfolio. And, because otherwise, if you don't do that, you could eventually get to the point where the strategy just takes over and ruins your account. And you don't want that. You want to cut those. It's just like trading. You want to cut the losers and let the winners run. And whether that's a particular trade or if you look at a bigger picture of strategies, you want to do the same thing. You just want to cut your losing strategies before they get too bad.
Okay, that's an excellent point. Now, I feel as though many people may perceive algorithmic trading as an area that is probably quite daunting. Do you feel like this is actually an accurate assumption, or do you feel like it's probably not that much more difficult to learn than it is to become a good discretionary trader?
I think there's two different skill sets, because if you want to become a discretionary trader, I think it's really important to understand the market and understand price action and that type of thing. Where if you're being an algorithmic trader, that might not be as big of a concern. So, and what I mean by that is a lot of times I'll see an idea and I don't know if it's good or bad based on my market knowledge. So what I'll do is I'll just test it, and that will tell me if it's good or bad. So in that respect, you don't necessarily have to be, a deep market theorist to be good at algorithmic trading. What you really have to be good at is your approach to evaluating ideas. And you have to do that properly. And if you don't do that properly, then it's that old computer phrase, garbage in, garbage out. If you don't do things right, you're just going to get garbage, and you think you're going to have these great results, and you're not. But normally what I tell people, as long as they can program even simple strategies in whatever trading platform and, if they can test simple strategies, they probably know enough to at least take that next step and learn how to test properly. As long as you can do that, you're good enough. Some people think they need to spend years of coding with their particular software language to be able to trade algorithmically. And actually, I think that is more of a detriment because you don't need to do a lot of fancy things. For example, I have systems that the entry is literally if the close is greater than the close of 10 bars ago, buy the next bar. I mean, that can be a simple entry like that, and that can work. And, you can put an exit or two with it, and those kind of things can actually work pretty good. And my philosophy always is, well, the simplest things usually tend to work the best going forward, because what you're doing, you're not putting a lot of demands on the market for the future. You're just saying, hey, if this little thing is true, buy. You're not saying, well, hey, if the momentum's up and the RSI is this and the ADX is this and your MACD is doing something, a lot of people think the more conditions they impose, the better off they are. And it's actually the opposite. The less you impose, the better off you are.
Okay, that's really good. That's an excellent point. And for someone who might be interested in moving towards algorithmic trading but doesn't know how to go about it, what would you suggest to them might be a good first few steps?
Well, obviously, probably reading my book once they get a little familiar, at least with the futures markets. That's a good one. There's other good system development books out there. Bob Pardo wrote probably the classic book a while back, and that's a good book. And there's books by Tomasini. One, it's called I can't remember the title offhand. I think it's called Trading Systems. Jekyll and Tomasini. That's a good book. So there's some good books that will give you some of the basics of testing. And then the other part of it is to actually just fire up that software, whether it's Ninja or TradeStation, Multicharts, OmniBroker, whatever it is, and learn how to program simple systems in that language, and do some simple optimization, be able to look at a performance report and see what's going on. That's the way you start getting a feel for this algorithmic trading. And once you get to that point, then it's, okay, well, now I'm going to learn to test the correct way. And then it's just a matter of programming lots of ideas and trying them out.
Sure, excellent. Okay, well, I'll make sure to put links to all those books you just mentioned there in the show notes. So if anyone wants to check those out, just go to chatwithtraders.com/38 and you'll find links on that page. Now, this is a question that actually came in through the Chat with Traders site, and I thought it was a really good one, and you're probably the right person to ask. Can you survive as a trader over the next 30 years without learning much about code?
Well, that's a good question. I personally would not want to, but I think if you are willing to spend the time sitting in front of your computer day after day, and I'm assuming you're going to be a discretionary trader, you might be able to do okay. I don't really know, because my world, I know a lot more algorithmic type, mechanical type traders, and a lot of them have had success. I don't know a lot of discretionary traders to begin with, so knowing that they are having success, I don't really know for sure. So yeah, that's I guess if you decide, hey, I'm going to go discretionary trading, it's possible. But obviously, if you want to do any kind of algorithmic, mechanical type trading and any kind of testing evaluation, I think you really have to learn to do some coding.
I think that's a good answer. And I mean, it is quite a tricky question, really. But I mean, Kevin, this has been really good. So let's just do one last question, then we'll probably wind things down. So I like to ask this to pretty much everyone who comes on the show. So if you had to sum it up for us, what's the main reason why you believe most traders never succeed?
Oh boy. There's probably a couple reasons. So I don't know if I'll be able to give you one, but psychology and having an edge. And the ironic thing is those two go together. So some people think it's all about psychology. Got to have the right psychology. I got to journal my feelings, blah, blah, blah. Well, that's great. But if you don't have an edge, all the psychology in the world isn't going to make you profitable. Okay? But even if you do have an edge, if you don't have the right psychology, so for example, if you're a mechanical trader and your psychology is such that you have to overrule the system, you're not going to be successful doing that. So you need both of those pieces, and if you only have one and not the other, you're still going to fail. And a lot of people don't get that. They think it's either all about psychology or it's all about finding an edge. And really the truth is you got to have both. And that's probably the biggest key out there.
100%. That's a brilliant answer, Kevin, and an awesome way to take us out. So before you go, can you share with listeners where they can go to find out more about you and connect with you?
Sure. My website's www.kjtradingsystems.com, and you can go there and read a bunch of stuff. And you can also, most of the pages have contact forms at the bottom where you can contact me, or you can just send me an email at it's kdavey, KDAVEY, at kjtradingsystems.com. Just send me an email. I'm just here trading pretty much full time, so I see all the emails. No one else answers any of my emails or anything like that, so they can reach me that way too.
Really good. And do you want to share the title of your book?
Sure. It's called Building Winning Algorithmic Trading Systems. It's kind of a big title, and then there's a nice subtitle. It's a trader's journey from data mining to Monte Carlo simulation to live trading. And in that book, I talk more about the process we kind of talked about today, Aaron. And in the beginning of the book, I kind of lay out my trading history. So it's more of a narrative in the beginning. And what a lot of people have told me is they kind of identify with a lot of the struggles I went through. But I think it's kind of important to see the struggles before you see, the ultimate success. Because a lot of people think trading's just all, hey, I'm going to start trading, it's going to be easy. And it's really anything but. I always tell people it's the hardest way to make easy money that's out there.
I like that. I like it. That's a book I'm really keen to check out for myself. So anyone who wants links, of course, everything will be at chatwithtraders.com/38, including a link to Kevin's book. And last of all, you're on Twitter as well, aren't you?
Yeah, it's my Twitter is KJ Trading, and people can reach me that way too.
Awesome. All right, very good. So go follow Kevin on Twitter, and Kevin, take care, and let's speak very soon.
All right. Well, hey, thanks for having me here today, Aaron.
My pleasure. Thank you very much.
All right.
You've come to the end of this episode. The best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's going on, guys? Welcome back to another episode of the Chat with Traders podcast. Thank you very much for tuning in. And this week we're up to episode number 39. Now, I had the great pleasure of speaking with Tom Dante, who many of you may already know from Twitter as Trader Dante. But if you don't, that's cool. I'll give you a real quick snapshot now. So Tom's a day trader from London who pretty much tells things exactly as they are. I mean, he makes no attempt to soften the blow from the harsh realities of trading. So, I mean, that's something we really value already. And he's got a really interesting and unique story about how he got started trading, which was around 1999. And from that point on, there was a period of about 7 years where Tom really struggled to gain consistency with his trading results. So that's something we dig into and speak at length about during the first part of this interview. Now, after developing a track record of profitability, Tom joined a prop trading firm where he learned many of the solid trading principles that have shaped him into the trader he is today, and again, many of which are discussed during this episode. Nowadays, Tom is an independent trader who focuses mostly on the bond market intraday, as well as other futures. And besides the few points I've mentioned already, we of course discuss much more, including the competitiveness of professional trading, the importance of learning from your mistakes quickly, and the real cost of becoming a great trader. Now, besides a standout guest on the show today, I also have some exciting news to share with you. Chat with Traders is now offering a new service to those who are serious about developing and moving forward as a trader. That is a dedicated one-on-one coaching service. Every week, I receive at least a few emails from listeners asking how they can find a trading coach or a mentor, like someone who has greater success, knowledge, and experience than they do themselves. But the tricky part of finding someone like this who is genuinely prepared to share pretty much everything they know in order to help you progress is, of course, finding them and then gaining access to them. And this is the reason why I'm excited to announce this, is because the barriers to intensive one-on-one coaching, I feel, have now been removed 100%. So there is currently 3 trading coaches on the Chat with Traders team who are readily available, who are prepared to block out their time and have one sole focus, which is to help you perform with greater results as a trader. And best of all, they can provide you with as much or as little ongoing support and mentoring as you need. So let me briefly introduce you to each one of these coaches. So we have Chris Sace, who was a guest on the podcast for episode number 33. He's a swing trader of equities, and he's been trading since around 2008 with a great focus on following trends and riding momentum. And we also have Zach Hurwitz, who many of you will remember from episode 11 of the Chat with Traders podcast, and he also featured on episode 25 as well. Now, Zach is a day trader of options and equities and has been since 2007, emphasizing intraday and swing trading of the volume-weighted average price, so a real emphasis on VWAP. And thirdly, we have Brad Jelinek, who was a guest on episode 26 of the podcast, and he's a prop trader and has been since 2003, with a strong focus on capturing intraday moves with global futures markets. So, all in all, 3 genuine traders who are there to provide you with the help, support, and guidance you need to continue improving. To learn more about this coaching service and to book a session with one of these guys, just go to chatwithtraders.com/coaching. In case you missed that, that's chatwithtraders.com/coaching. Very straightforward. And of course, if you have any questions about this, you can always email me. My email address is just aaron@chatwithtraders.com, and I can answer anything you're unsure about. Now let's dig into this week's interview. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest from London, UK, Tom Dante. Tom, what's up, man? Welcome to the podcast. How's it going?
Hey, Aaron. Thanks for having me. I'm really appreciate being here. I've seen the website. I've seen a few of your or listened to a few of the interviews, and they're really fantastic. So I'm really happy to be here.
Awesome. I really appreciate it. I mean, thank you very much for making the time to speak with me today or this evening for you. I mean, we've been trying to set this up for quite some time now, so we've got a lot to discuss. But so I mean, we're going to talk about your path to profitability in a fair bit of depth, because I think this will really resonate with quite a few listeners. We're also going to discuss your style of trading and just cover plenty of tips and pointers for other traders. So I think there's going to be a lot of value in this. But let's get this underway. Okay. And start with when did you first discover the markets? Like, what was it that appealed to you? How did you come across them? And even take it back a step further to let us know what you were doing before this time.
Okay, so it's 1999, right? And the market is on fire. But I don't know this. I mean, I barely even know what the market is, because I was 20 years old, and to be honest with you, I was more interested in girls. Now, my sister came home one day, and I heard her telling my mother how she'd saved a little money from her job and invested some money in the stock market, and how she was just making incredible returns. And I think many people kind of get started in the same way. They hear about the market from friends or family. But I was particularly keen because my sister is a very influential figure in my life. And just to give you a little bit of a backstory there, when I was just 3 years old, my father passed away from a sudden heart attack, leaving my mum, a widow in her 30s with 3 children, my 2 sisters and I. And I was particularly close with one of my sisters because she took a very kind of maternal role, really looked out for me when I was growing up. And she kind of became a second mother to me. And so the reason I'm telling you this little backstory is because it will really explain why I managed to become so enamored by the idea of trading stocks, because I'd be listening to her and I'd be hanging on her every word. And, she'd be telling my mother how she was buying these stocks, and boy, were these stocks paying out. And it was a period, as we know now, around the 1999, which we're probably never going to see again, where almost on a daily basis, stocks were just having these parabolic moves, and she would be literally doubling, tripling her money in unbelievably short space of time. Now, of course, I didn't jump right in because I was just 20 years old. I was still studying at the time. I had literally no money to my name. But her returns kept increasing. So eventually I kind of decided I better do something about this. I better get involved. And I scraped some money together and limped into the market. I say limped in because that is literally how I approached the market. I opened my first account with just £500, which is a very small amount of money. And right off the bat, I just proceeded to voraciously buy stocks. There was no rhyme or reason in it. I would literally look down the paper. If a company name appealed to me or there was a headline story on a company and it was positive, that was it. I was buying. And when I look back on it now, it was just a complete recipe for disaster. And I'll tell you why. Basically, the broker that I set up an account with, we had to pay £15 both to get in the trade and to get out of it. So that was £30 commissions for a round trip. Now, on a £500 account, that basically means the commissions account for 6%. So basically, to cut a long story short, the stock had to go up 6% for me to break even. And bear in mind that I could only go long the market. I couldn't go short at the time because the broker wouldn't allow it. So I had to be long only in one of history's major bear markets, with the stock needing to go up 6% for me to even make my money back. Now, I know the game is hard when you start out, but that's beyond hard and verging on the impossible. But I kept that up for several years. And a lot of the time when I tell people how long it took me to get profitable, people ask me, well, why did it take so long? And the reason it took so long is because I was just the idiot that does the same thing every single day, hoping for a different result. I mean, under those conditions, it would be incredibly hard for anyone to make any money, let alone a complete beginner. But there I was, just buying these stocks every day and losing money. And eventually the account would get blown, I'd refund it and start again, and the same thing would be happening. And, obviously from time to time, I did have, a few stellar stock picks by pure chance. I'd happen to stumble onto the right stock at the right time and it would shoot up and I'd actually make some money. But that kept me playing the game. And that's what keeps everyone playing the game, because you don't lose, every single trade that you make. Even the worst trader in the world is going to win from time to time. And as soon as you get that win, it fires you up and it reignites the whole dream. So it just keeps you going. And I remember, and I'm probably kind of paraphrasing now, but I remember a quote from Reminiscences of a Stock Operator where it basically explains how if you lost every single trade that you took, you would probably learn a lot quicker. Then what happens in actual fact is that you do have these wins. Sometimes you do, in fact, have win streaks as well. And you might not be profitable, but you put together a week, a fortnight, sometimes even a month or two of winning, and you think you've cracked it and you haven't. But it all takes so much time to find out whether you've made it and what's going on. At any rate, I kept up this losing process of buying these stocks and not making any money for 4 years, if you can believe that, before I really realized that essentially what I was doing is completely gambling and that I couldn't beat the market without being able to short, because that was going to be something that would massively help me if I could actually short rather than having to be long. So I was constantly against the trend. B, either having more money or getting lower commissions, and C, having a strategy that was a lot more robust than simply randomly betting on companies that I liked, the sound of. And then in 2004, I came across spread betting, and that is simply a derivative where we can bet on price fluctuations. It has major advantages for UK citizens because we don't pay tax on winnings. And that really changed everything for me because it opened up a lot of doors. It opened up doors in terms of new markets that I could trade. Like now I could trade Forex, commodities, bonds, stock indexes, as opposed to just stocks. And I didn't have such extortionate commissions. And what's more, I could go both long and short. And at this point, I thought, I've hit the big time. Now I've got what I wanted, and now I can settle down and start making money. And I nearly did, but not because I'd worked out a way to beat the market, but instead, I actually worked out a way to beat the broker. And I hit on something that made me a huge amount of money really quickly. And I'll tell you what happened. I often explain this in webinars, and people find this really fascinating. It doesn't happen so much these days, but I'm sure there are still opportunities if you look hard enough. But I used to open as many accounts as I could because they would give you bonuses to entice you in. So, for example, they might say, fund an account with £50 and we'll give you £150 to kick you off, start you off. So I'd open a lot of these accounts to get these bonuses. And one day I had 2 accounts open and I was watching the Dow, and it was a minute or two before 1:30. We had some tier 1 data to be released, and the news came out, and I noticed that the price moved with one broker and not with the other. And then it moved with the other about 6 to 8 seconds later. And I thought, that's odd. There's a lag there. Now, the next day I watched exactly the same thing happen. Well, by day 3, you better believe I was ready to capitalize on it. I would literally hit the market with the lagging broker, taking the directional cue from the faster one. So I'd see it go, and then I would know which way to basically trade and just hit the market. It was like seeing the future. It was absolutely incredible. And I made a lot of money doing that, basically capitalizing on the broker lag. And the best thing was that the broker just let me keep that money. Eventually, they did shut down that loophole, so their prices came in line, which was disappointing, but at least I got to keep the money. But that kind of spurred me on to search for more brokers that might be making these errors, and I came across several more where I could actually take advantage of mispricings. I remember one now, and I'm not going to give the name, but they would be erratically spiking prices every few minutes. Like you see, for example, crude oil would be, let's say 50 bid, 50.05 offered, and it would just be, quietly trading, and then suddenly it would have $1 spike up and $1 spike down in literally 2 to 3 seconds. And it wasn't the result of news, it was just literally the result of a pricing error with their algorithm that was pricing the market. And I would just, I'd see that and I would hit it. So I'd see it spike up $1. I'd know I could sell. And I'd also obviously have other brokers, and I knew that the price of oil had not spiked up $1. So I'd hit it, it would come straight back in line, and I'd make like 100 ticks, sometimes more in seconds. And these were literally some of the best days of my life. Like I was on top of the world because it was free money and I was making huge amounts. And it was that point right there where I knew that I was going to be trading for the rest of my life, because although betting on broker errors is not a legitimate strategy, by God, there are very little feelings like the ability to make hundreds, sometimes thousands of pounds in seconds. And you know that trading is a result of that. So I knew it had me hooked from that point then. All of these brokers, incidentally, with the exception of just one, let me keep the money. One just took it out of my account and wouldn't let me have my winnings, but all the others let me keep them. And eventually those loopholes all got closed down. And that is when, around about 2006, 6 years after placing my first ever trade, I had a fairly big pot of money, but now I had no means to make more because they shut these loopholes down. And suddenly I had to learn how to trade properly. And that really is when, the proper journey started, because now I had to look at the market and think, well, hang on a minute, I haven't got a guaranteed edge here, so how am I going to find an edge? And as I say, that's when the journey started.
Yeah, I mean, that's quite a story. It's a really interesting one. So, I mean, what was your next step from there? Like, as you said, you've got a big sum of money there, but you don't know how to turn that into more money. So what was your next step moving forward?
right? So at that point, what I started to do is I started to frequent forums, and I started to look around, and I started to try and learn how to trade. And of course, you know, I mean, at this point in time, I had very little understanding of technical analysis or fundamental analysis, because I'd literally been just looking at the ticker and taking advantage of, you know, of pricing errors. So I wasn't looking at things like head and shoulders, trend line, support, resistance, any of that. So I took to these forums and I started reading, you know, various different strategies, and I just started trading, and I started losing. You know, straight away I started losing that large sum of money that I had made, and I started losing it because I was just, you know, again, just trying things out, but with no real rhyme or reason. And then in 2006, I happened to come across what is called the James 16 group on Forex Factory. And I think it's one of the largest threads on that website. And I started to read the thread, read up on price action, begin to understand the dynamics of support, resistance, and market structure. And it really made sense to me. And I applied myself to it wholeheartedly, really studied it, watched the market with these frames of reference in mind. And I started to be able to anticipate when the market was going to react to levels and how far it was likely to react. So my ability to anticipate the market movements started to really improve after spending time studying price action from learning it from that thread. But despite the fact that I was able to now read the market and in many cases call the market effectively, I still was not making any money at all. In fact, I was losing a lot. And the reason that I was losing a lot is because I was just basically trading way too large. And the reason I was trading too large now comes kind of right the way back to the broker errors. Because I had made so much money so quickly, I thought that was, you know, that was standard, that was par for the course. So suddenly it doesn't seem exciting anymore to bet small when you've been used to making hundreds, sometimes thousands of pounds in seconds. You want to get that thrill again. You want to bet large. So essentially what I was doing is just betting way too big and having these big losses. And of course, that's why I wasn't really getting anywhere, because I would just, undo winners very, very quickly by just consistently betting way over the top of what I should be.
Okay, so during that time, was there a point when you thought, okay, maybe the good days have been and that they've now gone? Is this still appealing? Was there still opportunity? What motivated you to keep going from there, even though you'd been consistently winning and now you were consistently losing? Why did you keep pushing forward?
Well, what spurred me on was the fact that I could see that I could call the market correctly. So when you can anticipate market movements, you have a lot of confidence. And when you then fail to capitalize on them by really what can only be deemed as idiotic errors, you kind of berate yourself and you think, that was so dumb of me. But you keep going because you know that you can call the market, right? If you looked at the market and you just had no idea where it was going, and every time you came up with an idea it was completely wrong, I'm sure after a while you just think, you know what, this is ridiculous. I can't do this anymore. But it's very strange, and I think a lot of traders go through this, because I see it, as a mentor when I'm teaching traders. I see students say things like, right, I think the cable is going to bounce here. And lo and behold, cable has a perfect bounce right off the level they've anticipated. And I say to them, okay, so how much money did you make? And they'll say, I didn't trade it. And I'll say, well, why not? And they'll say, and they'll come up with an excuse. Oh, well, I took a trade before and it lost money, so I second guessed myself and I didn't take it. Or, what have you. Or I did take it and I got in and I got 5 pips into profit and then it stalled and I got nervous and got out and I didn't manage to capitalize on the big move I expected. There's always an excuse. But this is what I guess what I'm saying is that this is what spurred me on, because I could see that I had some talent. I just had to translate that talent into money, which is the hardest part of the game.
Absolutely. So at what point did you start to turn the corner and start seeing some consistency? Like, were there any standout aha moments?
What happened with me is that after a long while of betting too big, I had run my accounts right down. Like I was back to basically having to bet really, really small. And, you know, that was a problem for me. For a long, long time, my biggest psychological issue in trading was trading my P&L. It was a problem when I was trading too large, and it was a problem when I was trading too small. The problem when I was trading too small, and I see people talk about this a huge amount, I think it resonates with a lot of people, is that what would happen is, as a swing trader, I would sit there and I would wait. I would patiently stalk my trades. Okay, I never had a problem with anything like patience. But I could sit there and I could sometimes wait a day or two for a trade if need be. And I would then eventually get in the trade. But because my accounts have been so depleted, I would be back to betting very small. So I might bet something like £1 per pip increment that the FX pair moves. And I'd think, right, it's going to bounce from X level here to Y level here. And I would get in and it would have this, let's say, 30 pip bounce. And I would look at my P&L and I would be up, say, £30. And I'd think to myself, that's just nothing. That's just nothing for a whole day's work. So I'm going to try and run this trade. And you know what it's like. You come onto a higher time frame to try and justify running the position. So I go onto the daily time frame or the weekly or the monthly. Some time frame is going to corroborate the idea of running this. And many, many times that trade would just come right back on me. So I'd be up 40 pips, it's back and I'm scratching it. I'd be up 30 pips, it comes back and I'm scratching it, because I was always trying to run everything. I say this to a lot of guys when I hold webinars these days. I say, when people, they post on Twitter and they say, I'm in a trade and I'm up 2,000 pips on the euro dollar, and they point to where they got in on the chart like 3 months ago. Either they're a hedge fund or they're a guy trading a micro lot. I'm telling you, because it's very, very difficult to hold those trades for long, long periods of time if you've got sizable amounts of your own capital on the line. And it's, it is a bit easier if you've got small amounts of money. But as I say, I didn't want to take these quick exits because I just felt like I wasn't making a lot of money. So again, what I was doing is I was just trading my P&L. And the question that you asked me is, was there a point when I made that transition and I realized that I couldn't do this anymore? And there was a specific point, and that point was when I wrote to my mentor that was on the James 16 thread. And I was very, very disgruntled because I just couldn't make any money, trading my P&L. And I wrote to him and I said, this strategy is fantastic and I want to thank you for teaching me it, but ultimately I just can't make any money. I just keep trading my P&L. And of all the answers he could have given me at this point, right, to one of his students, what could he have said? He could have tried to help me get my, to get my mojo back, to feel good about myself again. He could have said, well, you know what, keep plugging away, or, don't trade your P&L or anything. He could have said anything positive, but he didn't. He wrote back and he said, well, you gave it a go, but I guess you're not cut out to be a trader. And when he said that, I was like, oh, no. You didn't just tell me that. You did not just tell me that. And that really spurred me on, because I'm like an ultra competitive person. And that's not always a good thing. Sometimes it can piss people off, but I am really, really competitive. And when somebody told me that I could not do it, that is when I was able to perform at the top of my game, absolutely at the top of my game. I've always been like that. If we get onto later in the interview, I'll tell you about how I got into prop. It's the same thing. I only got into prop after they initially rejected me and told me I wasn't good enough. So it's kind of like I need to be spurred on to do something. And when my mentor told me that I wasn't good enough, that for me was my breaking point. And at that point, I realized that, either you change your destructive behavior or you bow out of the game. That's, you've only got two ways you can go at this stage. But I was not going to be told that I wasn't good enough. So I absolutely I said to myself right then that I was going to trade as small as it took to grow my accounts, but grow my accounts is what I was going to do. And I was going to come back in 6 months, 1 year, however long it took, and say, well, you know what, you were wrong. I have done this. And as I say, that's what spurred me on, that competitive nature that I've got, that refusal to be told that I can't do something.
Absolutely. I think that's a really great trait to have, like you mentioned there. So, I mean, that was going to be my next question, was about how you got into prop. Like, why did you decide to go and trade within a prop firm instead of continuing to trade on your own? So tell us a little bit about that.
Right. So I was making money at this stage, and I'd kind of, as I say, I'd knuckled down. I was taking it seriously. I refused to trade my PLN anymore. I had to be very disciplined in order to just understand that I was going to have to bet small and grow, slowly, and that it wasn't going to be a sprint. It was going to have to be a marathon, a very cliched saying, but very true nonetheless. So I was making money and I was showing growth, but it was quite slow. And I'd often, I'd heard about prop firms, and I'd often wondered if I could kind of fast track my progress by having, access to more capital. But also at the same time, at this point, I've been profitable several months, and I started to think to myself, I wonder if there's any longevity in what I'm doing. I wonder how professional traders trade. I'm buying support. I'm selling resistance. I'm using Fibonacci levels. There's nothing massively complex about what I'm doing. Basic price action at the time. And is this how pros trade? And I wanted to know the answer to that. So I thought, well, let me see if I could get a job as a prop trader for a firm. So I made a kind of short list of firms, and one of the ones that appealed to me most was Futex, because they would let you trade outrights. Because a lot of the firms at the time that I found, they wanted you to trade spreads. So I went along to Futex to sit their assessments, and after sitting the assessments, I got a rejection letter. And I think that was most likely for my math ability, because we had to sit a math test, and my math is pretty poor. I mean, I got a C for GCSE, but it's pretty shit. So I failed that assessment. And when I got that letter through saying, okay, we're really sorry, but we're not going to take you, reading between the lines, you're not good enough. You're not of the caliber that we want. That then fired me up. And again, I thought, well, okay, I'll tell you what I'm going to do now. I am going to trade even harder, and I'm going to build a record, and then we'll see if I can get in. And I wrote back to them not long after. I had such a good streak in 2007, this was. And I wrote back to them and I said, you know what? Okay, you did reject me, but I've got a record here. Would you be interested in having a look at it? And I'll never forget the answer I got, which was simply, you've got heart. And he said, okay, fine. The guy that responded said, okay, fine. Look, come for an interview. Bring your record. I took it. They had a look through it. They went through it with a fine-tooth comb, asked me a lot of questions about why I traded this, why I traded that, and they ended up backing me. And it was a great time for me, because I was able to watch the professionals, how they traded, what they did. And I worked with some incredible traders. I mean, I don't know if you know this, but I sat for a while with Nav, who's the trader that's now being hounded by the FBI. That's made the $40 million, but has been accused of bringing down the US stock market. But I worked alongside him. I worked alongside some incredible traders, and I learned so much about the game. And that was really where my education kind of went to the next level. But I tell you something, Aaron, which was very, very important about this stage in my journey, which was that at this point, a lot of times when you're trying to learn to trade, how do you know that anyone that you listen to is profitable? You don't, do you? If you go on Twitter or if you go on forums, people say, oh, this is my strategy, this is how I trade, but you don't know whether that guy is making any money. You don't know. So if you start trading and the strategy doesn't work very well initially, or you can't implement it effectively initially, you start to have these doubts creeping in. Is this guy that's teaching me this even really profitable? And it plays with your mind. The thing is about being in prop is you were sitting next to guys and you could see people making money day in, day out, but you could also see people making insane amounts of money. And that really told you categorically, black and white evidence every day, this is possible. And you know, the power of that is pretty astounding.
Absolutely. No, 100%.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because you're a penny without risk, confidence, risk-free, before you even pay a cent?
I learned so much that it's hard to kind of drill it down to.
While you were in prop, what were some of the greatest lessons or the trading principles that were really drilled into you from trading within that firm?
I learned so much that it's hard to kind of drill it down to any one thing. But for me, one of the greatest lessons that I had was just the ability to understand that the market could be beaten and to focus, because all of these people that were making this huge amount of money, they were so focused in what they did, and they knew their markets so well. And I kind of realized at that time just how much you had to put into the game to get to that level. So, how in depth you had to know your market from a fundamental perspective, from a technical perspective. And, I think that was just really, it was that kind of, it was understanding how seriously these guys approach the market that I think was one of my biggest lessons. But, like I say, it's hard for me to give you specific examples because I took so much from so many different angles. Another thing was composure under pressure. Watching guys have big down days and not seeing it rattle their confidence at all. Seeing them be able to walk up the office, head held high with a big smile on their face. And you knew for a fact that the guy was down a massive amount on the day. Like, we're talking tens of thousands of pounds. And again, it kind of drilled into you that right mindset that you didn't have a pro trader get his ass handed to him on a day and then turn up the next day and go, I'm fucking scared. I'm scared to click the mouse. I don't know what to do. And it made you stronger, if that makes sense. It kind of made a man of you, I guess, if that's the right way of describing it. One thing that I learned that really stood out and really made a big difference for me personally is understanding that there's no such thing as a free trade, right? So a lot of people move to break even very, very quickly, and they say that they've got a free trade. And I was taught, not to think like that. And I have a big problem with this nowadays. So because I found that I would keep moving to break even in the early days because it is comforting to know that your risk is eradicated on the trade. But I just simply found that it didn't work because the market would keep coming back, knocking me out, and then going in the direction that I'd anticipated. And at one point, one of the guys there that was a huge trader had kind of taken me under his wing, and we actually spoke about this. And I said, I just got stopped out at break even again, and that damn market has moved, right where I thought it would. And he said to me, why are you moving to break even? And I said, look, I bought this, this level, and it moved up. I can't remember now, but let's say it moved up 20 ticks and it's come back. I don't want to take a loser on it at that point. And he said to me, look, if you buy support, right, which is why you got in that trade, and it goes up 20 ticks and it comes back to the support level, what are you doing? You're scratching the trade. You're puking it right into support. What? Because you don't want to lose money? That doesn't make any sense. Like, you're literally trading your P&L. You're focused on the P&L. And he said to me, trade the fucking market, don't trade your P&L. And it was a really, really powerful lesson for me. And again, it's kind of aligned with that whole, that principle of when people get in trades and they get up a huge amount of money and they move to break even just so they can't lose. I've seen people that maybe are going for a 100 tick target and they're up 90 ticks and they say, right, I'm moving to break even now, free trade, nothing to worry about. And I'm thinking, nothing to worry about? How about you worry about the fact that you're risking 90 ticks to make 10? Like, that's pretty worrying. People make a huge mistake of not realizing that risk reward evolves during the trade. It's not a static concept that you have a trade outset. So you can start a trade with going for a 3-to-1 risk reward, but there'll be points in the trade where that might have massively diminished, and the odds are now against you. So this was again something that I took from a very very large trader, just basically not to trade my P&L by constantly hunting for the for the free trade, and and to remember that risk reward evolves. And it was a very, very powerful lesson, and I don't think I'd be where I am now without having had that lesson, Aaron.
That's awesome. That's really cool. So let's keep this moving, and let's dig in now to a little bit about your trading style and your approach. So tell us, what are you looking for and how do you identify opportunities?
Okay, so on any given day, I have certain things that I look at. So I look at, for example, basic support and resistance levels in the market, like on the higher time frames, like weekly and daily. I also look at them on 60-minute charts, and I look at the basic structure of the market. So where are, for example, major trend lines? Where are the major Fibonacci retracement points? And what I try to do is I try to map the market, and essentially what I'm doing is I'm trying to play the market from one level to the next, as it were. But the big thing with me, what I think about a lot of the time when I'm trading is, where does the market have to go to facilitate trade? Because that is all that the market is there to do. So I try to think, where's this market got to go? Where's it got to test to try and advertise for a larger amount of buyers and sellers than normal? And I find that a lot of the time, the best trades often really kind of fall in the face of what you would expect. So, for example, I like to see a resistance being hit multiple times, and then I like to see price just stopping and just going quiet and just trading very quietly just underneath that resistance level. Now, when I see that, I know that that's often a really good opportunity to try and buy. But a lot of traders will look at that and they'll say a resistance level hit multiple times. That must mean the resistance is really strong. And now price is just stopping just underneath it. That means that, the market is running out of steam. There's no momentum up here and we're about to roll over and go to the downside. And so they get short. In actual fact, in that kind of situation, the market is often not very likely to probe above that resistance area to try and take stops. It will try and get traders up there to initiate and buy the breakout, and it will try and get the shorts to puke. So it will try and probe that area. Note that I say probe, not breakout, okay? Because a lot of people, even if they do get the idea right that we're likely to trade up through that area, they get shafted expecting a 200-tick move. So they buy it as it goes through and they get caught. So what I like to try and do is a lot of time try and anticipate that the market is going to break out of a range. And oftentimes I will take a position in a range. And it's weird because I found that to be highly effective over the years. But it flies in the face of what a lot of people are taught, because a lot of people will say, well, you don't buy in a range. You wait for price to confirm before you buy. But oftentimes once it confirms, it's too late. So that's just that's one of the things I look at. I'm very keen on finding trapped traders that get caught. And you often see this at kind of key reference points on the charts, like major swing highs or swing lows. And I like to try and take advantage of them. In fact, one of my actual favorite setups is when you get a large gap on the open. That's why I'm always watching the Sunday night open, particularly in Forex. Is when you get a large gap and the price travels in the direction of the gap. So, for example, if we gap up and the market starts then exploding to the upside, and then we get an auction failure beyond the big reference point. So, for example, it pushes up, we get a big key swing high, the market breaks that swing high, but can't close above it. And so we've got failure up there. And when I see that, particularly with an open gap, I will usually look to fade that market momentum back towards a gap close. And it's just one of the setups that I see a lot of, which has a very high expectancy. But the thing is, the market, it's inherently curious. That's something that you have to understand as a trader. The market is just very, very curious. And a lot of the time, it needs the comfort of knowing what is beyond certain areas before it can move with confidence in another direction. So, for example, a lot of people say they'll notice that the market will break a support level before it can rally, right? It needs to break the support level to know, is there any sellers down there? Is there anyone doing business on the short side? If there's not, great, we can move to the upside now with confidence. But the market, a lot of the time, the market, it likes to probe these areas. It likes to see what's going on before it can move. And that's what I'm looking for when I trade. I'm looking to see what is going on at these areas. Are people getting caught short, getting caught long? And what is the market doing based on what everybody thinks it should do? So to give you an example of this, sometimes you get sentiment, right? You get very strong sentiment on a market. So let's say, for example, there's a good example the other day in the Bund, right? Now, the Bund had broken, on a daily chart, it had broken a key swing low on the daily time frame, and it closed below it, and it was a very wide-ranging down day. Now, I have my ear to the ground. I'm listening to other traders. I use Twitter a lot for this, and I'm listening to what the professional traders are saying. And again, going back to prop, what are the prop traders, the guys that I've worked with that I know make a lot of money? What are they thinking about this market? And I would see that, the vast majority of them are bearish. Right now, that gives me information that the professionals, the guys trading size, think this market is going to go down. So now what I'm really interested in is what the market does. And then on that particular day, you'd see that the market just could not break lower. It just couldn't go. And that was a really interesting sign. And you get armed with a lot of information there, because if the chart is technically very bearish and the sentiment is very bearish, but the market won't break, you need to be long. You need to be looking for a long. And, if you're not long, well, okay, fine, but God forbid you're short that market. So I try and take on a lot of information from different angles to try and make a decision. But in short, to kind of summarize, I'm looking to find out, I guess, where traders' pain thresholds are and try and really capitalize on them, which is not a very nice thing to say, but if you can take advantage of a trapped trader, you can, there's money to be made there, and people get caught on a daily basis, and it's not too hard to tell once you've studied the market what the signs are when they're likely to be caught.
Yeah, well, I mean, that's just the reality of trading, isn't it? That's just how the market operates. So Now, from what I understand, you know the setups you want to trade, right?
Mm-hmm.
But you don't necessarily trade them in a systematic kind of fashion. So besides your own criteria that defines the setup, what else do you need to see before taking a position? I think it's probably that qualitative aspect coming into play. Can you elaborate on that a little bit?
Yeah, I mean, I'm a discretionary trader, so you're right, I don't trade certain setups systematically, because what I'm trying to look for is I'm looking for kind of, or taking on information from so many different angles, and I'm trying to kind of build a picture of the market. So I can't really bring it down to anything as simplistic as, well, when I see X pattern, I need to then go ahead and do Y. This was a mistake that I think a lot of people make when they first get into the game, is they see or they read about a basic pattern, like for example a candlestick pattern, and they read like, okay, if you see a hammer, that's bullish, and that means that, you know, the market is likely to go up, and they break it down to its lowest common denominator, which basically means, right, I see hammer, I get long, right? And a lot of the time what you've got to do is you've got to take on the information from a lot of different angles. You know, what time frame is that hammer appearing on? Maybe it's a daily. So what's happening on the weekly charts? What news have we got out? What's the sentiment like at the moment? How has this market been moving lately? Where is this hammer appearing in terms of the context of, you know, is it appearing around prior support resistance? Is it appearing in the middle of nowhere? And so on and so forth. So it's very difficult to be systematic, because you're trying to take on this information and deal with those different variables.
Okay, no, that's a great answer. So how do you determine whether or not the trade, before you get into it, has a worthwhile risk to reward before entering? Do you have profit targets, or how do you judge that before you get into it?
Right, so whenever I'm looking at a trade, looking to get into a trade, I have an idea of where I'm looking to take profit, and I have a firm idea of where I'm wrong on the trade. So then what I've got to think about is that risk reward ratio good enough to merit taking the trade? Now, I guess I differ from a lot of traders in this respect, because there are a lot of people that are taught to always go for a 2-to-1, or always go, you know, for a 3-to-1, or what have you. And that is good. Don't get me wrong. The higher that your reward to risk ratio is, the better, for sure. And I wouldn't dispute that. But what I would say is that it is dependent. Your edge is dependent on your risk reward ratio combined with your strike rate. If you have a high strike rate, you don't need a high risk reward ratio to make money. So I'm aware that I can get away, because of my strike rate, with a risk reward ratio of 1-to-1. I don't like going lower than 1-to-1, although I've worked out over time that I can get away with it, just going fractionally lower than a 1-to-1, like a 0.9R. But generally, I'll look for 1-to-1 or higher. Now, obviously, I want to get as high as I can. So one of the things that I do is I try to establish very early on in the trade, is this a trade that I am going to try and run? That's really a key question for me. And I think it should be a key question for all traders, because a lot of traders get into the trade and they find that managing it is the hardest thing. And a lot of time managing it is hard because they don't have an expectation of where they think it's going to go. They get in and they think, well, the market is likely to react here. Maybe we're a bit overdone to the upside or the downside, or this is a big trend line that we've just broken out of. I think it can tank, but tank how far? You know, so you've got to have an idea. And what I try to do is I have two types of trades. I have those where I feel that the market is poised from a higher time frame to make a big move. And then I'm going to get in on a lower time frame, like the 60-minute, and try and enter that trade and run it, sometimes for the whole day, sometimes even for longer, to try and capitalize on a bigger move. But the other type of trade is where I will literally play from one level to the next intraday. So it might hit a support and trade up to the next level. And as you would expect, I'll find the trades where I will run onto a higher time frame will be the ones that pay out in terms of giving me a higher risk reward ratio. But I don't. I trade the market, right? I don't trade risk reward. So what I mean by that is sometimes I see people. They come into the market and they say, okay, so I'm planning on taking this trade, and I'm buying, let's say, this support level, and I think it's going to go up to the next level. And they look at that trade and they say, well, but that's only got a 1-to-1 risk reward. I've really been told I should get a 2-to-1. So I'll tell you what I'm going to do. I'm still going to take that trade, but I'm going to make my stop tighter. Or I'm still going to take that trade, but I'm going to make my target bigger. And you see what they're doing there is they're completely ignoring the structure of the market. They're trying to impose their risk reward on the market. And to me, that's crazy, because you've got to trade the market. The market doesn't give two shits about your risk reward ratio. So, if you're not trading the market, what are you trading? And I think, again, that's where a lot of people go wrong.
I really like that point. I'm glad you brought that up about sort of trading the actual market and not trying to imply your views onto the market and try to make them fit. So, no, I really appreciate you bringing that up. That's excellent. Now, just like to keep moving. So now that we've covered your strategy, your approach to trading, let's get into some more general advice for other traders. Now, one of the things I've heard you speak about in the past, which I found quite interesting, was, again, going back to how you used to work or trade within a prop firm. You said that everyone who came in was given access to the same technology, the same equipment, same coaching, learning, all of that, yet still only a small amount would become profitable. So I guess two questions to come from that. Why is trading so damn hard? And were there any obvious differences between the few who made it and the majority who didn't catch on?
I think that's such a good question, and it's difficult to answer. It really is. It's like the $1 million question: why do some people make it and others don't? And it's the question that everybody wants answered. A lot of people make the mistake of thinking that just because anyone can open an account and they can buy and sell, that anyone can be a trader. And this could not be further from the truth. Like, this game requires a specific skill set. You've got to be wired a certain way to be able to make money. That's just the fact. You have to be able, for example, to react quickly to huge numbers of variables. You have to be able to act with ruthless decisiveness and commit to a position, but then in the next breath be able to completely change your mind if necessary. You've got to be able to cope with insane pressure, to be able to get knocked down and get back up, to stay strong, to stay resilient, to stay focused for long periods of time. And some people simply are not built this way. Now, a lot of people will come right back at you then and say, well, but can you learn these traits? And that's really hard, because sometimes to learn them, you have to change your entire personality. And I guess, some traits are easier to learn than others if you're determined enough. But if you are determined enough is the key phrase. I mean, let's, for example, take patience, the patience to wait for a good trade. A lot of people just, they just don't have this patience. I personally have got the patience for Saint. I mean, I can stalk a trade for days and weeks if I have to. But ironically, I don't have a lot of patience with people that come to me and say, oh, I can't find the patience to wait for a good setup. Patience is a basic and essential skill that you need. And the way I see it, if you can't find it, get another job. People often turn to a trading psychology book, right? What, to find patience? Seriously? It's like Nike said, just do it, man. Here's another one, right? You get someone that they take a couple of trades and they lose money, and now they're scared to take the third. And they're reading all these these books on psychology. I mean, can you imagine for a second? Imagine getting a job as a salesman, right? And they give you some leads to call, and the first call you make, someone just slams the phone down on you. And the second one you call, the guy just tells you to fuck off straight away. So the third call comes along and you say to your boss, oh, you know, I'm a little bit scared to call the third guy on the list. I mean, what do you think the guy's going to do? What do you think your boss is going to do? He's going to hand you a self-help book, or he's going to show you the door? You know, at the end of the day, there are certain skills, certain character traits that are hard to come by, but something like patience, you know, you've just got to have it. You need to take a look at yourself, in my opinion, and think, this is a skill that I have got to have, and I've just, you know, I've got to just get it. I've got to sit down and I've got to make sure I have it, or I've got absolutely no chance. So when it comes to even being, you know, being nervous to take the third trade after 2 losers, look, you know, how are you going to deal with this? You should trade live, trade small as you can, but I don't agree with trading on demo. That's just for me personally. I don't believe it teaches you the right psychology, but trade live, trade small, build a record, and get some stats together so that you know, when you go into drawdown, you know, you look at your stats and you know in the long term you're profitable. Because, you know, everybody gets drawdown. Everybody gets drawdown. This is a guessing game, right? And you're a gambler at the end of the day as a trader, and you're going to have losing streaks. Every professional trader will have a losing streak. The only people that don't have losing streaks are Twitter traders. So, you know, ultimately, I guess the point I'm trying to make is that a lot of these guys that I worked with, right, they were wired up in the right way, and they didn't need a psychology book. They, you know, when they thought, okay, I haven't had a lot of patience on the last trade, they just sat down and they thought, I need patience, and that's what I'm going to have. And they learn, you know, to have these skills and very, very quickly. Even if they maybe didn't have them when they came into the firm, they got them real quick. The longer that it takes you to acquire a skill, the more likely you are to drop out of the game before you eventually get where you want to be. Some people, you know, often ask me, how is it that I still kept going after 7 years? Because I didn't get profitable until 2007, but placed my first trade in 2000. How did I have the strength to keep going? Why did it take me so long? And as I think I said at the beginning, the reason it took me so long is because I was a very, very slow learner. I mean, I traded these stocks for 4 years when there was absolutely no edge. You know, a baby could have told you there was no edge in doing that. I was still doing it for 4 years. It's like banging your head against a brick wall every day and expecting, you know, that it's not going to hurt. So I think that, you know, if it takes you a long time, then this is a real danger. And for some people, it really, you know, it takes them a long time to learn. They just drop out the game. So if you can learn from your mistakes quickly, you're more likely to make it. And I think these guys that I worked with that got so big, they were able to just learn from mistakes very, very quickly and make sure they didn't make them again.
Yeah, you hit on a ton of great points in that. That's an awesome answer. And something you did hit on there was sort of losing streaks and going into a drawdown. So, I mean, as a day trader, or as any trader, as a matter of fact, I'd imagine you have days when you're not on your game and you have it, and you have some kind of losing streak. How do you effectively manage these times?
Well, you know, that's again a great question, and you just have to keep your chin up and you just have to plow through it. I mean, that's the only thing that I can say. You just have to, you know, you have to keep going. If it gets, you know, I mean, when I say keep going, I mean, if you have a down day or two, you've got to have the ability to come in on day number 2 or day number 3 and be strong as if nothing's happened. But if you do get from time to time streaks that last a week, a fortnight, you may find that it impacts you more, and you know, you may need to do different things. I mean, something that I will do from time to time if I do hit a bad run is take some time off. They say time heals all wounds, and it's completely true. Like, you know, at the end of the day, if you can just take even sometimes 2 or 3 days away from the market, it really can clear your head. But I think that one of the things, or one of the elements that I am, I guess, fortunate in is that I have an overwhelming amount of self-belief and self-confidence. And I don't know where I get that from. Like, I guess I'm just wired that way. You know, it's something that I have, which is fortunate for me in this career, but it takes an enormous amount to knock me. And I would say, honestly, since I got profitable in 2007, and, you know, it's now 8 years on, I would say I've probably only had one period in that whole time where it was really hard. Like, looking back on it, it was really hard. And I thought, you know what? I don't know how I'm going to keep doing this every day, because it was just, you know, I was going through a streak, a negative streak that lasted for weeks, and I just couldn't make money. Like, literally everything that I did turned to shit. And that was really, really hard. But again, you know, you just plow through it. I mean, I don't think that what I'm saying is particularly helpful to people, because they'll probably be thinking, well, how do you plow through it? You know, what's the magic pathway? There isn't a magic pathway. You know, if I come in and I lose money every day this week coming, I know that I'm going to come in the week after strong. I just know it, because it doesn't faze me anymore, Aaron. And I don't think, like I say, I don't think that's really going to help your listeners, but I suppose it's one of my strengths that's hard to, you know, to pass on, because I don't know what makes me like that.
No, that's excellent. Now, you have a quote which I really like it. I think it's an awesome quote, and it goes, "If you're not working on your edge, someone else is." So now I'd love it if you could expand on this for everyone listening and speak to the competitiveness of trading.
Right. You know, you should know that there are guys working so hard on their edge. And it's often the guys that are huge that are working the hardest, right? Which is why they're huge. You often hear people saying that they want to get into this game so they can make loads of money and they can retire and, you know, sit on a beach sipping pina coladas and, you know, placing a few trades from their laptop. The fact of the matter is that these guys I worked with that have made enough money if they wanted to live that kind of lifestyle do not. They are the first in the office every morning, and they are the last one to leave. And the reason that they've done so well is because of the amount of hours that they've put in. And they are the guys that are essentially taking your money. These are the people that have done the work that most people are not prepared to do. And at the end of the day, you're paying them, right? So I'll give you an example. When I was in prop, and I often tell this story, there was a couple of really big guys there. We're talking like a couple of $100,000 a week that they would be making. And they were huge. And one day, one of the guys had a stellar day. I don't know how much money he'd made, but we are talking a lot of money. And everybody was kind of, you know, had heard about it, and there was a bit of a buzz. And he was just, you know, he was just cool. He was just, you know, staying, you know, emotionally cool, but, you know, had a smile on his face and was chatting with some of the guys. And anyway, I left the office at about, I don't know, 5 o'clock, and I got the train home. I got right to my front door, and I realized that I'd left my key in the office to my front door. So I thought, well, I'm not going to call a locksmith. I'm going to have to go all the way back into central London to the office, get my key. So I get all the way back to the office. By the time I get there, right, it's about I reckon it's probably 9:30. Like, the market is closed at this time. It took me ages to get back, and the market is closed now. I come into the office, right, and all the lights in the office are out. There's just a little light on at the back of the office. And so I'm like, okay, somebody's here, but all the markets are closed. Lo and behold, there is one guy left in the office, and it is that guy that had that huge return, and he is sitting there recording his trades for the day, and he's writing down, you know, what went well, what went badly, and making a plan for the next day. And that, to me, it was a real eye-opener, because, you know, again, most people are thinking to themselves, if, you know, they want to make money in this game to live the easy life. And yet the reality of it is that most of these guys that have got all this money are working so hard. A lot of them don't have balance in their lives. That's just the way it is. So when I say somebody is, if you're not working on your edge, somebody else is, I mean that, these are the kind of hours that people are putting in. They're taking this game seriously. They know their statistics. They know their edge inside out and back to front. I mean, I personally spend a lot of time number crunching. So I crunch a lot of things to, when I see patterns in the market, I look at the probabilities of certain things happening. And sometimes I see guys call trades out, for example, on Twitter. And I think to myself, and I honestly don't want to come across in a kind of smug, know-it-all way, because trust me, I get it wrong, massively wrong from time to time. But sometimes I see people call these trades, and I think to myself, you know what? If you'd have done your homework, you would never be taking this trade, because there's no, there's very, very little probability that you are going to see that. See that make money. For example, I might see them, trading a pattern that I know has a very, very low strike rate. And again, it's not to say that I'm always right, but this is what I mean when I say that people have done this work, and a lot of the time they're the guys that, the newer traders are making ill-informed decisions and ending up paying the bigger guys that have done the work and put that time and effort in.
Yeah, so you touched on it there, and the guy who made the huge wins for the day, he was still at the office late. He was the last one to leave. Do you yourself have a daily routine for preparation and reflection outside of market hours? And if so, I mean, what's the importance of keeping a trading journal? And is it important, what's important to record? What should people be writing in their trading journals as a minimum?
Well, the first thing I would say is that it's vital to have a trading journal. Most people don't, and even if they do, they maybe just log the trades, but they don't really examine them with the aim of increasing performance. You really have to look at your journal hard, and and really try and answer 3 questions. Right? Number 1, how can I make more money from my winners? Number 2, how can I lose less money from my losers? And number 3, how can I get more trade ideas? Okay. Now, in terms of journal, I would like to plug a company called Edgewonk, and I came across Edgewonk recently, and I think that they are doing incredible things in the field of journaling. I wish that had been around when I started out. I would have probably got profitable a hell of a lot quicker. But they're doing great things out there. But ultimately, there are so many traders out there that just do the same thing day in, day out, and they keep expecting a different return, but they're not getting anywhere. Now, I'll give you an example. I worked with a guy a while back, and he was really going nowhere, but he'd never taken a proper look at himself and his record and where he was going wrong. He would just say to me, "Oh, Tom, I think the problem is I'm making money, I'm giving it back, giving it back, I'm treading water. I just don't think there's anything really in my strategy. I think I need to learn a different strategy." And so I said, "Well, hold on, let's have a look at actually what you're doing. Can I have a look at your trade journal?" And he'd actually got a trade journal. So, kudos to him for having a trade journal. He had it and he sent it over. Now, the first thing I noticed was that this guy's traded size was totally inconsistent. Like, one day he's doing a 4 lot with an 8 tick stop. The next day he's doing a 1 lot with a 10 tick stop. It made absolutely no sense. So I asked him what was up with that. I said, "Why are you varying your size so much?" And he said, "Well, 2 reasons. I'm varying it based on my degree of confidence in the setup. So if I see a setup I really like, I put more size on." And he said, "And sometimes I vary it based on confidence in my own ability. Like if I've had a bad couple of days, I'll lower my size." So I thought, okay, this is not good. But I said, "Okay, let's start with the setup. What makes you risk a 5 lot on setup A, but only a 1 lot on setup B? To quantify that for me." And he says, "Right, setup A is more likely to win." So I said, "Right, but based on what? What's the expectancy of it?" So I'm expecting him to give me a strike rate, an average win versus average loss, some stats. And he says, no, just gut feel. So I'm thinking, right, so basically, when you've just got a good gut feeling, you're risking more. Okay, that for a start is clearly not working for you. You can see that from your performance. But then the next bit is even more problematic, because it turns out that, like many people, he'll do a 2-lot, right? He'll do a 2-lot trade. And if that 2-lot trade loses money, the next trade he'll do a 4-lot to try and make the money back quicker. Now, if that loses, he completely shits himself, and the next trade is on a 1-lot. And so many people do this. So they'll get, a loser, and that loser, they try and revenge trade it, and because they're not in the right emotional mindset, they've upped their size, and they then get really hit hard. And then rather than just take a break and come in and refocus, they then get so nervous that they go right back to tiny size. And then, of course, Sod's Law, they immediately get a winner. But it's on such a small size, it's had no impact really for them. And anyway, lo and behold, what I found out is over a decent sample size of trades, this guy had a really positive expectancy, but the guy's down money. And this thing happens to a lot of people on a much bigger scale. He had no idea that he had a winning strategy. All he thought is, I'm not making anything, the strategy doesn't work. And he hadn't realized it was due to varying his size. But when you crunch the numbers, it tells you that if he took every single trade on a 1-lot or every single trade on a 5-lot, he would have made money. And he would have made a lot of money. But again, people don't look at this. Something else, and I won't go too into this now, but something else that's always worthwhile looking at is your maximum adverse excursion. So how far do your winning trades go against you? Let's assume for a second that you've got a fixed strategy where you have a 50 tick stop on every single trade, and you have, a 50 tick target. So you're going for a 1R. And let's just assume that you win 100% of your trades. You win every trade. I know that's never going to happen, but let's just assume it. Now, you could look at your stats, and if you find out that the furthest price went against you in your sample size was 6 ticks, let's say, then guess what? You've realized your stop is way too wide. You're using a 50 tick stop, but the furthest price ever went against you is 6 ticks. You could massively reduce your stop, and your expectancy would go through the roof. But there's a lot of people out there that are just busy, patting themselves on the back, going, "Look, I've won 100% of my trades. I'm absolutely killing it." But they're not working on moving forward. And this is something that you should never forget, is that you can always improve. There is nobody out there that can't improve in this game and that can't do something better. So for me, a journal is a very important thing, because I come to it usually every quarter. I review my journal, and like I say, I'm trying to answer one of those questions and try and find a better way to do things. And once you've found a better way to do things, you've got to implement that. But yeah, I do think it's all about ultimately having a journal and recording the right things and studying it. And if you want to know what to record, the best way to do it is, in my opinion, to at least go on YouTube and have a look at Edgewonk's videos, because they really go to town on it. It's like their thing. It's what they know.
Yeah, that sounds really cool. I'm going to check that out myself, and I'll also put a link to it in the show notes as well. So yeah, I mean, if you recommend it, I encourage that other people check it out also. Now, I want to dig into just a couple of the things that I spotted on your Twitter feed. And the first one would be the video you recently made. It's a parody video on so-called trading gurus, which has been getting a little bit of attention. And I mean, I thought it was quite entertaining. I got a good laugh from watching it. What was your reason for doing this? I mean, I presume you feel some kind of way about those who present themselves as gurus and maybe not qualified to do so.
Thing is, Aaron, I make a lot of jokes, right? And everybody knows that. And I feel that sometimes it's the only thing that kind of keeps the stress at bay, because it is quite a stressful job. And you need to have the ability to look at the market and just laugh, from time to time. Sometimes there are just the most ridiculous moves. And, if you don't laugh, you're going to end up crying, with your head in your hands. So I think it helps to have a sense of humor. But regarding that video, that specific video, there are so many people that just talk shit in this industry, and I can't help but want to parody it sometimes. For example, those that spout cliches like trying not to think about the money, right? Now, that's actually very good advice, but they'll be saying try not to think about the money, and then their Instagram page is full of Ferraris and Lamborghinis, and I'm staying at the Hilton, and I'm drinking Cristal. It's total nonsense. And aspiring to that lifestyle is what kills people in the end. The other thing that I tried to kind of parody in that video is just ridiculous hindsight analysis that a lot of people sort of post. And that really gets to me. So my personal favorite is when people just kind of say, well, this is where you should have been long, well, this is where you should have been short. And you're thinking, well, yeah, no shit. It's been a massive move. Yeah, I wish I had been. But you do see that. And of course, something else you see a lot is when people, they say like, all right, there's a big trend line here. Now, the market could rally from this trend line, but also the trend line could break. And if it breaks, the market could go down. But it could also false break and then rally. So watch out for that too. And basically, like, every single contingency is covered, but they're not telling you anything. Like, the person watching literally doesn't know whether they need a shit or a haircut. Like, they just don't know what to do with that information. So I kind of, like, I just wanted to make a joke, I suppose, out of, people that make all these videos and they're selling you the dream, but at the same time, they're not telling you anything useful at all. The funny thing is, Aaron, it kind of backfired on me because I think a few people actually did take it seriously. So like I saw like a few people on forums were kind of saying, oh, Trader Dante's really gone downhill now. Look at this analysis on cable. It's completely useless. And I'm thinking, shit, you guys haven't realized that's a parody? But
I mean, I thought it was pretty obvious from watching it, but I mean,
I'm
I guess
glad
some
you
people
did.
don't catch on to that. On a more serious note, what you said the other day in one of your tweets is you said, if you think the cost of this game is merely in the amount of money it takes to learn it, you're seriously deluded. So what is the real cost to succeed? And what's your thoughts behind that?
Well, now you set up with that question. We definitely can't end with that question because the answer is so depressing. But the cost of learning the game is not just in the money, because there is a toll that I think that the market takes on a trader. There is a huge amount of stress that a trader goes through, and along with that stress, you usually experience a whole host of emotions, fear, frustration, anger, depression. A lot of people focus so hard that they get burnt out after a while. There is an impact on your health. I honestly do believe that. And also on your relationships as well. I mean, it's difficult. I find it difficult myself, and I'm a profitable trader, to sit in a study for 10 hours a day and sometimes just get literally my ass handed to me by the market, and then come out and see my girlfriend and her daughter and just act like everything's perfect and oh hi, how's it going, and act really happy. It has a toll, and it especially has a toll in the beginning when you're not used to this, because trading is a really cruel and really emotionally draining experience. And I understand that I won't talk anyone out of trying it by telling them this. No one's going to go, oh, I heard you can make millions trading Forex, but this chap Trader Dante on the internet says it's stressful, so I don't think I'll give it a go. I know I'm not going to talk anyone out of it, but I try to prepare people for the assault on their spirit that the market is going to make, likely for the first few years and probably even longer. Because I think, as I say, people just sort of think that the cost of trading is limited to how much they paid for a course or a book or how much they lost trying to learn it. And I do think that many do pay a different cost, if only in time as well. You do find that a lot of the biggest and best traders will confirm that and will say that there is a cost. It is negative, it is depressing, but I honestly do believe it to be the truth, Aaron.
Yeah, I think that's really good. And I mean, Tom, we are going to end on that note because I think it's good that people, most of the listeners appreciate that and they want the truth. They can accept that. So, we've hit on just over an hour now, so we should probably start to wind this down.
Okay.
But, that was a brilliant answer. And your answers throughout this interview have been on point, really, really good. So thank you very much for doing this. I really appreciate it, and I'm sure the listeners are going to also.
Fantastic. Well, I've really enjoyed speaking with you, Aaron. It's been great. So
thank you very much. Well, before you go, do you want to share with listeners where they can go to find out more about you and connect with you?
Sure. I mean, if I've got a website which is www.trader-dante.com, Dante. Dante is my middle name, by the way. So that's why the Trader Dante. Someone once accused me of making it up because they said it sounded mysterious. No, it is actually on my passport. But I mean, I think that most people know me via Twitter. So on Twitter, I'm at Trader _Dante.
Okay,
And
good one.
I post quite a lot of stuff during the day. So I always appreciate the follow.
Awesome. Well, I mean, I encourage everyone to make their way over to Twitter and follow along because, I mean, you do post a lot of great stuff on Twitter. So, I mean, a lot of value in just following along. So, again, Tom, thank you very much for doing this. Take care and let's talk soon.
Cool. Thanks a lot, Aaron. Take care.
Okay, and that brings us to the end of another episode. So thank you very much for tuning in, and I'm sure you'll agree with me that Tom was a standout guest, just a whole ton of raw insight that he was able to share with us. So I really appreciate Tom coming on and having done this. And
Chat with Trader has begun.
Risk analysis tools, and more features.
They've worked hard to learn the market.
now, this week on the show, I'm joined by Brian Weiner, and to put it quite simply, guys, welcome to episode 40 of the Chat with Traders podcast. Thank you very much for tuning in. I know I always say this, but I really do appreciate it, so great to have you with me. Now, this week on the show, I'm joined by Brian Weiner, and to put it quite simply, he's a man just crazy about options. So options, guys, you're in for a real treat. And I should probably admit there were a few moments where my lack of knowledge on options is probably quite obvious, but Brian well and truly delivered. So it's an all-round great episode. I think you're really going to pull a lot of value from this. So just to give a little background on Brian, he's been actively trading for just over 15 years. And what's particularly interesting about him is how he's been involved with markets from a number of various angles. And what I mean by this is he originally started out as a market maker on the floor of the CME, and by the way has some great stories which he shares during the interview. From there, he later joined Haim Bodek for the rise and the fall of Trade Machines, which was essentially a black box startup which was ruined due to HFT manipulative orders. Brian speaks a little bit about this during the interview also, which is quite interesting. And some of the things he picked up and learnt from Haim Bodek directly about market structure, micro pricing, and those types of things. So very interesting stuff. And nowadays, Brian is the quantitative options specialist on the Sanglucci team, as well as an independent trader. During the interview, we of course go right into Brian's journey of how he got to where he is now, as well as plenty of discussion about options markets, including how options have evolved over time, the various types of options traders and where their edge exists, and a few things aspiring options traders need to be aware of. Now, once you get through this interview, if you're still hungry for more, be sure to go visit the new products page at the Chat with Traders website, which is just chatwithtraders.com/products. So on this page, you'll find a free ebook there titled The One Thing I Wish Someone Would Have Told Me Before I Started Trading, which is about 30 pages in length and includes the curated responses from many proven traders. At this page, you'll also find a premium ebook, which is just $15, and that's titled Why Most Traders Never Succeed, which I've received a ton of great feedback on. So if you haven't had a chance to read this already, I strongly encourage you to do so. Plus, as of last week, you can now get access to one-on-one trading coaches. There's currently 3 coaches, all of which have appeared on the podcast in the past. And I mean, it's very simple, guys. They're there to help you, so don't ignore this opportunity to get the guidance you need from a pro trader. So you can get more info on all of this at chatwithtraders.com/products. Okay, now time to dig into the interview. I'm your host, Aaron Firefield, and here is this week's guest, Brian Weiner. Brian, what's up, man? Welcome to the podcast. How you doing?
Thanks, brother. I'm good.
Great to hear. I mean, thank you very much for doing this and taking the time to do this. I mean, I've really been looking forward to it, and mainly because I think we're going to get into some pretty intense discussion around options. But before we get there, I'm really keen to break down your last 15 years or so as a trader, especially because I know you've had to almost like reinvent yourself a few times over. So let's start with your first experience as a trader on the floor of the CME. So tell us, how did you wind up there? And also, what were you doing prior to landing this gig?
Right. So I was at Georgetown in DC. I graduated in 2000. Before I graduated, I had really no idea what I was going to do with my life. I was in the business school, and people do investment banking and consulting, but I took an options class, and I actually really enjoyed it, partly because of the math, and then partly because I got flown down to Chicago to take an interview, and I went down to the SIBO first, the Chicago Board Options Exchange, and I was like, what is this place? I'd seen, movies like Ferris Bueller's and Trading Places, but when you're on the floor for the first time, you're like, wow, what is this? And it was just like, yes, I want to do this. Tell me more. And, I got a job offer, and that was my only job offer. And I never wanted to go to Chicago, but I was like, you know what? Who cares? I want to be a trader. So, an options trader specifically. So, that was really the reason why I landed on the floor, is because I took a class at school, and I was like, this looks awesome. Let's do it. And they hired me, and I was there.
Nice, very cool. So thinking back, do you recall what it was that initially attracted you to markets and trading?
It was different for me because it wasn't about being a trader. It was about loving options. And I'm kind of, I've always been, never been diagnosed with ADD, but I'm certainly, in my 20s was definitely hyperactive, definitely had, attention issues, I guess, partly in my head, partly because I'm into dance music, and, I was crazy when I was in my 20s, but, that was second to loving options, just the whole math behind it. I'm a math guy. So I was able to kind of marry together trading, or actually more so option theory, with something that would put my energy into use, and competition. And I was never really great at anything competitive athletically, but this was kind of like a quasi-type athletic competition. So you learn that later on when you're actually, as a trader, not as a trainee, but as a trader. It just kind of just married different things in my life, and it just made sense. And I was lucky I fell into it, because investment banking and consulting had no appeal to me. Everyone else, 90% of the people in my business school were doing that. And I am very thankful that I found something that I really enjoyed versus people killing themselves. Although you can make a lot of money, it wasn't what I wanted to do.
Yeah, no doubt. So tell us, you've just got this job trading in the pit. First weekend, what were your thoughts? Was it a complete shock to the system, or was it exactly like you'd anticipated it would be?
Right. So, when you get hired, you're clerk / trainee, same thing, and you are basically doing pit-related stuff or hedging-related stuff. Either you're sent down to the floor, or you're hedging someone's floor position upstairs. So there's two different types of things. Either way, you are chicken with your head cut off. So if say you're on the floor, you are giving the trader regularly updated risk sheets of their different Greeks, their positions, and or you're taking their trading cards and processing them through the exchange. Both have pressure, and you have no idea what you're even giving to them. The trading cards are maybe even easier, but if you forget, you don't know. You're still kind of clueless, but you're doing the best you can. And it's so loud, and you have all these dudes with coats on, they're acting crazy, clerks that have been down there forever, thinking you're an idiot because you're wasting their time and waiting for you to process something. So that alone is hectic. Now, if you're upstairs, all of a sudden you're, say a guy, this was in 2000, so the end of the internet bubble, Qualcomm, Yahoo, guys are doing floor trades on the floor, and their deltas are coming upstairs. So you're looking at the screen, you have to, some guy made a trade, bought 500 Qualcomm calls, you have to sell 50,000 or sell 25,000 shares of Qualcomm, so that you're putting an order into some level 2. Either you're selling the bid or putting an offer in. The first thing you do kind of is you're just selling the bid because you don't want to fuck around. But and we're trading in teenies too, so every 16 cents, so it's not even in decimals. So it's like you're just going from 0 to 60 upstairs as well. But it's more like you're physically, costing the company money or not. And they'll kind of test you sometimes. Some order was duplicated. I still remember to this day from 15 years ago, an order was duplicated. The system screwed up, and like the head trader of the entire company is like, Ween, which is my nickname and my badge on the floor. He's like, that was a fucking duplicate. Get rid of that. I'm like, shit. But then you kind of develop an attitude like, you can't yell at me. I ended up flipping that like 25,000 shares for a teeny. So that's like, making $2,500, $4,000 or whatever the case may be. But it's like you kind of build up some respect for yourself once you don't have anyone yelling at you, or, that's kind of the key. It's like, I don't know if you're familiar, you're probably not with football, but American football. But if you're an offensive lineman, the way that you're doing well is if no one's saying anything about no one's calling your name, no one's making fun, no one's commenting about your performance. So, those are the challenges that I faced, and I think I did pretty well with them. I was thrown in the pit after like 9 months on the job, but you go through both cycles. You're upstairs hedging, you're learning about option stuff and about hedging deltas and position stuff, and then you're on the floor learning about what it's like being on the floor. So again, both at the beginning, you're chicken with your head cut off, and you try to adapt as best as possible, and they recruit you because you seem like someone that's smart enough to handle the stress. And that's what they saw in me and other people that were in my trader trainee program. So a lot of floor traders or trading companies have classes like, maybe 2 to 10 new traders every year. And they hope, that they have maybe 50% of the people can become traders. There's a lot of turnover though too, but it's that's how they weed out the traders and those that can't trade.
Sure. Okay. So just so we're clear on that, were you actually making buy and sell decisions for yourself while you were on the floor of the trading exchange, or were you just sort of executing orders that other people were trying to tell you to do?
Right. So, just to clarify, when you're a trainee or a clerk, you're hedging people's stuff and you're just doing the hedging stuff. But when you're on the floor, say I'm a trader now, I am market making. So I am making my own decisions. No one's telling me what to do. They might say, my position manager might be like, we need to buy some gamma, we need to buy some options, or we need to sell some options. We're long too much or we're short too much. So then I will change my markets and I'll do whatever I can to achieve those goals until we're back at a happy medium, until we're at an equilibrium and I can trade around. So, and what I mean by that is, as a market maker, I'm trying to buy low, sell high, just like someone trading stock, but I'm trying to do that in terms of volatility. And that's very different. It's three-dimensional. And, so I am making these markets with the goal of collecting this spread and, having a neutral position, but there's different orders coming into the pit from brokers. So again, there's a difference between a broker and a market maker / trader. And, we're going to take the other side of that trade that the broker has that came from Merrill Lynch or whatever the case may be, Goldman Sachs. I will be the counterparty, but I need to get paid in terms of edge. And we quantify that in volatility points, Vega points, more or less. So I am making decisions that will maximize my potential to keep that bid-ask spread over time, But if my position gets too big in one direction because of the order flow, my position manager or myself will realize I need to change my markets a little bit. I need to lean to selling more or buying more, and that could go from out of the money calls to out of the money puts. So just I know very complicated there, but I'm making my own decisions unless my risk is too large.
Yeah, that's excellent. Thanks a lot for explaining that, Brian. And that the volatility aspect, we're definitely going to get into that a lot deeper in a little bit. But you mentioned just before that sort of during the first 9 months was sort of the initial training period. What was some of the training that you went through? Like, what sort of training did you receive during that initial 9 months there?
Yeah, all types, and it varies from doing the back office clearing stuff, which is not really important, but it's good to know how options clear, how expiration occurs, things like that. Then you're also learning about I guess the functions on the floor, how the exchange works, things like that, what could cause a fine, petty things like that. Then also, how to make a market, it's different. It's fun for, I guess, your viewers to know about how it was on the floor then, because right now it's just like you have parameters and if you're a market maker, you're kind of quoting around a theoretical value. So we had theoretical values, and you got to learn how to make your market. If my value, say a broker comes in the pit and they want a market in some, say the S&P 500, the weekly call, some at the money call. I see my value is $10. I might make a market 9.5, 10.5. $9.50 bid, $10.50 offer. But if the market moves, I might want to change that. So, you learn how to make markets and how positions affect you monetarily, things like that. So that's kind of like the thought process. First, you learn how to make a market, then you realize how your position that you have combined with how the market moves will affect the P&L at the end of the day. And you get to a point where you feel like you can actually make those markets, adjust, or act like a trader in the pit and make money. And I started doing that. The trader that I was covering, that I was clerking for, ended up moving to San Francisco for the company to work in the I guess it's now called ARCA. The Pacific Stock Exchange had options on the floor. So I was actually kind of market making outside of the pit, going through brokers. If they had an order that I liked, I would actually tell that broker. And I don't know if it was legal or not, but they let me. So I was actually making money as a trader for the company as a clerk. So you kind of like get to a point where you feel comfortable and you're like, I need this. I need to be in the pit. Like, I know what's going on. So it's a training of your confidence, and not everyone gets there. But I mean, that's what it is over the 9 months. And it's kind of like a step process. It's a step function. It's not necessarily everything is smooth, but you just kind of get to a point where, like, I get it. And let's move on to the next task.
Sure. Okay. Yeah, that's really good. So during that time, were there any significant events that you will probably forever remember from your time as a floor trader? Like, are there any stories you'd like to entertain us with?
I certainly have stories. Let's start with, there's a few which were fun / not fun. I remember, because of the internet bubble happened, and I was doing trades when the trader was in San Francisco. There was a random 50 basis point drop in interest rates, and all I could feel was like a gust of wind, and just like it sounded like a stampede. All of a sudden, traders came out of nowhere, taking a shit, coming out of the walls from the break room, and SPOOs went up 3% in 5 minutes. I was like, holy shit, what this is trading. This is crazy. And markets going wide. I remember 9/11. That was, that's like the biggest story for me, really. I was in the pit as a actual trader for the company for about 6 months, and 9/11 happened. I was like upstairs about to go downstairs. The first plane hit, and we had a trader in New York, and he's like, the World Trade Center just got, the plane went into the World Trade Center. I was thinking it was a Cessna, like whatever, accident. I went down to the floor, and the second plane hit, and it was just like, I remember being on the floor. I'm like, I'm protecting America's capitalism. I'm staying on the floor, but eventually they kicked me out. It was just like I was like young, and it was just like so patriotic, and I was on an exchange. It was just crazy because like the first day the markets opened, I've never been a part of trading like that. You're talking about the S&P flying all over the place. That was the pit that I was in, the S&P 500. All the option market, it was so wide. Like we made more money than I've ever seen that day, and I felt bad about it, and it was just crazy. It was like juxtaposition of all types of emotions, but it was like I was, as weird as it sounds, I was very lucky to be a part of that. If anyone was going to be, someone had to. I remember one time, more just comedic stuff, just to put away the 9/11 tragedy. I was kind of a raver back in the day. I would party on Thursday, come in, no sleep, and doing raver stuff. But so I got there was it was in the Chaim Bodek's book Dark Pools. There was a quote about me doing this. It's kind of funny. It's like the big broker's like, "Hey Ween, how much for you to snort line of cayenne pepper?" And now, just to say, there was the cattle pit was on the same floor, so people would buy, beef jerky, spicy beef jerky, and the shrapnel on the bottom, the scraps, they're basically dared bet me to snort a line of that, and I was like, $200, and they were done. If I waited 2 minutes, I would have got 1,000, but I was an idiot. So I did that. It was hilarious. I was there when Globex first started, and there was arbitrage between the floor and the Globex. So basically the beginning of electronic trading and the demise of the floor trading. I was late for work that day. I just met a girlfriend that I dated and ended up dating her for 3 years, and that was a long, long time ago. But I was shit-faced from the night before. I woke up because my clerk was like, "Ween, where are you?" I'm like, "I thought it was Saturday." And she's like, "Get your ass to the floor." I was like, "Shit." So I got to the floor, and my boss was like, "We'll talk about this after the close." I was going to be fired that day. They were looking to can anyone. The floor was dying. But luckily, what saved my job that day was that there was a random bid for some 6-month option, and I made 15 grand in about 2 minutes. Didn't even have to hedge it. And the great part was that the guy that made this, he was the big guy in the pit, the big market maker. Thought he was the shit, and he made this market where he offered these options, for sheets for my theoretical value, but they were bid 75 cents over in Globex. And that, I remember that day because, I was able to celebrate with my girlfriend and then my buddy after, and he was like, "They were going to fire you." I was like, "I know." But because of Globex and electronic trading, that saved my job. I ended up quitting a year later to focus on electronic trading, but that was pretty apropos for electronic trading, my introduction to Globex. So those are the few of many.
Yeah, no, those were excellent. Thanks a lot for sharing those. And I do remember reading that part in Dark Pools, and I did have a good laugh while I was reading that. But I think this kind of leads into my next question here. And at what point did you actually decide to get out of floor trading, and what were your reasonings for this?
Yeah, so I had a buddy, and I'm going to go bowling with him pretty soon, but I had a buddy that he started off at my company. My company laid people off right before 9/11, and he kind of bounced around market making companies. The volatility was kind of low, so it was, a lot of, even if you're a good trader, there's a very possible chance that you were going to get canned or laid off because the volatility was so low after 9/11. And what is low? Low means that the S&P moves on average less than 1% a day, which is very from high to low. The high-low volatility was very low day to day, and it was like the floor's coming to an end, the volume's low, and my buddy was working as a stock, kind of like a customer market maker, which I do to this day, while I'm working on this hedge fund stuff. But he was making money doing exchange arbitrage, doing intrinsic value arbitrage, things like that. And he was working for himself, doing really well. And I wanted to go back to grad school because I wanted to get to New York because I'm a Boston guy, and it just made sense for me to, focus on getting into grad school, trading for myself. The floor is dying. This looks like a good opportunity. And so I went for it. I was like, I told my boss, I'm like, I think that's it. And, he was kind of happy for me because he, who knows in 6 months if I would have had that opportunity. And 6 months later, the other trader that was in our group quit too. And my head trader went on something else. It was like, it kind of was all falling apart at the end of 2005 and then into 2006. And that's when I quit at the beginning of 2006.
Okay.
It just made sense to me. Yeah.
Yeah, got it. So I know around that time, at some point, you got a master's in financial mathematics. So I'm curious to know, even though you'd already been trading for several years and you were doing quite well, what was the advantage you saw of actually going back to study further?
The advantage was that I could get into a hedge fund or a trading company, and I got into Trading Machines with Heim. But again, it was just like how I got into trading. I like math. I love the pricing, the option pricing theory. It's like something that I enjoy. I love, and I love it even more than I did then. And I just love how options are priced. I love how option Greeks are calculated. I love how prices and Greeks evolve over time. It's just something that's just so elegant and sexy about it. It made more sense than getting my MBA. I also fucked up on my MBA score. I got a 670 or something like that, and you needed above a 700 to go to a top school, and I was going to take it again, but I found out about this Chicago financial math program. I didn't even need a GRE if I had experience. It kind of just worked out, and it just made more sense. So that's why I took this program. It seemed natural to me.
Okay, sure. So you mentioned Trading Machines there, and I'm keen to dig into that. So after graduating, you went to work at Trading Machines, which I'm sure must have been a very interesting time in your career. And for those who aren't familiar, would you like to tell us about Trading Machines and what was your role there?
Yeah, so I got into Trading Machines kind of in the beginning of the financial crisis. I remember I was kind of finishing up grad school. My buddy had some position on. He was trying to sell vol, and Bear Stearns was happening and all this crap. So it was just a crazy time to start. It was a startup. So my role, I was not the head trader at the time. There was a head trader. He kind of sucked. I did the first trade. I did the last trade. I was basically the tech sector trader. So Trading Machines was a black box, not technically a market maker. We did quote at some points, but we were a takeout engine. So we would see orders, basically customer orders that were bidding or offering limit orders and options, and we would take them if they offered edge, just like in the pit. An order comes in below my theoretical value, as long as it seemed like a good, there was enough edge for that particular stock, we would trade it. And I would also, so that thing would run on its own. Then at the same time, I would kind of lean that trading machine's black box. So it's kind of gray boxing. I'd be like, well, I don't think we're moving much, so I only want to sell options. So I would toggle some things and be like, just sell. And I would have to monitor the hedging of the stock. And that kind of the demise of trading machines revolved around basically the manipulation of high frequency traders affecting order types on exchanges, and that's a 2011 to 2015 hot topic. Haim, is a whistleblower in that. So basically, I'm watching the hedger try to buy or sell stock to hedge my option positions, and we'll forget about the HFT stuff. Puts a sour feel in my stomach, but so I'm basically making sure that the volatility trading that we're doing is appropriate, and when it's time to only buy or only sell, I toggle some switches. I might hand click too, kind of like when I was trading stocks for myself after leaving the pit. If the machine thought that something was too risky to trade, I might be like, I might override the machine, and I did really well doing that. And I focused mainly on tech stuff because that was kind of my speed. The S&P was so boring at that point. I left the pit. S&P is very different in the pit versus outside of the pit in terms of the action. So SPY was boring, Qs were boring, but Amazon, Netflix, Google, doing a lot of expiration stuff. So pinning was really big in Google back in the day. So doing a lot of that stuff, working on making new logic for executing, for quoting, for trying to figure out why this hedger was screwing up. That wasn't really my main thing. We had a guy that was supposed to be in charge of that. He kind of sucked. That's one of the problems we had. I remember 2000 being at Trade Machines going in. It was New Year's Eve 2011, and trying to hedge, correlation hedge gold versus SPY. It was such a crappy beta. But I remember just grinding it out with Haim, trying to save this damn company that was basically ruined by HFT, manipulative orders, high not slide orders, that direct edge and bats were the kind of the reasons behind that. So anyway, towards the end, trying to save the ship. In the beginning, just being part of the whole fun team. This is the new wave of option market making, and then the slippery slide towards 2011, and trying to do the best I could. It's kind of a tragic event.
Sure.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more earnings tracking. Zero locate or hard to borrow fees. Start your evaluation. Get funded with up to $200,000 in buying power. Master.
That he really
previous position at UBS, running the U.S.
Link in the show notes to start trading with Trade the Pool's capital.
Okay, so tell us, what was it like working with Haim Bodek? Was there anything market related that he really introduced you to, which you were maybe perhaps previously unaware of?
Yeah, I guess market structure was something that I wasn't a king of. I I understood exchange fees, but I had a background for being a customer market maker, and he was like, "Oh, you're one of those guys," and it was fun working with him at that angle in the beginning because I was considered a barnacle from his previous position at UBS, running the U.S. global equity option market making platform. But he kind of, I guess, introduced me to micro prices, That's kind of the main thing. Coming from the floor where things are wide and being, exposed, you basically just kind of trading. This is pre-decimalization. So he kind of introduced me to decimalization, sub-penny pricing, and dark pools and things like that. I'm like, I was so, not that I kind of caught on to it, but I was so like unaware of the battles that went into dark pools. I had traded on them indirectly through my platform experience as a trader for myself for a few years while I was in grad school, and never really realized where my stock was going. So we introduced that concept, kind of opened my eyes to Goldman Sachs is selling or actually I had Merrill Lynch was selling my flow to some other maybe to UBS, and it was all like, he, as he calls it, exhaust, and the next guy will pick and choose if my stock flow is good enough or my option flow is good enough and they want to keep it or not. So it was just weird that I didn't realize that the different layers that occurred between when I press a button to trade and who the final recipient is of that flow. So he basically slowed down the process from a customer action to the final market maker that got a piece of that pie. And it was very fascinating to me. And I learned a lot in terms of market structure and micro pricing. I was kind of introduced more to correlated tradings with his partner, a very smart guy, Tong Wei Ko, and that was more the correlation trades between the different ETFs, say, and baskets, stuff like that, which we experimented with. So that was fun. More math, I enjoyed that. But yeah, so kind of aside from the volatility stuff, how to analyze the market in a different way. That's kind of Haim's main thing.
Yeah. I mean, that type of thing is really fascinating, and I mean, I also find it very interesting. And I suggest if anyone listening, perhaps if that got a bit messy there, definitely check out the book Dark Pools. Haim Bodek has he's in that book for quite a few chapters and really goes. I mean, Scott Patterson, the author, really goes into depth with how it all sort of works in the dark pools and that type of thing. So let's keep this moving and let's dig into your trading approach, how you're trading these days. So tell us, how would you describe your trading approach and what are some of the key things you're looking for out there in the market?
All right, so I am a market maker at heart, as we know. So right now I am, and I guess we'll turn back to when Trading Machines ended. I worked with Haim for a year on Trading Machines 2, and that kind of like slowed down, and I had to start trading for myself. So I started being a customer trader again, like I was during grad school, and trying to market make. And I was trying to figure out what to do, and so I figured it out. I traded Apple only pretty much for 2 years, market making the wing options, so the out of the money stuff, the stuff that doesn't move that much. But I was trying to take advantage of the fact that Apple had so much volume that I could buy 2s and sell 4s in some out of the money thing, and there was so much back and forth. I was able to market make with my finger, which I don't know how many people were doing that for 2 years, but it was great. Doing fairly well, like 6 figures, low 6 figures doing that. And then when Apple split last June, it totally fucked up my life. So I tried doing the same thing in other tech names like Amazon and Tesla and Netflix, and that works to a little somewhat of a degree, but not as great. So what I am doing more and have been working on is kind of doing simply like Friday, buying cheap options when the time is right and there's going to be a move. So more of a directional trader. I'm more of a directional trader now than I was ever before. But what I'm doing is basically looking for that home run on a Thursday, Friday. I mainly just trade Thursdays and Fridays while I'm working on big picture stuff. And So again, what I'm doing is I'm kind of looking at the tape and looking at charts and looking for a retrace or a continuation and buying a cheap option or buying a cheap spread. I might sell some other stuff, sell some premium, but you tend to do much better. And I know me, like if all of a sudden if I sell an option and it goes in my face, I have to get out quick. So I don't let things go in my face. And that's what made me successful in Apple for those 2 years. As a market maker, any market maker really, whether it's me clicking as a customer or a market making operation, they try to keep their risk tight. So being that Apple isn't there anymore and trades completely different when it's a $100 stock, I trade directionally, but more leaning towards, again, buying options, not selling them. And looking for that big home run play, and I'll read the tape too, which will help defend my thesis. And I might, look for certain times of the day on a Friday when I think, if we market dumped out and we're leveling off, there might be some buying patterns around 2 o'clock, 2:30, something like that. I also use one of my friends is he has a StatArb signal that I use on Thinkorswim, and I can see that there's a reversal signal. I put that together with my own intuition, and then I see the tape, and I see this, SPY is starting to catch a bid too. So that's when I'll come in and try to place my home run bets. And those are the main things I'm doing right now.
Sure. Okay. No, that's really good. So I guess now would be a good point to dig into options a little bit deeper. So probably a good starting point for this would be if you could explain to us what's the real reason that options exist as a product? Like what were they originally designed for, and what's the right reason for trading options? I mean, I know people trade them in all different ways now, and they do it quite well, they make money. But what's the real underlying reason why options exist?
Sure. I mean, the first real reason was to hedge stock, hedge your portfolio. And that's when the put was invented. And then they realized that, we should invent a call too. So kind of the put was first just to hedge portfolios. Then they invented the call because you learn this as a trader trainee, like I learned on the floor. Call and a put are the same thing if you're trading volatility. And so it evolved from just purely hedging to, all these market makers have positions because, if you're going to buy a put to hedge your portfolio, someone's got to sell it to you. So that's kind of how the market evolved. So the market evolved, and for the liquidity providers that allow the portfolio managers, the institutions, the banks to hedge their customers, hedge their positions, things like that. And then volatility trading existed because the market makers, if they sell a call, you have to hedge it. And the underlying pricing of an option is the implied volatility. Implied volatility is, we're probably not going to get into that detail now, but I mean, that's just the way to quantify the value of an option on, I guess, a day-to-day basis, whatever the time frame may be. As you get closer to expiration, that implied volatility number gets crazy, so it's not really valid. But that's the reason for the option market is to initially, again, just to hedge portfolios. Then you have the market makers that take the other side of the position and they're evaluating it in terms of implied volatility. But then, the next level is what we're looking at currently is, you trade options to hedge volatility in the market. That's where the VIX comes from. So it's kind of evolved to, as hedging market volatility, not just market direction. So that's kind of the third stage of why the option market exists.
Okay, sure. No,
That makes sense.
That's really good. So, would you be able to break this down for us? And you've kind of mentioned in your previous answers directional trading and then non-directional volatility options trading. So, besides the kind of the obvious distinctions between the two, what are some of the other distinctions that make these two approaches significantly different?
Okay. Well, there's different types of traders. Again, so we're looking at, directional traders that either they want to buy, calls because they think the market or that stock is going to go up. They want their downside to be limited to how much premium that they buy, or you could have. So those are premium buyers. Then there's premium sellers that have a direction. So they think the market's going up or that stock's going up, so they'll sell puts instead. So it gives them premium with a bias that the stock's not going to go below their strike price. Then you have the volatility traders that think that, based on this implied volatility, or they might just look at simply premium price, just like I was talking about the premium sellers that trade with direction. The volatility guys might just be like, okay, well, based on this implied volatility of this 3-month option, I don't think that this 3-month option is going to move 3% a day on average. I think that the implied volatility is too high. I'm going to sell a straddle or a strangle and collect premium. Whereas maybe a volatility buyer thinks that this option is too undervalued in terms of its ability to move over the course of the next 3 months, or say it's a weekly. They think that there's some activity that's going to happen, and they're going to buy options. They're going to buy a call and hedge it, or put and hedge it, or buy both the call and put at the same strike. That's a straddle, or buy a call and put at different strikes, and that's a strangle. And they're going to make money if the stock goes beyond the strike prices plus the premium that they paid. That going into greater detail, but they just think that the market's going to move in one direction. They don't care what direction it is. As long as it moves more than the option requires it to, I'm going to make money. So those are the two different types of volatility traders, buyers and sellers. I guess related very well to directional traders, up or down. So then you got the market makers in between that are basically trying to, make that spread between the bid and the ask. And kind of manage those two different types of traders. And the market makers, again, are kind of like the volatility guys, but so hope that wasn't too complicated.
No, that's good. So in that case, do you suggest to options traders, probably more newer options traders, that they either specialize in one or the other? They're either directional or non-directional trading, or do you feel as though it's worthwhile to have a well-rounded approach?
I think if you are a new options trader, you need to really read up on what options are. Now, not like me as a trader trainee back in the day, but you got to know, mostly the new traders can only buy options, but you have to realize how much capital that you're putting at risk. So it's definitely wise to be a directional guy first, because at least, if you're buying volatility, you're buying a call and a put. So yeah, as long as the stock moves heavily in one direction, either one, that's fine. But most likely you're going to buy the wrong options. They're too far out of the money, and you're going to waste your money on premium. So it's good to know, what you're spending your money on. The time frames. That's more important. Like if you're going to invest $1,000, and investing I'm using that term loosely. If you're going to bet $1,000 on an option, you should know, what that $1,000 is offering you. The stock needs to move 5% in 3 days. That's probably stupid unless it's a name that does move 5% very often. So that's more important, is to understanding the time frames that you're trading and the realistic goals of that stock. And if you think it could just move because there's earnings, you need to also know that market makers build in that earnings move into their option premiums. So if you're buying, a call and a put, you're buying a straddle of say Amazon, and their earnings are on a Thursday before expiration, you realize that you're on one straddle, you're spending $3,000. So you got to be educated. Do you think Amazon could move $30 just for you to break even from that strike price? So it's about doing your homework on what you're spending your money on. A new trader could be a volatility trader. I don't expect them to be. Usually a new trader that's trading options was a stock trader at first. So now they want to leverage their money by going directional, by buying a call or buying a put, and that's fine, but you got to know your time frame. You got to know that, okay, I'm going to buy this call or put, but if that stock doesn't move by the end of the week or in the end of the month, then you're going to be out X amount of dollars. Whereas stock, at least that stock's not going to expire, so you got to understand those concepts.
Okay, so you really emphasized the importance of doing your homework there before you even get started. Are there any resources or any books or any educational material just off the top of your head that you would perhaps recommend to anyone who's keen to get deeper into options?
I certainly do. Natenberg, I think it's John Natenberg. That was the Bible as a floor trader. Natenberg is number one. It's 200-300 pages. I forget. That's the Bible for option trading, for understanding the different types of trades, spreads, things like that, and learning about volatility in the Greeks. So that's good. John Hall has a good book. Those are the two that I recommend. I don't know any other newer ones. I'm sure there's some Wiley books, but I don't really know much about them.
Okay, and what are the titles of those two books?
Let me look it up right now, just for everyone to have. Okay, yeah, it's Sheldon Natenberg. Sorry, Sheldon Natenberg. Option Volatility and Pricing. Creative title. Yeah, so that is it's on Amazon. It's $35, new or used. I suggest buying the cheap used version, and that's basically the only thing you need to know. But it's geeked up. There might be a dumbed down version of something else, but again, that was the first time that that was the first book that I read. Actually, John Hall was the first book that I read. That was while I was at Georgetown. Let me look at that one. That is Options, Futures, and Other Derivatives, John C. Hall.
Okay,
excellent. That's what I learned at Georgetown. Yeah, so
cool.
Yeah, those are the top two, and I have a course on St. Lucie about introduction options as well.
Sure. Okay. Yeah. Well, I'll make sure to add links to all of that in the show notes. So that'll be available at chatwithtraders.com to everyone who's listening. Well, this has been really good. We should probably start to wind things down. Let me just ask you one last question, still around the topic of options. What would you say is one of the areas where traders new to options most often come unstuck? I mean, is there anything particularly important that sometimes gets ignored by newer options traders? I mean, you already hit on homework and obviously preparing yourself beforehand, but is there anything else that comes to mind besides that?
It's just a lot of times it's disappointment that I already talked about it, that, you wasted money, you bought an option and nothing out, you actually just watched your money go down the toilet. So that's one thing. But then, if you are able to sell options, the key is knowing what your worst case scenario, your max loss is. That's very important. Now, when you buy an option, max loss is how much premium you paid plus commission. If you're able to sell options, say you're a rich guy, say you're a guy that has, you're a first time trader, but you know what, you have $50,000 in your account, they're going to let you sell options. You got to know what your max loss is. You got to know that if you sell a call in, say, a biotech, and the stock rips because of an FDA approval. Say the stock's trading $10, but you sold a $15 call. You're like, oh, this is so expensive. It's worth $2. Sold. The stock could go to $30 in the morning, and you're out $200,000, and the clearing firm's like, you owe us $150,000. That's something that's very important. So that being said, it's important for you as a new premium seller, a new option seller, to cap your risk, and by doing that, the way to do that is to spread it. So if you sell, say, that $20 call, buy the $25 call against it, so that you know what your max loss is, and that's very important. If you sell a call, buy a higher call against it. If you sell a put, buy a lower put against it to have your max loss. And that's the most important thing I can say, because it's all about preservation of capital, especially when you're selling options. It's very risky, and I do that to this day. I spread everything. With Apple, I didn't as much when I was market making with my hand, because, aside from one or two instances, Apple I had confidence in that, but that was still stupid. You got to preserve the capital, hedge your risk, and going back to, if you can sell options and you're long premium, it's always good to, say you want to buy a call because you think a stock's going to go up. Nothing's wrong with selling a higher call to hedge your premium risk, so you don't lose all of your, say, $2,000 investment. You might get $500 by selling a call against it. So, it's all about hedging stuff. And, not everything's gonna be a home run. That's the other thing I have to say is, there's nothing wrong with taking some of your profits off the table, even if you think the stock's gonna keep going up. You never know what's gonna happen. There's always, some fund that's trying to sell some of their position. Carl Icahn could just all of a sudden dump out all its Netflix shares, and you'd be like, I should have sold those calls. So, when in doubt, get out of half. That's the other thing I could say is, when in doubt, get out of half your position.
Awesome. Love it. All right. Another brilliant answer, Brian. Thank you very much for doing this interview. I think options guys are really going to enjoy this. And I think everyone else is going to find it really insightful as well. So before you run away, do you want to share with listeners where they can go to find out more about you and connect with you?
Yes, certainly. Sanglucci.com. SANGLUCCI.com. I featured partner there. And then also I am on Twitter, Dirty Automatic, K at the end instead of a C. That was my DJ name, and that's been my Twitter handle forever. Dirty Automatic is and you can ask me questions about options anytime you want. I always respond. I love talking about them. So either or, I am available.
Okay, well, in that case, would you be happy to answer any of the listeners' questions if they just leave a comment below this interview?
Yeah, definitely.
Okay, cool. Well, there you go. If anyone has any questions about options or trading in general, just leave a question below this interview at chatwithtraders.com. All right, Brian, again, thank you very much for doing this, man. Have an awesome day, and let's talk soon.
Thanks, you too, brother. That was fun. Thank you.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join tastytrade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. tastytrade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. tastytrade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? Hope you're doing really well. Welcome to episode 41 of the Chat with Traders podcast, and thank you very much for listening in. This week, my guest is a discretionary futures trader from London, UK, and his name is Cam Dada. Cam originally started out in 2001. From 2005 onward, he spent a few years trading within a prop firm, and nowadays has reverted to trading independently. During this interview, we discussed the great emphasis Cam places on auction market theory, market profiling, and volume profiling techniques to capitalize on intraday moves. Additionally, we also discussed the importance of believing in your trading plan, the 2 types of risk, both financial and psychological, and how Cam uses NLP, mindfulness, and meditation practices to continually improve trading performance. Plus, plenty more as well. But developing the right mindset seems to be the underlying theme throughout this episode, and I feel as though you're really going to enjoy this one, so let's just get into it. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest, Cam Dada. Cam, welcome to the podcast, buddy. How you doing?
Yeah, very well, thank you. Thanks for having me.
No trouble whatsoever. Thank you very much for coming on and being cool with an interview. I have a feeling this is going to be really great. So, I mean, I know it's Sunday evening for you right now. Tell me, how's your weekend been?
Yeah, it's been good. I spent some time with the family, spent some time with the kids. And that's the main thing for me. That's my priority in life right now. Spend as much time as I can with the family and my kids. That's my sort of life right now. So I spent some time with them and enjoyed some days out over the weekend. So we had some good fun. So it's been good.
Very cool. Good to hear, man. Well, Cam, I'd like to go right back to your early days in investment banking. So tell me, how did you come into this job? And when did you begin to develop an interest in trading?
Yeah, well, when I graduated from university, I started to work in investment banking, but on the trading floor as a desktop support engineer. So I was providing the traders support for their PCs if there was any issues with the software, the hardware, etc. So that's how I got into investment banking, but I wasn't in the the trading industry itself, but I was supporting traders. So I just found it fascinating being on the trading floor on a day-to-day basis, and I just found it was really exciting. So I started to speak with some of the traders there, started to ask them how they got into it, and I just become obsessed with trading, and I just wanted to become a trader. So I started to read some books. One of the first books I read was A Beginner's Guide to Day Trading Online by Tony Turner, and that book sort of taught me some of the basics to get into trading. It was actually recommended to me by a trader there. So I read that. But the interesting thing for me was there was this center point. It was a center point at the end of each chapter, which basically was a motivational quote, but also some paragraphs on trading psychology, self-development. So I really sort of got interested in the fact that, psychology was so important, the mindset, developing the mindset, etc. So that really sort of got me even more interested. I really got sucked into the, developing the right kind of mindset, which really helped me when I actually started trading, because I spent a hell of a lot of time developing the right kind of mindset. And then I actually started to, develop the strategy. Whereas most traders get into trading and they will develop a strategy, try to trade their strategy, and then realize they have to work on their mindset. So, in that sense, I actually had a bit of a head start. And that's how I got started in trading, developing the interest in trading. So back in 2001, I started to trade a demo account for about a year. Then I borrowed £5,000 off my mother, and I said, I'm going to open up an account. I opened a spread betting account, and I started to trade the mini Dow in the evenings after work. And I did that for about a year and a half, and then I just decided to just dive straight in. 2003, it was the summer of 2003. I decided to dive straight into trading. I started to trade futures then, and I was trading full time since summer 2003. And basically, I just borrowed some money off my mum. I borrowed £25,000. I was lucky enough to, be handed that money and be trusted with it. And in 2005, I got into prop trading. One of my friends, which went to school with me, he actually was sort of born into the stock trading world because his dad was a trader. So he went straight onto the London Stock Exchange and then into prop trading. He introduced me to prop trading back in 2005, got me some financial backing. And, that was where the, journey really started.
Okay, Cam, that's really good. So let's really zoom in to that journey. So did your role in investment banking, do you believe that it all sort of prepared you for what you were about to experience with trading?
Not really. I think it just sort of prepared me in the sense that I knew it was emotion fueled. But, the traders in investment banking are not trading, like I am, you are, as day traders, etc. They're trading clients' funds, it's all long term, there's departments for risk management, fixed income, etc. So it's a completely different world. But, trading is still, it's emotion fueled when you're trading for yourself. So investment banking sort of got me interested, but it didn't really help me because I wasn't a trader there. I was providing support, but I also knew that I wanted to work for myself and do my own thing. So, in that sense, it just sort of prepared me, to go into a business which I knew was going to be emotion fueled. That's about it. There wasn't really much else I learned from being in the investment banking field,
Sure. Okay. So you mentioned that there was a book which really helped you in the early days when you were sort of learning the ropes. Where else were you learning from? Like, what other information were you taking in, and how were you sort of developing your knowledge on trading?
Yeah, basically from my job in investment banking, working for the traders, I developed some friends there, and them guys sort of introduced some websites, some online sources. I used to use stockcharts.com. It's still there. They've got a chart school there. So it's lots of detailed information on candlesticks, chart patterns, etc. So I started to really sort of go into the online material that was freely available. So I didn't really read that many books. I just went through the online material that was available. I came across something called stage analysis, which basically broke down all markets into 4 cycles: stage 1, stage 2, stage 3, stage 4, which I still use until this day. And then I discovered Fibonacci, and I started to really apply Fibonacci on my charts. I was using eSignal back then. So, that's where I really started to, get my own thing going with my own sort of technical strategy, if you like.
Okay, awesome. Yeah, we're really going to dig into your strategy shortly. Just before we get into that, though, so you traded for a few years while you were still holding down a full-time job. How did you manage this? Like, how much time were you devoting to trading, and what style or type of trading did you focus on to begin with?
Well, I was trading the mini Dow. That was the product that I chose to focus on. So I was trading that between 7 p.m. and 9 p.m. because I used to get back from work probably about 6 p.m., 6:30. So I'd dive straight in. The markets were open in the the afternoon in the US, which is our evening here in the UK. So I had that benefit, of course. So I was able to sort of hold my job, but also come back in the afternoon. Sorry, the evening. It's an afternoon session for the US market. So I was able to trade the mini Dow. I then quite quickly discovered that I wasn't really going to make that much of an income just trading the mini Dow. So I decided to also start trading spot forex for swing trading, holding a position for days, if not sometimes weeks. So I started getting into spot forex trading as well. So that's, it's about 2 hours a day I could sort of commit to for day trading.
Okay, and what was the moment when you felt confident that you could make the transition from part-time to full-time trader? And what advice would you give to any other trader who has a goal of doing the same?
Yeah, I was quite lucky in the sense that I was basically living with my mother. I didn't have a mortgage, I didn't have kids, I wasn't married. So in that sense, I didn't really have a hell of a lot to lose. I didn't have a mortgage, I didn't have a house to lose, etc. So And I also had the benefit of getting some financial backing from my mother, which, luckily enough, provided me some support through, me getting started with the business. So in that sense, I didn't really have much holding me back. So I got straight into it. I dived right in. I went to a Tony Robbins seminar, Anthony Robbins, and he said one thing that really stuck in my head, which was you have to put yourself in a position where you have to perform. And that really sort of hit home for me, because I found when I had a job, I knew I was getting a regular income from that. So I didn't really have to commit fully to my trading, because it was more of a sort of sideline thing. So I realized that I was missing a hell of a lot of opportunity in the morning session. So I really wanted to commit to that. So I found myself just taking a lot of time off work. I didn't want to go in because I wanted to trade. I wanted to spend some time there. So it was clear that I didn't really have the motivation to hold my job down. So I had to leave. So I listened to that phrase that Tony Robbins said, and he just said, you have to put yourself in a position where you have to perform. Meaning that, if you're in a position where you don't have to perform, you don't really have to commit, you can sort of get in that comfort zone. But I wanted to put myself in a position where I had no choice. I had to succeed. I had to do something. So that's why I just decided to dive straight in. I went full time into trading, started, trading my own account. I had my ups and downs, as we do. You learn through the experience. But, that was the main thing. Tony Robbins, just that phrase, it really got me going,
Yeah, that's a really great quote. I do like that one. I think that's awesome. I asked this question the other week, and I think it's quite a good one. So when you did make the switch to full-time trading, did you find that your trading habits changed in any way, or was there anything that changed which you probably weren't quite expecting?
Yeah, definitely. The emotions really picked up, because the pressure, once you don't have a job, you don't have any regular income. Luckily, as I said, I didn't have a mortgage. I was living with my mother, so I had a roof over my head. I knew I was going to have my roof over my head. I wasn't going to lose that. So in that sense, I had a bit of support there, but also at the same time, there was a lot of pressure all of a sudden. There's a lot of emotion that came into trading full time, because now I don't have any regular income. I've got to rely on my trading. So, those months, those weeks when you're learning and you're really applying, what you've learned, there's many times where you don't make money when you're trading. I didn't expect that. I decided to get into trading thinking that, I was going to make money every day, every week. It's just going to be linear, meaning I make more and more every month. My financial forecast when I first started trading looked like basically $2,000 1 month, $3,000 next month, $4,000, the next month, literally just sort of adding on £1,000 every month, which is not realistic at all. So trading is not linear. It's not linear for me now. It's never going to be in that way. So you just sort of got to realize that the reality is that it's going to be very up and down, like any business really. Trading is a business, and that's the way I see it. So like any business, you're going to have some good weeks, you're going to have some good months, but then you're going to have some down months and down weeks as well. So you've got to be able to get through that, and that was an eye opener for me. So I had to get used to going through these ups and downs, but sort of get through them as well. Remain resilient, build that discipline to stick with the plan. So there are many obstacles to overcome, but when you get into this business, as most of you guys that are listening will know. So I really had to work my mindset, and that's why in 2005 I become a NLP practitioner. So I took a course to become a neuro-linguistic practitioner. I also became a master practitioner back in 2006. So I started to use those techniques to help myself with my mindset, get into more sort of resourceful states, more positive states whilst I was trading. I learned how to use, the reframing techniques. I was reframing things that I've learned to sort of think as negative or, bad. So I learned to reframe them. So I started to see things like down days and down weeks or drawdowns as positives, meaning that I started to reframe what they meant, because most people will see a drawdown and they think it's bad, something's gone wrong. So I learned to reframe that situation, because I also started to see that after a drawdown or a dip in your equity curve, normally, that's when the good run comes. So I started to reframe that. Even now, when I see a dip, if there's a couple of weeks where I'm not making that much money, I know that the good time is, just around the corner, so I have to sort of stick with that. So, I've learned a lot from, NLP, working on my mindset, meditation as well, so.
Sure. Okay, and just before we move on there, when you did make that jump from part-time to full-time trading, and you did borrow that money from your mother, were you consistently profitable at that stage, or were you still very much in the struggle zone that you were very much learning how to find your feet?
I was making money, but it wasn't consistent at all. It was 2004 that I really had, a period where I started to make some consistent money. I started to come over, get over some of my obstacles, etc. And then in '05, when I went into prop trading, that's when it was a real sort of eye opener for me with my trading. So, it wasn't a straight run where I was making money every week and every month. There were some down weeks. Most months were positive, but there were some months which I made very little.
Okay. So if we had to sort of kind of sum it up, what would you say were your greatest challenges and even failures in that early stage that you had to overcome during those first few years?
I think it's just sort of realizing that there are many parts within us as human beings, and they really come out when you get into this trading business. So you really have to face your demons. It wasn't something that I was expecting. I knew that the psychological aspects were really important in trading. I knew you had to have discipline, but I didn't realize to what extent you really have to face your demons, your inner demons, the things that are part of us, but they are also at the same time sometimes in conflict with your goals and your objectives. So I started to recognize that I had parts of me that would sort of help me achieve my goals, but there were also parts that will fight against those objectives because there's a fear, there's the ego, and the ego is a big thing that I had to overcome. The ego is the key ingredient for failure and for drawdowns, because the ego is it's all about the self-image. The ego is the self-image. It's what you think about yourself. It's what others think about you. The thing in trading, we really have to accept losses, right? I don't even call them losses. I call them the cost of doing business, expenses, because I don't use the word loss. The reason is because loss itself, that word has a real deep sort of pain associated with it, with any human being. So it doesn't matter within what context. Loss is just seen as a negative thing. So as soon as you hear it, it just feels negative. It sounds negative. So your state just shifts. So I don't use the word loss. I never talk about losing trades, losing days. I always call them expenses or cost of doing business. The things that I've learned as a trader, the main things that I had to overcome is the ego, the self-image. Get used to accepting that you can be wrong. Get used to accepting that you're not going to always be right, and your strategy, it doesn't matter how good it is, you're going to have uncertainty, and you have to embrace that uncertainty.
Yeah, and I think that's a really powerful way of looking at losses too, so I'm glad you really brought that up.
Yeah, in NLP, one of the things that I learned is, you have to, language is a very important factor, in us as human beings. In NLP, we learn that 55% of our state in any given moment is really, it comes from our physiology, how our body is, right? But 38% is the language. Only 7% is the words. So 38% is a big chunk as well. So you can shift your physiology. Like if you're depressed or you're sad, your body, your physiology is completely different. Okay. And if you're confident and you feel good, your physiology is completely different. Your heart rate is different, your blood pressure is different, but your body feels completely different. And you also have a different posture, So these are things that I had to become aware of and really sort of focus on understanding. I learned that when I was over trading, I leaned forward. My physiology was different. When I waited patiently, I was actually sitting back and my back was against my chair. I learned that when I stopped using language that was not positive, such as the word loss, a lot of traders use the word loss or down, they call it a losing day, a losing trade. They even call themselves a loser, But the thing is that word itself is very, very powerful. Not just on a conscious level, but on a subconscious level. So you can't really turn it around. Many people struggle to see loss as a positive thing because loss itself has a very deep-rooted feeling within most people. Loss of a loved one, loss of money, loss of a job. It just doesn't feel good to most human beings. So you shouldn't use the word. You can take it out. I don't use it in my journal. I don't use it in my trading journals in terms of my spreadsheets where I record my trades. I actually have renamed the columns where it says loss as cost of doing business. So these are things that anybody can do, and it really does have a powerful effect, in the long term.
Okay, sure. That's really good, man. Thank you for explaining that. It's very well said. So you've mentioned your days as a prop trader a little bit. I'd like to kind of zoom in on that if we could. So talk to us a bit about your prop days. Like how did the opportunity come about and what did you just make of the experience?
Yeah, when I got into prop trading, one of my friends that I went to school with, like I said, he was pretty much born into the trading world. His dad was a stock trader. He went straight into the London Stock Exchange as a floor trader. And then he went into this prop firm, which he was one of the directors at. So he introduced me to the firm and got me some financial backing based on my past performance. So I got some backing. I basically was able to trade quite a bit of size. And initially, when I went in, first few weeks, I traded way too much. I started trading 20, 30 contracts. I used to trade 4, and I was up and down. The P&L was just swinging up and down. And it's the first time I experienced that level of anxiety, that kind of fear. It was unsettling for me. So I realized that putting on size is not just as simple as just sort of having the capital and being able to do it. It's there are two kinds of risk. There's psychological risk, there's financial risk. So just because you can take that kind of risk, if you've got 500 grand in your account, you can take 1% risk, which is 5 grand. It doesn't mean you can psychologically handle it. Financially, you might be able to, but psychologically, you might not be able to. So I had to learn that when I started trading, much bigger than I really should. I started to do a lot of scalping when I went into prop trading. And, for me, scalping is not what I do. I tend to focus on more of a longer term perspective intraday. I tend to look for like 1 or 2 good trades per day. I'm very, very picky. But I started to try to become something that I wasn't because I wanted to try it out. Because everybody in London back then, prop traders, everybody was scalping. I used to be called the longer term trader, even though I traded intraday. So, scalping is something that I tried to get into during a time where, I think it was a lot more, there was a lot more potential. It was more achievable. Not to say you can't scalp anymore. It's just not my choice. I think of, what I do is playing football, scalping as playing tennis. They're both sports, but they're 2 different sports. And this is the thing that I find with traders when I'm coaching them. They try to mix it up. They will listen to a scalper, learn execution from a scalper using order flow, and then yet they're looking for, a 20, 30 tick run based upon a longer term perspective move. And, people start mixing things up because they're listening to like 10, 20 different people. And, it just gets really confusing. And I think people just have to commit to one style. There's a lot of a mix up right now, with the guys that I work with. People are trying to use scalper risk, scalper execution strategy, but try to hold the trades longer. It's not going to work. So, in prop trading, I learned that, there was a lot of traders using profiles. That was when I got introduced to profiles, order flow, reading the DOM. A lot of traders didn't even have charts. They just had, the trading ladders, the DOMs, and they just looked at those and they traded off that all day long. So, I learned quite a lot from being there, but I also learned that I didn't like being in a trading floor environment. I found it very distracting. I didn't like the fact that it was so emotion fueled. I didn't like the fact that people were sort of start swearing, chucking monitors and screens across the room because they, had a losing day or losing trade. So I found it very emotion fueled. So I sit there with my headphones on. I wanted to go back home. I sat there for 3 years trading there because I wanted to go back home and I wanted to trade from my own office again. So I did that in 2008. But prop trading taught me a lot about myself. I learned that I actually don't want to be in that environment, but some people do. I coach some people, they love to be on a floor. They like that competitive environment. They want to be surrounded by other people. I'm very much like, I want to trade. I don't want to be distracted by anyone, So everyone's a little bit different. So I learned that from being there.
Okay, so what were some of the main reasons that kept you there for the 3 years? I mean, was it the access to like the coaching and the education or the technology?
Well, there's not much coaching really. You do have psychological coaches that come in every 2 weeks or so, but in terms of technical training, there really isn't any. I went in as a trader that had a track record and had my own strategy. So I was backed, but I wasn't taught. So I had to learn myself. So there wasn't much training. It was really, it's the financial backing. It's financial backing. The profit splits. I built up a good profit split, but the thing is, I was paying very, very high desk fees back then. So I was spending a lot paying for these desk fees. You actually do start off down every month because you have to pay your desk fees. It can be anything between £2,000 to £3,000. Now you can probably get away with £1,500 pounds a month, but those desk fees, you're down that much every month. You have to make it back, and then you have to share your profits on top, which I don't think is a bad thing because you can get a hell of a lot of leverage. And it is, for many people, it's easier to trade somebody else's money. If it's not yours, there's less emotional attachment to that. For me, I didn't really see it that different to trading my own money, but I got to a point. It was more of an environment thing, But I think prop trading has its benefit. I had the benefit in 2008 to continue to clear through the prop firm, so I got the benefits of the risk management. So there's still that risk layer. There's a risk management desk. I have a risk limit on my account. I have the technical support, etc. So I had that set up since 2008, and I still have it now. I've actually started to offer this now to independent traders because it's not available typically. Most independent traders go to retail brokers. So I've got a setup now where traders can clear through a prop firm. They get the lower commissions, but they also get that risk monitoring. The risk monitoring is a key thing that keeps traders in prop coming back the next day.
Sure, absolutely. Okay, so looking back on what we've covered so far, with the power of hindsight, is there any way that you feel as though you could have avoided some of the difficulties that you went through?
Not really. I don't think I really would want to avoid the difficulties because it's. I believe that it's the difficulties, the pain that you have that really makes you grow. So it's very difficult for me to say that I would not want to have experienced those difficulties or think of ways that I would have tried to avoid them, because if I didn't have them, I wouldn't be who I am today. So I think you grow through pain, you grow through discomfort. You got to have that. If you go to the gym, it's a pain, it's a discomfort that's going to make your muscles grow. It's the same thing, in terms of trading. Your mind's going to grow if you test it. If you keep testing the discipline every day, it's going to grow. But you got to remain resilient. So it's the pain, it's the discomfort that makes you grow. So I don't think you have to avoid it. I think you got to have it.
Okay. Yeah, no, that's a really good point, Cam. So,
are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now that we're pretty much up to speed with your journey and how you got from day one to where you are right now, let's talk about how you trade the market. So if you could, just take a few minutes to run us through your trading style and what you're looking for out there.
Yeah, sure. I'm basically what you would class as a discretionary trader. There's two kinds of traders, really. There's those mechanical systematic traders. There's discretionary traders. So discretionary traders are those that build their plan every day. It's making choices, decisions on the fly based upon what they perceive right now, what they understand right now. That's what category I fall under. So I don't trade systematically, mechanically. So I use what I call the trading framework, which is basically it's a development that I've sort of I've built this over my journey, if you like. So I've been using Profile since 2005, but before that I was trading with stage analysis, which is basically just the 4 cycles in the market. So stage analysis and Fibonacci. So I used a bit of Fibonacci, and also I've always had a top-down approach. The top-down approach, which you start on a daily chart, you then move to a 60-minute or 30-minute chart, and then I would draw down to shorter-term charts, for execution. So I've always had that approach, and I still use those tools until this day because they're very useful. So that sort of gave me the foundation to start trading. And then auction market theory, market profile is what I really started to get into. Probably about the same time I went into prop trading. I started to get some interest in the profile and what the potential was back then. So I started to watch the profile every day. I started to see if I can see any patterns. I read Mind Over Markets by Jim Dalton, which is a great book. It's not very practical, but the theory is there. It got me started. I read the book by Stoudemire as well, Stoudemire on the Markets. I read the Chicago Board of Trade Handbook, which is great. If you read the first 2 chapters, that's pretty much all you need to know about auction market theory. That was a game changer for me. The Chicago Board of Trade Handbook, which is freely available now from the CME website. That really, the first 2 chapters of that book just made it really simple to understand auction market theory. It just made a hell of a lot of sense. So from that point, I started to work with the profiles on a day-to-day basis. So I use market profile, volume profiles. I use order flow. I'm very discretionary. I tend to focus on intraday swing position trades, which are the 1 to 2 main sort of trades you get per day, 1 to 2 main moves you get per day. There will be days where I don't take a trade. I will sit there 4 or 5 hours and not take a trade because it doesn't set up. So my plan is very, very specific. It's very clear. The trading framework is basically, it's a combination of auction market theory, stage analysis, and some use of Fibonacci. So I tend to focus on trading value. So the first thing I do is find where value is in the market. It's typically when the market goes sideways. So the market will spend time there, but it will also distribute volume there. So, you've got to keep in mind the purpose of any market for the exchange is to facilitate trade. Okay, it doesn't matter what market it is. That's the purpose of any market, to facilitate trade. It does that best when we find value. Okay, the reason being is because we then have the market finding a fair price, an unfair price, and an unfair price for the buyers and also an unfair price for the sellers. So the market finds value all the time because that's what it's looking for. So if you actually look at a market and you start drawing these profiles around these balance phases, you will notice that the markets are typically balanced and sideways most of the time. And most traders actually focus on trends. The trends are there, but balance and value is also within trends. But you also have trends within balance and sideways phases. So, it's really a mixture. All the time there's a mixture of balance and trending markets. So, for example, you could have a sideways range over the last 2 months on a daily chart, but intraday you'll have short-term uptrends and downtrends intraday. So, the market's never really sideways or trending in my view. So I basically focus on finding value. Once I find value, I look for opportunities to trade back towards value. Okay, so the trading framework gives me an idea of when I can keep trading towards value and when I have to start looking for the market to move away from value. So that's the thing that typical auction market theory, market profile doesn't teach. So I had to sort of find a way to do that for myself in a very structured way. So the trading framework does that. It lets you see ahead of time when you're going to focus on shorts, where you're going to focus on longs, when you have to give up on the shorts or the longs and actually look, for a move in the other direction. So it's very, very structured. But at the same time, it's not mechanical. So I need to structure, but at the same time, I don't want to be fixed. I don't want to be mechanical, right? Does that make sense?
Yeah, totally. So just before we go on, what markets are you most active in?
My main markets are the Bund, Euro stocks. Sometimes I trade the DAX. So those are products on the Eurex. Sometimes I trade the E-mini S&P. I use the mini Dow and NASDAQ really for confluence, but I don't trade them anymore.
Okay, sure. So, I've heard you speak in the past, and you speak a lot about having context of where the price is. Would you like to expand on this for us?
Yeah, context really, I mean, for me, I can't do business without understanding context. But this is one of the key things that a lot of new traders are missing. They don't really understand where they are doing business or truly understand where they are doing business. So keep in mind that the market, when you perceive the market, you can really tell yourself any story. So I quite often say there's really no truth in the marketplace. It's just an opinion, it's a belief. But the thing is, like what I've built like with the trading framework, it's a belief structure. It doesn't make it right, it doesn't make it wrong. Like somebody else will have a strategy. It doesn't make them wrong because I don't agree with it. You know, that's right for them. So the market, that's what makes the market, these different beliefs, these opinions, you know. So what I tend to do is I tend to focus on market structure to give me an idea of the context. So I always work with a top-down approach. So I work on the daily chart. Some people think, you know, daily chart, isn't that a bit long-term if you're trading intraday? For me, the daily chart tells me what's going to happen over the next few days, maybe weeks. So, you know, that is actually what's going to manifest itself intraday. So if I'm aware, you know, the market might have a move higher this week, I know from the daily chart alone, you know, I want to focus more on the buy side, you know. So I go for a top-down approach in that sense. So that gives me an idea of context on the daily chart, longer time frame chart. I typically trade a longer time frame chart, which is minimum 30-minute bars, 60-minute bars. Those value areas that I trade around might build over 2 or 3 days, sometimes weeks. And I will focus on trading around those value areas with context. And it's finding that value that gives me the context, really. So I go for a top-down approach. I find context. And because I have context, what I mean by context is it's a story. I've told myself a story that I can believe in. You know, I can say, okay, this market is oversold, overbought, because I can see where value is. So I think it's unfair for the seller below value. I think it's unfair for the buyer above value. Therefore, I know I don't want to be a seller below value. I know also I don't want to be a buyer above value. So I know what I want to focus on. So, but it's for a good reason, because I know there is value below or above. So that provides me context. It provides me something to focus on. I quite often say, you know, the market, it's not about direction, because the market, if you really look at it, the markets will move up and down just as well each day. You know, you have good moves up and down. You can make money on any side of the market, really, on most days. You'll have the odd day where we just trend and we just move higher or lower. But typically the markets are, you know, very good on the upside and the downside. There's opportunity on both sides. So it's not about direction. So it's about focus. It's about structure. So to find focus and structure, you have to have a very, very specific structured approach where you have to have context. You have to understand, why do you even want to trade that? You know, most traders struggle with discipline because they don't have the patience. But why do they not have the patience and the discipline if they really believe in what they are doing? If you truly believe in your story and the context that you are trading around, you should not have an issue with discipline. Nothing else should be tradable. You know, it should be only the trades that you've understood because you understand the context. You know, for me, selling below value, it doesn't make sense. I don't care how good that looks on a short-term chart. You know, it doesn't matter to me. I know I'm waiting for the sellers to get trapped. I'm waiting for the advantageous opportunity on the other side. You know, so it's about being very structured and having a very clear understanding of what you're actually looking for. You know, I only trade grade A trades. I'm not looking for crappy trades. You know, one of the things as a day trader is that there's too much opportunity. You can trade every 5 minutes if you like, every 2 minutes. You know, there is too much opportunity. So for me, you know, funnily enough, you know, have you heard about the fear of missing out, Aaron? I'm sure you have.
Yeah.
So the fear of missing out is that it's a key thing that comes up again and again and again. And I say, you know, why have you got a fear of missing out? Because I love missing trades. And I'll tell you why. And this is another reframe that I've done through NLP. I love missing trades. The reason is because a lot of the trades are crap. They're not good. They're not good trades. They're shit trades. Okay, I'm only looking for good trades. So why should I be concerned about missing trades that have nothing to do with my plan? You know, I'm always missing trades. And actually, the better I get at missing trades, the better I'm going to get at actually finding the good trades. You know, so it's not about missing trades because you've got to miss them all the time. Does that make sense?
Yeah. So you mentioned something in there which I'm actually keen to bring up with you, and that's believing in the plan and believing in what you're trading. And it's something you talk about quite a lot, which of course, it makes perfect sense. But I can see how it would also be very difficult for a trader who has limited experience to do this. So what would you suggest to someone in this scenario who has limited experience, who doesn't really have any real reason to believe in what they're doing yet?
Yeah, I understand that because with experience you can sort of believe in what has actually sort of manifested over time. So I really believe in my trading opportunities because I've seen them play out so many times. So, of course, I started off without any experience as well. Everybody does. But at the same time, there's nothing better than real time experience and real time spent in the marketplace actually trading, to build belief and confidence. That's just the same, with any business, any sport. If you're an athlete, if you've never played the sport before, you're not going to have a lot of confidence in your ability. So, trading is no different. If you haven't traded a lot, you can't expect to have a lot of confidence in your skills, your ability, because you haven't proven it to yourself. So that is something that a lot of traders are going to struggle with. And that's why they become mindless. They take trades they shouldn't be taking. They lose sight of what they're trying to achieve because they really don't have that experience behind them. So what you have to do, and this is what I did, that's why I started with stage analysis. I needed a story. I needed something to guide me. I needed something to believe in. I needed to be able to put the market into context. The context is key. So you need a story, but at the same time, initially when you read that story, you might not believe it. When I first went into auction market theory, I had to learn and believe without experience in the fact that most of the time we're going to find buyers below value. If we have a nice distribution on the profile where we found value, we're trading around it, we should find the buyers below value most of the time, not all the time, and the sellers above value. But I have to believe in that without experience. Okay, so it has to firstly make sense. It has to make sense. Whatever you're going to do, it has to make sense. So for me, like trading auction market theory, stage analysis, it's a common sense approach. I can look at it, it's broken down into layman's terms. It makes sense. Like trading around value just makes sense in everyday living. You buy when something is at a lower price. You want to sell it at a higher price. It's just common sense. That's what we do every day. So have something that makes sense to you and you can believe in without experience. That's key. So you have to commit yourself firstly to an approach that you believe in just because it makes sense. So if it doesn't make sense, it's going to be very difficult.
Yeah, I think that's a good way to say it. Yeah, no, that's good.
So yeah, I mean, you need a story behind the marketplace. So you want to approach with some kind of story that you can believe in. This is the issue for mechanical systematic traders because, they have to believe in setups or signals. Okay, and a setup and a signal is based upon maybe a back test or an indicator telling you what to do. I struggle with that because I can't trust or believe in a setup or an indicator because it's not coming from me. I got to a point where I actually did sort of look at systematic trading styles, but I would look at a trade and think, well, it's telling me to buy it, but I don't believe in buying this market right now. It doesn't make sense. So it becomes difficult for the human being to commit to systematic mechanical styles because we are quite naturally critical. We will judge the situation. So as a trader trying to trade mechanically, you have to try to become emotionless or not be a human, but which is very, very difficult. So in discretionary trading, what we have to do is learn to trade based upon our beliefs, our feelings, what we understand. Yeah.
Yeah, I think that really highlights the kind of the two different mindsets that are maybe best suited to each approach. So when you say auction theory, you've mentioned a few times throughout the episode. Would you mind explaining what this actually refers to? What does this term refer to, auction theory?
Well, in its most basic sense, the way that I've understood auction market theory, basically, it looks at any market as an auction. So just like you go to a car auction, a property auction, an art auction, these products are being auctioned. So the price will be advertised higher to see if the buyers are interested. Okay, and if a buyer is interested, we advertise higher again. Yeah. So, but we will keep advertising higher prices until the buyers no longer want to buy those higher prices, right? So that's the auction, process taking place. But it also works on the downside. The market will keep advertising the price at lower prices until the sellers give up, until the sellers say, look, we're not interested in selling this low. So that's the auction process in a nutshell. That's it. It's just about understanding the market is an auction process, and basically price itself is the advertising mechanism. Price itself is the advert. So price itself has to be put into context to really understand if it's a good opportunity. Does that make sense?
Yeah, no, that's good. So more on the discretionary aspect of your trading, like someone who is completely discretionary, how much would you say your success or your trades, your decisions rely on gut feeling and instinct?
I think every trade that I take really has some feeling behind it. There are a lot of trades which I have a greater feeling behind. I think of belief and confidence as feelings. I talk about emotional scales, and if you sort of picture in your mind, if you got like a balance scale, okay, and on one side you have fear, doubt, and anxiety, and on the other side you have belief and confidence. Okay, these are the feelings, right? And I always want at least 80% belief and confidence in every trade that I commit to. Okay, meaning that there will be some element of fear, doubt, and anxiety because I'm human. So I'm not trying to pretend I'm not human. And I'm not trying to pretend I'm not going to have fear, anxiety, and doubt because I'm taking risk. I'm going to have anxiety. I'm going to have fear. I'm going to have doubt. I'm risking anywhere up to $5,000 a day. I'm going to have some doubts. I'm going to have some fear. I always say I wake up every day with performance anxiety. It doesn't go away. All this stuff about, working on yourself and becoming emotionless is bullshit. Unless you become an alien that is not human, you're always going to have feelings, emotions. You can't do anything without feeling. Okay, you can't. As a human being, everything that you do, every choice, decision you make, whilst you might not be consciously aware of it, has feeling behind it because it feels right. It sounds right. Because in NLP, we learn about the auditory senses, the kinesthetic senses, right? The visual. It's not just about seeing things, it's about hearing it and feeling it as well. Feeling is absolutely important in every choice decision you make, right? So you can't get away from it. Every trade is going to require some kind of feeling behind it. But some trades, I will feel a greater sense, like a gut feel that it just feels right or it just feels good, right? But it doesn't mean, that's not there in the other trades. It is, but sometimes it's just a bit stronger. Does that make sense?
Okay, sure. No, that's well said. So, with an approach like this, a totally discretionary approach, how would you go about recording and documenting this type of thing, which relies heavily on discretion? Like, how do you put that into a trading plan?
Okay, well, what I do is basically, as a discretionary trader, you basically have to have what I call like a business plan anyway. The trading plan is, for me, it's a little different to a mechanical trader because a discretionary trader has to rely on belief. So I break down my beliefs. What do I believe about the marketplace? What do I believe makes sense? So I will write down things like, some notes about auction market theory, value trading, why I believe in it, why it makes sense. So it's all about why does it make sense to have this in your plan in the first place? Because that why will give you the confidence. Because if you understand why, you can really believe in that, right? But if you don't understand why you're putting that in your plan, it's going to be very difficult to believe in that setup, that opportunity when it presents itself. So discretionary trading is about understanding the why and also building beliefs about the marketplace, telling yourself a story. But what I do is build a trading plan every morning. Every day I build a plan. Now that's what I call a pre-market analysis plan. So it's a pre-market plan before the market opens up, but I have an idea of what I'm going to focus on. Then I break it down into what I call pre-engagement vision. So it's before I'm engaged. Okay, so it's a pre-engagement vision based upon a longer time frame chart. So I've got levels, I've got the areas where I'm potentially going to start looking at shorter time frame charts, order flow, because I don't look at shorter time frame charts or order flow until I'm in these pre-engagement zones. And then I move to another step in the process called an engagement zone. So I have an engagement zone, which is basically a shorter term setup, a visualization right there in the moment, right in the present moment. I visualize exactly what I need to see on price action around this area for me to actually consider getting into the trade. And then I break it down to specific prices, like within this 3 or 4 tick price range, that's where I want to read order flow. If we're lifting offers there, I'm going to get in. If we're hitting the bids there, if it's a short, I'm going to get in. So there's a very specific process that I go through. I don't trade setups, I trade my process.
Okay, makes sense. So I'd like to steer this conversation a little bit deeper into NLP because, we've brought it up a few times throughout this interview. Now, could you explain to us maybe not only what this actually stands for, but what is the concept of NLP?
Well, NLP is basically it's a study of excellence. So what they decided to do, Richard Bandler and Grindler, they are the founders of NLP. Basically, what they did is study people that are they excelled in what they did in life. So they studied people that are very good at what they did and studied, it's basically a study of excellence. So they to try to figure out what these people had in common that really made them succeed. And as a sort of result of that, they started to come up with these concepts of states, shifts in states, and also your language and how it impacts what you do. So basically NLP itself was a study of excellence, and then it became specific techniques. So it's broken down into specific scripts and techniques which you learn as a practitioner. So you'll have scripts to deal with phobias, fear, anxiety, all sorts of issues that we have to overcome. Now I would also add, NLP for me, there are specific techniques which I think are good, specific techniques which are pretty much useless for me. So it's very personal. I think what will work for one individual versus another. So there are specific techniques that I like for traders, and I teach them. But I found that the main thing that really helped me, and I'm just going to sort of go off topic a little bit from NLP, was mindfulness and meditation. So NLP is working more on a subconscious level. It's working more with your thoughts, your current beliefs, etc., your past memories. But meditation, mindfulness sort of gets beyond that. So I think NLP has its uses. I would recommend anybody wanting to get into NLP, just Google it. Just Google NLP, neuro-linguistic programming, and you will find a lot of information behind it. Now, I'd done this 10 years ago, so then it was very, very new. Nobody really even knew what NLP was, but now it's got very popular. They're bringing it into schools. A lot of the prop trading firms now are using NLP practitioners to help the traders. So I do a lot of work with prop trading firms as well. I help traders with their mindset, their discipline, etc. And I use NLP, timeline therapy as well, mindfulness, meditation. So NLP is just one of the tools that I use, and it has specific techniques, scripts that you can use. It's a very in-depth subject, though. It really delves deep into how our subconscious and our unconscious mind works. Does that make sense?
Yeah, okay. No, that's really interesting. So, I mean, the techniques, I mean, you mentioned that some of them have worked for you and some haven't. Would you be able to share with us maybe an example of one that has and how effective that was to your trading results?
Yeah, sure. One of my favorite techniques is parts integration. And I was talking about, different parts of me which started to show up. And the more aware you become of yourself as a human being, not just a trader, as a human being in general, you realize that you have different parts within. Sometimes these parts will have conflicts with each other. So, for example, you might have a successful trader part. It wants you to do well. It knows your goals. It knows your objectives. It knows you have to follow your plan, be disciplined. But then you have this fear part, which is scared about taking risk. It's scared, but for good reasons. It's scared. It's also trying to protect you. Fear and anxiety exist because they're not bad things. Like, fear is not bad. It exists for a good reason. But it's because you either have doubt of something, it's fear of the unknown, you don't know what's going to happen next. But we're going to face that every day as traders. We're going to have fear every day because we always deal with uncertainty. So fear is something that most people see as negative, and they think of it as a bad thing. But with NLP, what we do is we go for this specific technique and we bring out these parts. We bring out the positive part on one hand, the negative part on the other hand, and then we visualize, these parts, and we put a color on them, we put a shape on them. But then we also start to go through what we call chunking down, and we start going through this specific process of realizing that this part, which we saw as negative, actually has a higher intention. Like fear itself, the main intention for most people is to protect them. It's trying to protect them. It's actually trying to look after them. Okay, so it's concern about them as a person, as a human being. So fear actually has a positive part. And then when you put that together with the successful trader part that wants you to succeed, you realize that they actually, although they seem like they're in conflict, they actually are trying to achieve a very similar goal and they can work together. So what we do with this technique is to bring these two parts together, because otherwise they're sort of in conflict. Does that make sense? We bring them together and make them realize, and yourself realize, that they are part of the greater whole, which is you.
Okay, that's really interesting. And I mean, besides NLP, do you experiment with any other methods that also work on an altered level of consciousness?
Yeah, well, I got into meditation when I started Kung Fu when I was 13 years old. I started to do meditation back then because we just did it as a part of the class. I started to really get more interest in meditation again because my father passed away when I was just 7 years old. So he was diagnosed at 26 with motor neuron disease, which is ALS. Okay, so he used to read a lot of books on meditation and self-development. So after he passed away, I started to really sort of go through these books. I just wanted to get into his head, what he was reading, what he was interested in. And so I started to read these books about meditation, opening your chakras, etc. I was probably 15, 16 then. It didn't make much sense to me then, but I started to practice some of the techniques. So probably when I started to trade, I started to get into meditation a little bit, but it was on and off. So I was doing it like for a couple of days and I'd skip it for weeks. And I'd do it again and I'd skip it again. But from around 2005, for the last 10 years, I've pretty much committed to it on a day-to-day basis, especially the last 6 years. It's without fail, I'm going to meditate every morning and every evening without fail. And that for me has raised my consciousness, my awareness so much that now I almost trade with this awareness from like a third person perspective. It's almost like I'm watching my every move, so and it's amazing, how much you can really raise your consciousness, your awareness. And mindfulness does the same thing. It just makes you more and more aware through very simple techniques. So these are things that I think are, key, because most traders, and you've probably heard traders say time and time again, I know what my plan is, I know what I'm supposed to do, but I didn't do it, and I see that all the time. I hear that time and time again with traders that I work with. They know what their plan is. It's not because they're not smart. They are smart. They're very smart. They're probably smarter than me, but they are very smart. They know what they've got to do, yet they can't do it. And they keep telling themselves time and time again, I've got to stop doing this. I've got to stop trading outside my plan. My plan is to look for these bigger intraday swings, and I'm sitting there scalping for 20, 30 trades a day. So people know what they've got to do. It's not that they don't know. They know they need discipline. They know they need patience. That's just something that everyone knows, but people can't get it. The reason is because most people, and it's not, I don't mean to sort of say this offensively, but most people are mindless. They don't know they're mindless. They don't know that their subconscious is really in control. Their unconscious is really controlling what they do. It's almost like, they're living on autopilot. So people come into trading every day, they make mistakes time and time again, and they can't break them because their subconscious, their unconscious is much quicker than their conscious thoughts and their beliefs and their opinions, etc. coming in. So they're doing things they don't want to do unconsciously. It's automatic. But when you become more mindful, more aware, it doesn't happen instantly. It happens, time. If you commit to meditation like for a few months, you start feeling the benefits. But it's like it's like building a muscle. You have to go to the gym. You have to train your muscles. You have to feed your muscles to see the benefits. So if you don't meditate and you don't commit to that every day, you're not going to see the benefits. But I've seen the benefits, and I trade from a perspective where I sort of watch myself doing everything that I do. Does that make sense?
Okay, so with like you mentioned there, you're meditating most mornings and evenings. What are you actually doing? Like, take us through that meditation process or routine, you could call it.
Yeah, there's a number of meditations that I've done over the years. I started with guided meditations where you listen to someone actually guiding you through a meditation. So they would talk you through the process. That's a good way to start. But I tend to focus on doing a combination of yoga, it's like breathing exercises, and also Qigong, which is it's basically like a moving meditation. So I like those two techniques. And every morning I would do like a 15, 20-minute meditation. And every evening as well, I would do a meditation for like 15, 20 minutes. So I tend to just get into a place or state where I can just be silent and still. When I first started meditating, you find that your mind wanders. You start thinking about what happened yesterday, what's going to happen tomorrow. And when I first started meditating, it was very frustrating because I knew that the objective was to become silent, to become still. But your mind just keeps thinking, it just keeps wandering, and you can't stop it. But what I realized that meditation is really about is just raising your awareness of the fact your mind keeps wandering. So you don't have to stop your mind wandering, you just have to become aware of it. So you become this witness, this observer of the thoughts and your mind wandering, trying to think about the past, the future, and you just keep bringing your attention back to the now, the present moment. So it's a technique, a process that you go through to practice being in the moment every day, in the now. So you do that for 10, 15 minutes every day. And because you're training your mind to do that throughout your day, when you're trading or doing anything else, you can get there a lot quicker.
Okay, that's really cool. So for anyone who might be interested in learning more about meditating or even NLP, are there any resources that come to mind which might be helpful for someone who's pretty much has no idea right now?
Yeah, NLP, I think just Google NLP. There's probably a few websites that I could recommend. I can't think of any right now because it's been a long time since I looked for NLP websites. Now, I did an NLP program with someone called Topher Morrison. I'm not even sure if he still does them. But, I've got a manual from him. Christopher Howard, he used to do NLP programs. There is Tad, I think it's Tad James. Tad James, he does timeline therapy and NLP, so you can check him out. Their website is called tadjames.com, TADjames.com, yeah? So that's probably a good website to check out. Mindfulness, meditation, I would say go to YouTube, actually, and search mindfulness. Jon Kabat-Zinn, he's the guy that really sort of brought mindfulness into the Western world. So just Google or search in YouTube mindfulness and mindfulness meditation. Watch some videos by Jon Kabat-Zinn if you can. I think he's got some great videos on mindfulness.
Sure. Okay, cool. Well, thanks for sharing those, Cam. Well, this should probably, we should probably start winding things down. I've got one more question which I'm pretty keen to ask you, so we'll ask that and then we'll probably wind things down. So,
okay, cool.
You've been a trading coach for many years now, so do you find there's anything that newer traders are missing or perhaps even just ignoring? Like if they just did X, they'd be so much better off. Is there anything that comes to mind?
I think it just comes down to, actually for most traders, it comes down to trading less. Like most traders that I work with do trade too much. Over trading is a big thing. And I think, it's raising your awareness. And mindset is so important. It's key. It doesn't matter how good your strategy is. The mindset is very, very important. If you're mindless and you're trading outside the strategy, it doesn't matter what strategy you trade, you're going to have the same issues. So I think, the key thing is always going to be psychology and developing your mindset, but actually doing something about it rather than just knowing you need to be more disciplined and patient. So that's the key thing I would say to anybody, really. That's what you've got to focus on. Most people know it, but actually do something, commit to it. Be disciplined to do it. I often say discipline is a lifestyle because, don't expect to be a disciplined trader if you're not disciplined in life. If you're waking up late every day, if you can't attend meetings on time, you can't stick to a diet or an exercise plan, practice discipline in other areas of life. Like commit to a diet plan, an exercise plan. Commit to going to the gym 3 or 4 times a week. If you could commit to things like that, you will become a disciplined person. So it's not about becoming a disciplined trader. It's about becoming a disciplined human being.
Yeah, that's a great answer, Cam, and great answers throughout. So thank you very much for coming on and being a phenomenal guest. This has been really good. So thank you very much.
Yeah, it's been great. It's been fantastic.
Excellent. So do you want to share with listeners where they can go to find out more about you and where they can also connect with you?
Yeah, sure. I've got a website called thetradingframework.com. So you can go there. You can find out more about the trading framework itself. There's lots of free videos there under the archive. I post up free pre-market analysis there pretty much every day. So yeah, check that out. There's lots of stuff on there. And if you've got any questions, just drop me an email on info@thetradingframework.com.
Okay. And what's your Twitter handle?
It's L2ST. I nearly forgot then. L2ST, @L2ST.
Cool. Okay, well, everything that has been, all the resources and a recap on this episode can be found at chatwithtraders.com/41, as well as all the links Cam just mentioned there. So, everything can be found in one place there if that's easier for you. All right, Cam, well, thank you very much again for doing this. It's been a pleasure speaking with you. So, take care and let's speak soon.
Thank you, Aaron. Have a good day.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? I'm your host Aaron Fifield, and thanks so much for listening in to this week's episode number 42. What you're about to hear is an interview with Bert Mueller. He's a trader of futures and equities and has been involved with markets since around 2007, but he does things a little different to most. He's an algorithmic trader who harnesses the power of machine learning to discover and develop profitable trading strategies. This is an area that hasn't really been covered in previous episodes, except for the odd mention here and there. So it was really great to have Bert on the show to share some insight on machine learning and how it works in the realm of trading. Beyond this, you'll also hear Bert's views on diversification and how he thinks about risk management. Plus, one of the things I really respect about Bert, and that is his drive for continual progression, his attitude towards further education, and the way he approaches goal setting. Now, just before we roll into the interview, I'd like to ask you for a very small favor. Could you please leave a very brief review on the podcast in iTunes? It's a massive help. Reviews have a huge effect on how well this podcast ranks in iTunes. So obviously, the better we rank, the more listeners we can reach. So if you'd like a quick and easy way to support this podcast, please go to chatwithtraders.com/iTunes and leave a brief review. It'll take you no more than 2 minutes, and like I mentioned in the past, your support is really appreciated. So please do this just while you're listening. That would be really cool. Okay, time for this week's interview. I'm your host, Aaron Fifield, and here is my guest for episode number 42, Bert Mueller. Bert, what's up, man? How you going?
I'm good. How are you, man?
Not too bad at all. So we spoke yesterday and you were pretty much running off next to no sleep. I hope you've had a chance to catch up.
Yeah, a little bit.
Okay,
Yeah,
I'm not
we got
convinced.
the first snow today in Moscow. So looking
Okay.
out the window, the entire city is white. Real nice.
It's white, so it's snowing, is it?
Yeah.
All right, very cool. Yeah, we're just heading into summer here, so it's much the opposite. But yeah. Well, anyway, Bert, it's really great to have you on for an interview today. So first of all, thank you, and secondly, I'm really intrigued by some of the topics we're going to cover, and I think most of those topics are probably going to stem from machine learning. So that in itself is something that hasn't really been spoken about in any of the previous episodes. So some listeners may already be familiar with the concept of machine learning, but I'm sure you're going to open the minds for many listeners as well and expose them to something completely new. So I think it's going to be really good.
I'm excited, man.
All right, cool. Well, let's do it. So let's start right from the very start, like we always do. So share with us, when did you first discover the markets and what was your real introduction to trading?
So I came into some money around 2007, 2008, and yeah, I have a friend who's a financial advisor, and I talked to him, and I was like, what should I be doing? What's the good way to go about this? And he's, the classical American, registered investment advisor, and he's like, look, you need like some stocks, you need some bonds, that classic stuff they teach you in school. And so I went ahead and I bought some stock, and I think Ford was the first company that I bought because well, Ford's a good company. They have had a solid balance sheet and whatnot. Actually, I think it happened to be one of the companies that didn't get bailed out after all that. So I guess maybe the initial analysis on a fundamental level might have even been correct. But I bought it and it went down. And I bought it, bought some more, and it went down some more. And then it kept on going down because that was the time. We were in a bear market and everything was kind of going down. And I thought that this is kind of lame. I'm a smart guy, or I thought I was a smart guy back then, and I have this, I have a buddy that helped me with my analysis. Our analyses coincided. They're in agreement, and the market obviously wasn't. So what's up? And so I kind of just started reading, and I had a more technical background. I was studying biochemistry at the time. And technical analysis appealed to me. It seemed really easy to look at the stochastics or whatever they had, the RSI back then, and then to buy the bottoms and sell the tops. Obviously, in practice, it didn't turn out to be that easy. But I kept reading, and I actually ended up trading options because I was, young and dumb and wanted to make $1 million overnight. Obviously, I lost. I even took some money because there were some other people who thought I was smart. That turned out really, really, really bad. I lost all the money really fast, actually, and. I was devastated because it wasn't my money, and I had never made that much money in my life, and just, oh man, so bad. But I don't know. I realized that someone on the other side of that had made that money, and so I realized that you could be the guy making that money, and so basically I set out to do that, to be that guy, and I read basically. Everything I could get my hands on. Obviously, we were talking about this yesterday. The Market Wizards books were amazing. That's why it's awesome that you're doing this podcast. But I realized kind of that there's a very many different approaches to trading, and I realized that the approach that I was most comfortable with was this like more technical, mathematical, whatever, computer-based approach. So that's kind of how I got started.
Okay, yeah, no, that's really good. So, I mean, let's just take it right back to the very start there, and you came into some money around 2007. I mean, why did you come with that money to the stock market? I mean, you could have, gone and started a business with it. You could have done a bunch of other things with that money, but something appealed to you about the stock market. What was that?
I don't know. I'm not going to lie to you, man. I think just making money while doing nothing, that's what I thought it was going to be like. You put your money in the market and then just, and a year later you look and there's more money. But obviously it doesn't work like that.
So let's talk more about your first year or first 2 years while you were trading. So you told us about the Ford example there where you just kept buying and it kept going down and you bought again. After that happened and you started to read up on technical analysis, what did the next year or two look like for you? How'd you go?
I did have some good trades using just silly technical analysis like RSI and whatever stochastics, that kind of stuff, and that was actually super bad. Actually, I know a lot of traders on your podcast and a lot of traders I know as well that hand trade, they kind of say like the worst kind of trades are the ones that are like wrong in principle, but they turn out well, and then you think you did them right, and you get that overconfidence in the wrong kind of technique. And so I did end up making some money trading this stuff, and then I was like, I want to make more money. Basically, I just wanted to get more levered. So I did the long options.
Okay, so if we had to summarize those first few years, what were probably the greatest challenges and frustrations? Like perhaps that was, just taking on too much leverage, like you mentioned there, but was there anything else?
It's too much risk and being undereducated, and I think being overconfident. I was, really young back then. I'm not much older, not much younger than I am now, but still, in terms of trading experience, night and day. Yeah, I think it's just, undereducated, over leveraged, and you really have to understand that, like, making, let's say, 20% a year consistently, you're gonna make as much money as you want, basically. Making 15% a year, you can make as much money as you want, if you start young enough.
Sure. Okay. So you also mentioned right at the beginning there how you read a bunch of books. Market Wizards was obviously the highlight, but you also read a ton of other trading books. So you did a lot of reading. What did you discover from this, and was it a helpful exercise?
So, it was definitely a helpful exercise. I would say, the 99% of the stuff out there is total BS, in the sense that it's not going to help you. Even the stuff that's good, for example, maybe like out of the hand trading stuff, the stuff I've seen work personally, kind of maybe, let's say, is support and resistance, right? But even the people that talk about just straight up horizontal support and resistance, in their books, they're going to use the examples that are only the ones, like the best examples. And so, again, it's kind of detrimental to the learning process. You need to really understand. You need to see the times that your technique fails. You need to really understand those, I think, a lot more than the times that it works. Because when it works, well, it works. You don't have to do anything. But it's it's still worth it to read let's say a bad book, or there's no such thing as a bad book, but a book that doesn't help you in the classical sense. It doesn't give you useful information, because you can see what other people are doing and you get ideas. Maybe I should do the opposite of that, or maybe I should that's a thing I just never thought about. Like, this guy trades let's say commodity spreads using like the lunar cycle. I'm like, wow, that sounds ridiculous, but I've never thought of trading commodity spreads,
Okay, yeah, no, that's a really good point you bring up there. So, what you're kind of referring to there is what's sort of known as the well-chosen example. Is that seeing those examples and then also seeing them actually fail and not work out so well as how they did in the books and in the examples, is that what led you into more of a quantitative direction? Like, what made you move on that path?
Yeah, there's no framework, maybe there would have been a framework if I had like written down like 6 patterns, right? And then, went through all the price charts by hand and looked at them, but which 6 patterns would I have picked? What if I picked the wrong 6 patterns? And I realized it's like in business. I came to it from kind of a business approach. You want something where there are higher barriers to entry, because there's less people in the market at that point. For example, the reason I choose to trade intraday but not HFT is because I can take advantage of HFT liquidity but not compete with HFT players. So it's kind of the same over there. If I had more math skills, less people are kind of doing that, because, I guess it's a little harder, but it's not. So they're just tricking you with the symbols.
Sure. Okay. So that's probably actually something we should cover before we go too much further. What is your background, like educational wise? Could you just run us through that briefly?
Okay. So in undergrad, I triple majored in biochemistry, molecular biology, business economics, and global studies. Then I went on to do a master's in bioinformatics, and now I'm doing a master's in computer science with the specialization in artificial intelligence and machine learning. But I really like to study, so for anyone out there, Coursera, edX, all those websites, they're super awesome. And I actually took my first machine learning class on Coursera because I didn't think, it's kind of low risk. You can just drop the class wherever you want and it's free. And, it actually ended up being like, probably 50 times easier than I thought it would be.
Sure. So that was actually going to be my next question. Ask you, like, where did you even get started once you sort of started to move in that quantitative direction? Was machine learning the first thing you kind of stumbled across? Because, I mean, there's probably easier things you could have picked up still on the quant side of things before you got into machine learning.
I think machine learning, I think computer science in general, it's a little bit easier than like straight, straight math, like, it's there's this example, there's this thing called, I don't know if you know about integration. There's differentiation and integration in calculus, right? And so integration, let's say, is you find the area underlying, between the x-axis and some line, for example. Or if you have a circle, you find the area of the circle. And to derive that equation to find the area of a circle, it's pretty complicated, I would say. But then I stumbled upon this thing called Monte Carlo integration, where basically you just kind of put the circle in a box and you already know the area of the box, and you throw darts at the box and you see the proportion of darts that land in the circle versus the box, and you can figure out the area that way. And I thought that was so beautiful and easy and kind of stupid. And wow, why would you ever do so much math to get to this simple solution? Because, you don't need in trading, precision to the, 50th decimal place. You just need, approximate precision, which means you don't really need closed form solutions, if they're even available, like the ones provided by, classic math or whatnot.
Yeah, okay. All right. No, that's really interesting. So let's drill down now into more of the specifics about how you trade and how you've been trading in the past couple of years. So run us through your actual style of trading and how you approach the market.
Okay, so I use machine learning. I try to use kind of evolutionary computation stuff like genetic programming, grammatical evolution, because I like to read the system after it's generated to make sure it's not doing anything crazy. I'm a little bit uncomfortable with stuff like neural network and regression techniques because you're ending up with a set of coefficients which don't really tell you that much. I try to be in the market. I trade intraday. I'm in cash by Friday, and I would say 90% of my portfolio is in cash by close of each day. Trade only limit orders. I try to be in the market the least amount of time, to avoid those Six Sigma, those black swan events. I trade futures and equities. Try to keep my risk balanced, and risk is the most important thing. So, for example, trade short only the index futures and long only Apple. It's not a pairs trade, right? They're not trading at the same time, but on average, the risk is reduced.
Okay, and that's a good summary. So I'm really keen to go deeper into what you just mentioned there. So let's start with, for someone who may be totally unfamiliar with machine learning, how would you even describe this to them? So let's take it right back to the basics.
So I guess machine learning is symbolic regression, right? And so regression, I think, people are more or less familiar with. You have, some points and you fit a line to them, right? What line best describes this set of points, right? So you can call that like, baby machine learning. It's what I do is the same thing, except you, instead of using coefficients in a line, you kind of start with the 0 point origin. You have nothing, and you use functions, and you have a whole kind of a program written out. So it's a program that writes programs, basically. That's the type of machine learning that I use specifically.
Okay, and I don't know if this is going to be relevant or whether or not it might be helpful, but are you able to perhaps give us an example of machine learning and other technology that we might use in our everyday lives?
Sure. I mean, yeah, it's a little different, but yeah, all the time. Obviously, Google, they use machine learning and like or Siri or whatnot. Um, so when you do the search, they use machine learning to kind of depending on, let's say, your geography and the language you're speaking, to start searching in the places that are most likely to give you the right answer, like the answer closest to what you're looking for, like or PageRank and whatnot. Um, yeah, or obviously self-driving cars, right? They use machine learning to distinguish between the objects and the people and the road and whatnot.
Okay. So let's bring this back to trading now. How do you actually use machine learning to discover and create effective trading strategies?
Okay, so first of all, something that not a lot of people know, or I believe, I don't know, but there are edges that persist, for 30 years. I don't re-optimize any of my trading systems. I just pick the, N best out of, a ton and trade them. So I have systems, like I won't trade anything that hasn't worked, for all the data that I have, basically, unless there's some serious structural issues with the data, like before some point. Like some people will recommend, don't trade, before, or don't use data before 2003 for integer trading because is it the before it was like quarters and now it's decimals or whatnot. But I don't do that.
So what's your actual process like? Like, let's say you wanted to create a new strategy tomorrow. Where would be your starting point, and then what would be the steps before you go to live trading?
Yeah. So I look at my portfolio, right? And I see, what I'm trading, and let's say I'm trading, already I'm trading the E-minis, right? So I already have exposure, whether I'm also check if it's long or short, or let's say I'm long short already the E-minis, right? So I would then say that I should probably pick a market outside of the U.S. index market. In fact, outside of the equities market. So I would then go to the next most liquid market, because that's very important to me. That would be the FX market. So I would probably pick the euro in that case. I would download the data for the euro, and put it in machine learning software. And run the machine learning that will output a set of systems based on my objective function, predefined criteria. And I validate those systems using, cross-validation out of sample. For example, I check the currency systems on all the other currencies. They don't have to work, but it's a lot better for them to work. And there's stuff that works definitely on the intraday time frame with sharps above 1.5 on every single currency with like less than 5 parameters. So that's definitely possible. And I think once you really figure out, you have to understand first of all, what is the maximum profit the market could give you, and second of all, what are the systems that you can build around that, if that makes sense.
Yeah. So just to zoom in a little bit on what you said there, you download the data, right? And then you've put it into your, I don't know if it's the right word, but your software that, operates, does the machine learning aspect of things. What's actually going on there? Like, what's it doing when it's reading through all this data? What's the purpose of that?
So basically, it does something like let's randomly generate 10,000 systems, right? No assumptions at all, just randomly generate 10,000 systems. Maybe it'll say, when the moving average of the volume of yesterday is above, I don't really use indicators. I mostly focus on price pattern and seasonality type stuff. But basically, it generates 10,000, let's say, of these systems, picks the top, let's say 1,000. They mate, which is their characteristics get kind of mixed, their rules get kind of intermixed, and they create 10,000 more. And that goes on for a while, and then you have some sort of optimal set of trading systems at the end, and they get rated based on a objective function that I set, which is like the goal. So maybe Sharpe ratio or drawdown or number of trades, and I'm a lot more worried about robustness than performance because like you can take 10 kind of decently performing systems and you put them together and you have an amazing one as long as they're not trying to capture the exact same effect, right?
Okay, so for the program to compute as you use an example, there are 10,000 different systems or strategies. How does it come up with those 10,000? Have you put like 5 different rules in there or 5 different parameters, and then it's just kind of throwing out every variation of that, or how does that work?
It has a set of like indicators, let's call them. Could be like the high of yesterday or, a moving average. It has the price series. It has a volume. It has, you have to understand also the content of the stuff you're giving it, right? If, price can definitely predict future price, but like, for example, if you can predict weather better than everybody else, you can really trade, the ag futures really well. So there's like information that's outside of price that it's nice to incorporate. For example, Twitter sentiment if you're trading stocks, spreads if if you're trading commodities. Like calendar spreads, the different months. There's a lot of stuff. Again, a lot of seasonality out there, and a lot of highs and lows between various time points in the day are important.
Okay, so let's talk about the benefits of using machine learning instead of a more commonly used technique, such as actually writing a strategy, backtesting it, and then optimizing it. Like, what's the benefits of going down the machine learning path?
Okay, so let's start with I'm gonna make a comment about the fact that a lot of people say like machine learning doesn't work or whatnot, and I just have a very simple, kind of a couple sentences that I think I know mathematically proves them wrong. Let's say, and if you do it the right way, that is. So this assumes you're starting with a 0-point origin. So theoretically, basically, let's say we have a function space, right? And this space includes all viable trading strategies in the world, right? Everything possible. It's infinite in size, right? Now, obviously, some people are trading and some people are trading money and making money. Unless you believe basically it's all random and some people just make money sometimes and then lose it and then it's all, But obviously, that's not true. I don't know. I'm not really sure how seeing some people's results you can believe that. But anyway, so there are viable strategies in this space. Now, like let's say grammatical evolution from a 0-point origin, you can, if giving it operators like plus, minus, divide, and multiply, there's actually mathematical proof saying that you can create any function using just those four operators. So basically, if you search long enough, you will be able to create any and every single possible trade function or trading program that there is, and those automatically include some that work because there are people that are doing this. So I think that's really important. And it doesn't apply to all types of machine learning. it applies to ones where you have enough operators and you're working from a 0-point origin. And yeah, you do. It could take forever to find a viable trading system. Because, for example, I don't use just plus minus divide and multiply because that would it takes too long. And I do have a 40-core Xeon server to process all this stuff.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, so what are the key differences then between, finding a strategy using machine learning and then actually defining the opposite to that would be defining a strategy, so writing some parameters and then back testing that on data and then optimizing it from there. So how does machine learning differ from that approach?
So there's something called like the data-driven model of development and the the model-driven development, right? And when you come in, for example, let's say you're doing trend following and you want to use, maybe you just want to use one moving average, and that's your model. You have the moving average model. You say when it's above this moving average, you go long. When it's below, you go short. Maybe you want to use a crossover. You say when the fast one's above the slow one, then you go long, and vice versa. You make a ton of assumptions, like maybe that market is mean reverting. Maybe that market on that time frame is mean reverting. Maybe the indicators that you're using, outside of the moving average, allow for you to only find mean reverting systems in the market. I mean, there's just a ton of stuff you don't know and a ton of bias you introduce by coming in with a model that you have, that you know of. Versus, for example, maybe, I've seen some of my systems do stuff that a human could just never figure out, because you have to be looking at different times in different time series at the same time. So, like, for example, let's say the yen was up 3 days in a row, and you have a low today in the E-mini that that is the lowest low in 2 months. Let's say buy tick above that low and sell at the end of the day or something like that. It would be very hard for a human to kind of, you have to look at the yen in the past 3 days, and at the same time you have to look at the E-mini today, but you're looking at 10-minute bars, and no computer can even show you 3 days, of 10-minute bars, let's say. in terms because the price series is too long, so you're not even going to be able to visualize the pattern unless you got like 3 or 4 monitors, and even then.
Okay, so this is probably a good point to ask this question here. So once you discover a strategy that has an edge, kind of like what you were just explaining there, and it's, to you it's worth trading. A strategy like what you've just described, it might not necessarily make sense to you logically, like in your head, you might not understand the reasons why that would work, but it does. So are you just purely looking for statistical edges only and you don't really matter about why it works?
Well, I mean, yeah, right. I obviously it gives me more confidence when I can make sense of it or whatnot. I'm probably not gonna. One of my friends just sent me a funny that he works at a big bank, and they were just like, "Oh, you see this dragon pattern?" And they drew a whole dragon on the chart. I'm like, okay, if it breaks the dragon jaw, then we're we're going down. And so that kind of stuff sounds a little bit ridiculous to me. Probably, not gonna trade that kind of stuff. But look, man, there's so much stuff we don't know. Like we're pretty dumb, as a whole general population. And like, for example, the first cavemen, they didn't know where fire came from, right? But that would be really dumb not to use fire because you could do a lot with that. Just because you don't know why something happens doesn't mean it's not viable. A. And B, there's a famous example that when people try to tell me, they're like, well, what about this? There was this correlation or something like the Bangladeshi butter prices. It's a famous one. Could explain with like a couple or like 1 or 2 other factors, like all the variance in the S&P between like certain years. But it was a pretty long period of time, and they're like, well, that's obviously, spurious and it's BS, and why would you ever trade that? And my thing is, hey, man, if you traded that for 10 years at 20% and you just turned it off at a 20% drawdown or whatever your way to turn it off was, who cares? You could have made so much money, and we're in this business to make money, not to be correct and not to explain how or why the market works. If you want to do that, go be an economist. I mean, it's just, that's it. We're in this business to make money.
Yeah, that's a really great point. I like how you summed that up. So while you're using machine learning to find strategies, once these algorithms are actually live trading, do they continue to evolve with machine learning also?
No. So that's the thing. My output, which is another specific, that's a specific, I would say, to the way I do machine learning. My systems are actually like relatively simple. Like that system that I told you is actually not that complicated. It has maybe 1 or 2 free variables,
And when you say free variables, what's that refer to?
Like things you're optimizing, I mean, I wouldn't call like like a day high is just a day high. There's no number you can optimize there. You know what I'm saying? Like it's just the high of the day. You can't, but in a moving average, it could be, 21 bars, 22 bars, 23 bars, 19 bars. What's the difference between all that stuff, So I try to stay away from that kind of stuff and more kind of discrete, you have the day high is always the day high. There's no way to kind of, optimize around it. Does that make sense?
Yeah. So what level of interaction do you have with your algorithms once they're actually operating and live trading? Like, is there any discretion when you decide to either run them and then don't run them? Like, could you shine some light on this for us?
So I try to start running them maybe when they're in a drawdown, but that doesn't always work. Obviously, I have the luxury of doing that when you're like already running many algorithms. I've been doing this thing recently that's been amazing, actually, and it's kind of so I make I make slight economic bets on from my knowledge of fundamentals or whatnot, or my guess on fundamentals. But for example, from trading by hand before I saw the divergence between like the advanced decline line and the S&P, and I was like, and also I know that we've been easing and you can't go any lower, and it's kind of like 30% a year in the market. That's kind of unreal. That's not like, that doesn't happen, especially for for this long. So I kind of turned off a little bit, not turned off, but lowered the allocation, lowered the risk to my long only systems, and left my short only systems, the way that they are, on the indices only, and that's been really awesome. But then if you look back, I would just be let's say, so my results were like a 4 sharp over the past 6 months, and if I hadn't done that, it would be like 3.2. So it's not a big difference, but it's boring when you have when you have your systems and you have your framework. It's you just kind of run it, and you're like, what are you going to do? Sit all day? You're trying to tinker. I mean, you shouldn't tinker, right? And I don't tinker in a way where it can affect me, because, for example, if I make a bet and I'm wrong, right, I have a system that's worked for 30 years, right? So it's going to be still working more or less in the same way it's worked before. If I'm right, I get a little bit alpha in the near term, Basically, it's like a lot easier to predict the equity curves, out of 10,000 systems that have been working amazingly over the past 30 years than it is from 10,000 stocks. So there you go.
So what type of trader is machine learning probably best suited to? Like, for someone who currently isn't exploring this angle of trading, is there anyone who should maybe consider this? Someone who you think would be a good fit, like a certain type of trader it would be relevant to?
Humans, I think like the people that I know that trade by hand well, they're like super self-aware, and they spend a lot of time on like themselves to make sure that like they're the machine, and they're well oiled and working well. And that's not the way that like humans are. It's that's why trading is so hard. So I think it's suitable for everybody. And the beautiful thing is, I didn't know, to be honest. Look, when I started doing this is the way I looked at it. I was like, I'm going to learn all this machine learning stuff, right? And if I completely fail at trading, which is possible because, it's hard, I can go and work at like Google or something. So I think it's a really good, there's a lot of good you could do in general in the world with machine learning technologies and artificial intelligence. And, there's never going to be a lack of jobs, and you're always doing cool projects. So if you ever, give up on trading, you could always do that. Although, again, just work a little bit longer. It's just right there, it's definitely possible. Yeah.
So you mentioned just there artificial intelligence, and I don't want to go into this too much more, but is artificial intelligence essentially the same thing as machine learning, or is there are there differences between the two?
So, I mean, they're different. Like in academia, they're different. You can call machine learning kind of a subset of, general artificial intelligence. Machine learning is a bit more about having a lot of data and kind of learning from that like massive amount of data, versus artificial intelligence has a little bit more kind of heuristic stuff, for example, or non solutions that aren't based on randomness in any way, for example. So it's a little bit more general.
Okay, cool. So share with us your thoughts on diversification, because I think that from when we've spoken in the past, you've spoken about how you can diversify in various ways and how you'd like to do this, and the various ways being that you can either do it for greater returns, and then on the other hand, you can also do it for protecting risk. So could you just speak on this a little bit and your thoughts on diversification?
Okay, yeah. First of all, yeah, obviously you should always diversify to protect risk. That should be your number one goal all the time. But I'm diversified, for example, across asset classes, across the side of the market, right, long or short, or I'm starting to do some pairs trading stuff even. I diversified across time frames, and basically every time I have extra capital, whatever that is, let's say $50,000 per contract. I mean, it depends on your contract size. I'd like to pick up a new market. I would much rather add a new market than allocate more to an existing market. I don't allocate more because again, you don't know what's gonna happen, right? In the future, regardless of how smart you are and how good your systems are. You can still have, like, we had the flash crash, or like last year that was already last year, right? The franc just poof 30% intraday, like. That's ridiculous. That's like a world currency. They're not supposed to have 30% moves. I mean, when I was reading I read a lot of the trend following books, and they recommend, for example, volatility based position sizing, and they're just like, yeah, well, if the bonds move more than 2% in a day, like, you're not worried about your portfolio. You're worried about, like, the world ending, and is that true? I mean, the franc moved 30% in like a second. I mean, it was like 5 minutes, but still, that's a lot. That's a world economy. So diversification across as many aspects of the market, of the kind of trading space as possible. I use some a little bit more advanced math techniques like PCA on my equity curves. You have to. So a lot of people try to diversify on assets, but a trading system is essentially it's a filter that transforms your price series, right, into the return series for your system. So you're not actually now you're trading the original time series, so the original asset, but really you're investing in the equity curve of your system, which is not the same thing as the asset anymore. It's transformed, and you have to understand that.
Okay, and while we're on the subject of risk, just to add to that a little bit, when we were speaking the other day, you mentioned global risk metrics. So would you be able to maybe shed a little bit of light on that? Like, what are you referring to when you talk about global risk metrics?
Yeah. Like the thing I was talking about, the 80 line divergence, VIX making new highs, the spread between the front and the two front month VIX contracts, that kind of stuff. The spreads in between different expirations of different futures contracts, the volatility surfaces of various options and stuff. There's a lot of predictive there's a lot of predictive stuff out there in terms of risk. When people are, I mean, for example, volume drying up. If you have it makes you can see that that's not good. You can see that something bad is going to happen.
Okay, so say volatility is increasing on the VIX. How does that tie back into your individual strategies? Like, let's say you're trading in an equities market.
Well, if you're really creative and you can make it work, you can create a position sizing function that, for example, scales the inverse of the volatility or the inverse of the VIX. So, like, the higher the VIX, the lower you invest. For example, or you could be simple, like before when I was just doing, let's say, kind of long-term index trading, you can say, I don't know, let's say the VIX closes above 35 2 days in a row or something like that, then you exit. But when you're doing that kind of stuff, you're a little bit more prone to overfitting. But you just have to be aware. And because there's a lot of stuff, for example, the VIX also, it defines market regimes, right? So there's clearly, you have to examine your performance, the performance of your systems or your own performance based on, the market characteristics. I believe there's many different market regimes. Could be like, VIX is above 30, and it was an up day on the S&P, or VIX is between 15 and 20. And that it was a down day in the yen or something like that. And I mean, basically, there's infinite variations of those. But I like to have my systems, like, there's not that much inefficiency, or there's a lot of inefficiency in the market, but it's not as consistent as you would think. Like, you can't get 10 trades a day on one inefficiency unless you can, but it's more, you're getting in the realm of kind of HFT stuff. But I like to trade for one system, let's say once or maybe once per a week or once per 2 weeks, and you get that over 30 years. You combine that with 20 other systems that have different edges. And that's a lot more robust, because if one of the edges kind of goes away, you can always turn that system off.
Absolutely. Okay. So stepping away from your own trading a little bit and just kind of talking about the broader market, as machines become more and more prominent in trading, the way you said, is there any downside to this, or do you maybe see this as a positive thing?
I think it's a positive thing because we're incorporating more information, more predictors. I mean, if you're doing it right, again, I said it's very important to understand. You have to add stuff that really predicts. I mean, not predicts, but helps. Price by itself, you can make a system using just price. But again, if you had some weather or some sentiment or some other or some intermarket stuff, it always helps. You're making markets more efficient. I think also humans will always have their place, kind of regardless of the amount of computer trading, because computers are still dumb, yeah, they can find the good patterns, but humans rely too much on computers, I think, in that sense. You saw it, for example, and stuff happens, like I think it was, when was it? In the past couple of years, Knight Capital Group, they just, they opened, the market opened, and they just sent a bunch of like not correct orders into the market, and they, what is it, like an 80% drop in their market cap in one day? And it's like, wow, it's a good company, but relied too much on the computers, didn't do their checks, didn't do their risk management, their verification, and their testing, and lost a lot of money.
Yeah, that's pretty savage. So for someone who is so deeply involved in the programmatic side of trading, how important is this going to become over the next 10 to 20 years for all traders? Like, do you think that those without any programming knowledge will be disadvantaged in any way, or does it not matter?
Definitely not. Look, I mean, if you're doing scalping, yeah, 100%. You will definitely be disadvantaged because there you're relying on speed and whatnot. But there will always be time frames, generally a little bit higher than the ones that are, worked on by the robots, where humans will excel. There's, because we have pretty complex neural networks in our heads, and complex in the sense that they could fit a lot of nonlinear patterns. There's a lot of stuff that we process and goes on in the background of our minds that, we can't formulate and we can't put on paper.
Okay, cool. So I understand that you keep in close contact with a number of traders, just moving on to a slightly different topic here, but you keep in close contact with a number of traders. Could you share with us how this has been beneficial to your trading by just having other traders in your circle that you can, I don't know, like maybe bounce ideas off and that type of thing?
Yeah, it's awesome. I mean, I've been super fortunate. I actually, and quite randomly, met a group of people about like, a year and a half ago, and my performance has like tripled since then. And just purely because some of these guys do HFT, and they were like, this is the performance that we can get. And you can kind of extrapolate, if this is the kind of performance you can get intraday, and this is the kind of performance you could get HFT, right? Then basically in between is what you can get, trading intraday, but not HFT.